Okay. Bruce is the Chief Investment Officer at Integral Asset Management. He initially joined Goldfields in '72 as a learner official and gained underground experience at some of the West Rand gold mines. He then completed a BCom and joined the stockbroking industry as a mining analyst. Worked for various companies over the number of years, and he is a founding member of Integral Asset Management, and he is also the investment analyst representative on the SAMCODES Standards Committee. So Bruce, without further ado, off to you.
Right, good day, Tanya and the team. Thank you very much for this opportunity, and good day to everyone online. It's to chat to you guys about the role and the meaning of SAMCODES and what it means to investors. And if you think about it, as Tanya said, what are the purpose and the reasons is it gives mining entrepreneurs the opportunity to gather all the technical information, do all the risk assessment, and really at the end of the day is to be able to go to the investment community and raise funding for mining opportunities. So if you look at put yourself in the shoes of the investment community, in the old days, and I'm talking 25 years ago, there were a lot of technical skills in the stockbroking and the asset management arena, be that geological, mining, or metallurgical skills. And likewise on the stockbroking side and on the asset management side. And those skills have dwindled and long since left the industry. There's very few of us left. Industry is dominated by chartered accountants and CFAs, chartered financial analysts, so very much an accounting type background. And the picture I've got on the top left is an Impala Platts mine on the Western Limb. And typically, you know, that is what your general investor would look and think about as a deep level mine. They would see shaft head gears, silos, conveyor belts, processing plants. And unless you have a geological or mining background, you have no idea of what is down below. Now, the industry has gone a long way in recent years to provide lots of reports. On the right-hand side, and just not to repeat all the time, but I'm using a lot of Impala Platinum's reporting. They have won the awards of the best reporting mining company for many, many years, and they do a fantastic job. So in the old days, we used to only get annual reports. And I can tell you that in the early 80s, the annual report would be about 10, 15 pages long, very little detail. We now have audited financial statements. As you see here on the left, we have annual integrated reports, ESG reports, remuneration reports, and then the most important ones that we're going to be alluding to today are the mineral reserve and resource reports. Now, when you go, if the average investor opens up the balance sheets, they want to know what a company is all about. They look at the balance sheet, or what they call the statement of position nowadays, income statement and cash flow statements. You could generally look at those three statements and you could get quite a good idea of what the company is all about. Now, this is again Impala, and I just want you to focus on under non-current assets. The top line is property, plant, and equipment. That is the asset base that is recorded in the balance sheet, 64.5 billion, 57 the previous year. Now, if you look on the right-hand side, that number is primarily made up of expenditure that has been spent on capital account, building the mine, the shafts, be it the open pit, be it all the stripping, all your processing plant, your connections to water, power, etc. That all goes in there. And then you have your typical depreciation number going through every year. Now, you might ask yourself, well, where do we see any valuation or indication of what the real asset base is, which is the mineral reserves and resources? Where do we see that? What the mining companies do behind the scenes, once you've got the capital expenditure number on your balance sheet, the mining companies, if you look bottom right, I've got some comments there, they will do their life of mine net present value type calculations to get a feel for what they think the value of the mine is. And that's really, what are we going to exploit? What are we going to process? What prices are we going to get? Exchange rate, costs, etc. And if that valuation differs significantly from what the balance sheet is showing, you will see in the middle of the right-hand top right table there is a reversal of impairment. So you could either add to that number or impair it. My problem with all of this is when I look at that, I can't see, I don't understand where the reserve and the resources are. It just doesn't tell me anything. So hence the type of documentation that comes via SAMCODES is incredibly important. So what the SAMCODES does for us is it connects the mining entrepreneurs with investors. And if you just look through some of the commentary that I've included there, and this goes back a while, it's from Sibanye-Stillwater 5 years ago, 6 years ago. And really, it gives the investor a lot of comfort that comparisons are made against other jurisdictions. There are the linkages to the stock exchange in terms of when you are listed, you have to abide by certain rules, regulations, and it links into and back into SAMCODES. And so it gives the investor a lot of confidence that the data and the information is trustworthy. Also, what you know, along the same line there is that the mining entrepreneurs are able now to combine all the risk elements that go with a mine. And I'm sure many of you will understand from the day you start exploring, you are building a case of certainty. What have we got down there? What does this ore body look like? What does it contain? How would we mine it? How would we logistically get people in and out of a mine? How would we ventilate? How do we get the ore out? How do we process it, market it? And so what the SAMCODES allows competent persons to do is to pull all these risk elements together, assess them carefully, and then modify them so that we understand how we're going to mine, process, what infrastructure is needed. Ultimately, is there a market for the product? Is it long-term sustainable? And of course, there's all the legal issues. ESG has become a big issue now, and that adds a lot of pressure onto mining companies to look after the environment. The social part of it has gathered momentum. Communities creep up around mines in huge numbers and put massive pressure on the mining companies. And then, of course, there's just governance, which we shouldn't even have to debate. But it enables the mining entrepreneurs to put this together and create a business case that can then come to the investors for funding. This is typically, I've taken this from Anglo Platinum, and I can tell you when you go through the Anglo-American reports and listen to them, driven by a big global company, this team are just really on top of innovation, pushing forward, looking for smart ideas, etc. So this gives us, the investor, a lot of confidence when we look at these reserve resource documents, and the other ones are listed, is that we know that the ore reserve and the mineral resources have been sufficiently drilled. They explain how they get to the tonnage and grade estimates. We know that the mining companies are looking at their, and that's obviously very topical, looking at their sources of power and water. And then just the general skills. One is blown away if you look at these big groups like BHP and Anglos and Rio Tinto. The range of technical skills across companies like that is just amazing. It is sensational to see how they get pulled together and get the job done. Of course, we've got to understand plant and equipment that is needed, and then the financial assessment, which is more what the investor is really good at doing. But the investor doesn't know what underlying assumptions and numbers need to be considered. And so SAMCODES provides a lot of teaching and a lot of assistance. Again, it also, on the top right-hand side, Anglo Flats and Anglo American itself, their value chain is, it gives us the insight into when they go out and discover ore bodies, how they plan and build, the mining, the processing, the marketing. When sadly these ore bodies with their finite lives come to an end, is how we're going to handle the closure. And then the bottom slide just really goes through the whole process of, to define those mineral resources and reserves is the process of data collection, validation, modeling. And then when you finally hand all of that information over to someone who can now really plan the mine. Now this is where we get to marry the SAMCODES with the stock market. So the JSE under Section 12 mineral companies, you can see on the left-hand side are some of the definitions and requirements. So any listed mining company needs to abide by these guidelines, and that plugs straight into SAMCODES. So again, the investor is pretty confident that the JSE now has not just allowed mining companies to list, come and sell you a story, and there could be no substance to it. It is very, very strongly linked back into SAMCODES, and you're going to hear a lot more about that. And then just to give you sort of the first type of slide that you typically come across when you look at a mineral resource and reserve report is the one on the right-hand side. And this is great. This is what Impala have done, and they really do put things together in a nice way. If you want to go and see what a good reserve resource report for the investor looks like, where under mineral resources, they'll tell you the ounces that they think are inferred, indicated, measured, and then likewise on the reserve side, they'll tell you the probable and the proven. Right, so here's an example. What Impala do is that they will list all their operations and they will show what the ownership is. And what we would have to do is to try and value this properly, is we would have to go and try and build a model on each one of those mining operations. And then we know what percentage participation Impala has. Now, underlying all of this, when we see those percentages, we just assume that the mining company owns all those mineral rights. They have long-term rights to it. All the mining, the environmental, the water licenses, the social license to operate, that is all taken as given that it is in place. And we should be far more strict on that, because as you move away from big companies that have been around for 30, 40, 50, 60 years, and newcomers, one should interrogate them and try and make absolutely sure that you have proper ownership. So that's vital. Right, so here we get to, as I started out saying, is that the average accounting type of person would only use the imagination to look at a shaft and then try and imagine what was underneath it. And I think in this audience, you'd all agree that you've probably got no chance of imagining what is down there. and what the ore body shape and size might look like, and then how you're going to get it out. So I really like the 3D schematics that are available. And I would urge people that when you're putting geological type of documents into the public domain, into the investor domain, please use as many 3Ds as you can. So this gives you a very simple idea. I don't know if you can see the red lines. The top red line gives you an indication of where the Merensky Reef horizon is. The lower one is the UG2. Shaft system, dark black line going down on the right-hand side of the schematic. And that shows you where the shaft goes down. It begins to give the investor an idea of shaft systems to access reef horizons or bulk ore body in that case. The bottom one is two rivers on the eastern limb. And obviously people will know about the Steelpoort Valley, where the terrain is very, very different. And it's fascinating for investors to get there that have never been to mines before. And you can see the red line where the Merensky is sort of almost up against the edge of the mountain, whereas the UG2 outcrop is further back to the east and on a more flatter plane. And people arrive and they just see this hole, a portal going into the side of the mountain. And like, what are you doing? You're going into the mountain. And so a schematic like this starts giving you a good idea of where that reef horizon is and how we're going to put portals in and then declines down into the ore body, and then how we can board and pillar mine that out. As I say, this is very, very daunting when you have a financial background only, and you've never seen underground. We move from that schematic, and the next thing is we want to know, well, what is the reef all about? So on the right-hand side, the top section is the link to the left-hand side top schematic is Impala Rustenburg. It shows you the Merensky Reef, the 6E prill split, and then the same, the UG2. And you can immediately just see where the differences are. And a key difference is Merensky's greater platinum, and the UG2 is a lot more rhodium, and that has brought in tremendous revenues in recent years. I mean, 18 months ago, more than 50% of our PGM miners' revenues came from rhodium, and then second platinum, palladium, and third was platinum. So they no longer can be referred to only as platinum miners. The bottom right-hand slide is two rivers, and you can see the 6E prill split on the Merensky and the UG2. Also, somewhat different from the Western Limb. This gives us as investors a great insight into how we can actually model the mineral economics of that ore body. Without this, you have no idea of what these companies could be worth. Right, this is just another very, very old slide from old mine that I worked on years ago. And Goldfields, GFSA, when they were still listed and ran the old Goldfields mines, used to produce these slides. One was a plan view, and one was this transverse side view. And this I found very, very useful in explaining to investors is the blue and brown, red, orange lines are the reef horizons. And it shows the shaft systems and then the access, the crosscuts accessing to the reef horizon. This type of slide is so meaningful. It shows you the depth of the reefs, and it also shows you how far at certain points and times in the mining cycle, how far you are from the shaft system. And that talks to traveling times. And many people just have no idea what traveling times mean to the economics of a mine. Sometimes you might only have 4.5, 5 hours on the rock face, and then they wonder why the mines are inefficient and have high costs. Great slide, very old. I wish we had more of them today. As I said now, the SAMCODES really has given me as an investor, as an analyst, access to just really valuable information. And that will allow us now to start building life of mine models. As the mining companies have their life of mine models, analysts who really want to get to grips and understand mining companies and how to value them need to also crunch the numbers. And so top left, you'll see Impala will start off by listing all their 6 major mining companies that underlie the group. In terms of the 55.7 million 6E ounces, you can see for 2022, Zimplats accounted for 39%. They've built a fantastic mining presence in Zimbabwe. Impala is 30%, and then you can see the others are smaller contributors to the reserve ounces. On the top right, very useful type of analysis. It takes you from ounces in 2021 across to ounces in 2022, and it shows you on a net basis how much was mined out or added to the reserve. And you can see in this case, Marula was a big positive contributor to the reserve during the year, and Mimosa was the other one. The others on a net basis had mined out some of the ounces. Bottom slides show you this in a bit more detail, and I've just chosen 2 was the Impala Rustenburg and the Marula. And there you can see where they give you very detailed tons and grades on a 3E, a 4E, and a 6E basis. And then the attributable ounces split out across all the different metals. So we would be able to plug that into an Excel spreadsheet, link it up to the prices, link it up to the rand-dollar rate, and that would enable us to generate a revenue calculation for a company like Impala. And I can tell you, when I started out in the early 80s, they never mentioned what the tons milled was. There was no mention of grade. Full split was not even spoken about. Costs were not given. In those days, we had homelands where you had tax and royalty and lease payments in South Africa and outside of South Africa. It was an absolute nightmare and a guessing game. You were really tested to try and value these companies. This is a really, really useful slide. It is the attributable ounces, and you can see the ounces on the top part of the scale of the slide. Those are the attributable reserve ounces per shaft. And on the bottom part of the slide, it shows you the depth, the shaft depth vertical intervals. So we can look, and immediately you can see which ones go to surface. You can see which ones are subvertical shafts and which ones are probably, there might be a tertiary there. That is very useful in just understanding. You can then let your mind wander, and you can picture what the structure of the shafts are, importantly, how deep they are. And I mean, right now, with winter coming, there's an increasing chance that Eskom goes to level 6 and worse. That means our mines will be on level 4, and the curtailments could be that they may have to stop putting people down the deep shafts because we just won't know when we get them out again. This helps me understand which companies and which shafts are vulnerable to Eskom sitting at level 6 and beyond, and therefore the mines having to make the drastic decision of pulling the shift on their mines. I've had discussions with 3 of the majors recently, and they just do phenomenal work in playing around and being able to juggle their mining versus their processing and when we can get the shift down. So hopefully we don't lose too much, but the common consensus is we could lose between 10 and 15% of our PGM production this year. Right, this is just another type of slide that gives us very useful life of mine information, and it highlights changes in trends. So the top slide is Impala's Rustenburg operations. You can see the blue started off as a Merensky mine. They had problems trying to smelt the UG2 in the early days. Chrome used to clog up the smelters. And by the late 80s, they had pretty much sorted that out. And you can see how the blue line, the Merensky, has tailed off over the years, made a recovery and it's tailed off. And it's become more than just slightly more than a 50% UG2 operation. But it also gives you a very good indication. You can see in recent years is that this operation is up at Rustenburg is starting to get towards its twilight years. The bottom section are the non-Rustenburg mines that they own. And you can see how the ounces or the tons have grown over the years. And the blue line, the blue bars show you, the light blue ones show you Zimplats. They have just achieved wonderful stuff up there. And it just begs the question is, well, why did the government not allow all the other metals and minerals to progress like PGMs have? This is the Waterberg project in which Impala's got a 15% stake, and they've decided really just to sit back and not really chase it. But without this type of information, again, investors wouldn't have a clue what an exploration opportunity is or isn't. Top left is just the location, so you can see typically down at the bottom are all the Mogalakwena Amplats operations, and then the light blue going north is the Waterberg project. The isometric on the right-hand side, I mean, isn't that wonderful? If you're a non-mining technical person, you look at that and immediately it helps you understand the plane of the reef, the dip, why you're drilling, what are you doing with the drilling. It all starts to make sense. Bottom left is the geological succession. There's a huge amount of information out on the west and the eastern limb, less so on the Platte Reef up in this northern limb section. And that just gives you a good idea of the geological succession. And then already, because of the drilling, they've been able to put a mineral resource statement together. And so when you look at this, they've given us tons, grades, and given us estimates of 4E ounces, and then individually platinum and palladium for 2 zones. The left-hand side of that table is the T zone and the F zone. And if you analyze those numbers, you'll see that it is a heavily weighted palladium ore body. And the T zone, in fact, is interesting. It's got almost 19% of the 6E is gold. So because the market thinks that palladium is going to be eased out and people will go back more to platinum being a lower price, palladium prices come off quite a lot. And so I think Impala a little bit hesitant to push a palladium-loaded ore body and look to develop it. I want to just go through something, and this shows how the information that comes through SAMCODES and how the mines report, how it can affect us even on a daily basis. So this is Amplats's Mogalakwena numbers. This came out recently, about 3 weeks ago. Just have a look on the left-hand side. I've got an arrow there. But look at the built-up head grade from 2018 through to 2022. We dropped from 21, we had 3.23 grams per ton head grade to 2.79. That is a 13.5% drop. Now, out of that whole table, that is the key number here. Now, what happened was, and if you had been looking at the ore reserve and resource statements, you would have seen a slight tail off in lowering of their 4E grades. And that is because they're going through a lower grade zone, and it's just unavoidable. And that hit the market. Suddenly, they came out with numbers. You lose 13% of your grade. Boom, you lose 13% of your revenue. And in a high inflationary environment, that squeezes your profit margin quite dramatically. And this is what happened to this last set of results that Amplat's put out. And Mogalakwena is at least 50% of their numbers. The conclusion that Amplats have come to, and you can see they've done a lot of work now to try and get to grips with the grade, is what they're saying in the long-term open pit, no material change in the ore reserve. Now, that's fine on a 40-year basis. But if you're going to go through a lower grade for 2 or maybe 3 years, the market is going to hit you. And that's exactly what happened. So this is just a bit more. They've done intense work on understanding these lower grades, and then looking at ways of how they're going to mitigate it. And that's understanding the geological model, and then looking at their drilling patterns and avoiding waste would help a lot. But the biggest issue here is it's no problem in the long term, it is a problem in the short term. And so what I thought I'd show you how, by following these numbers closely and really getting to grips with what is in the resource reports, and then you can talk to management if you have done your homework. And so what I put together is from the bottom of the mark, this last big cycle started in late 2015. I've indexed the top 5 big PGM miners that are listed here. And you can see for quite a long time, Northern Platinum and Amplats in the dark blue and the green battled each other out as the better performers of this bunch. And then suddenly from sort of March 22, the market came off, they all came off. But when this announcement came that Mogalakwena grade had dropped, Amplats got hit a lot harder. And so the slide on the right-hand side just pulls Anglo Platinum out. And you can see the price on the right-hand side fell, and then it rallied a bit. And then once the market got wind of the lower grades, it hits your revenue line badly, boom. There was a huge sell-off there. Now, at some stage, that might be an opportunity because we know they'll go through the low-grade area, and then they will be back to maybe 3.2, 3.3 grams again. Northern Platinum, with their Boysendal operation, had a similar incident recently. On the North Mine side, on the UG2, they suddenly hit an area where the reef split. And the reef split into from a few inches, which didn't matter. I think it split up to about 3 meters in parts. And so they have had to do a tremendous amount of additional development so that when they mine through the split reef section, that they can mine maybe 10, 15% of the split reef and then take the rest of the tonnage from the normal reef. But it required a lot of very, very urgent extra development and a lot of solid planning to be able to avoid a hard hit on grade. Just for you on the investment side, you can see it was a real big bottom in the market in late 2015. But anyone who bought these platinum shares, Northern to date, and this is after a very, very big pullback, is up 29% per annum. RB Plats is up almost 28%, Impala 27%, Amplats 26%, and Sibanye has lagged a bit at 17%. They've also got lots of other non-PGM operations that impact there. And then I thought what was interesting is if you look at the reddish colored line is RB Platts. Up until May 2020, it had lagged the rest of the producers. And then it came to the public notice that not only Impala was hunting down RB Platts, but so was Northern. And since then, it has outperformed the others. So you can see the market gets things wrong. Part of the reason they weren't chasing RB Platts is it's not a very liquid share. Big institutions who want big holdings just simply can't buy them. But we've got Impala and Northern both believing that that is an outstanding investment, that you will not find another big ore body and mine like the old RB Platts and the new Stelldrift deposit. Right, so let's get to the end. Really, in my mind, it is regrettable that this great work done by SAMCODES committee and the JSE has not led to more exploration and listings of mining companies. It's an absolute tragedy. The work that goes in here is world-class, and we need to get a lot more out of it. But what the SAMCODES does, this uncertainty when we look at balance sheets and we can't see the intrinsic value, we can't see the reserves, SAMCODES brings that all out. It's there. It's a lot of hard work to go and delve into it and get to understand it, but it allows us to do life of mine sort of cash flows, NPVs, IRRs, and sensitivity analysis, etc. And then, of course, the thing that many people stop their calculation before they get to tax. I believe that's a big mistake. You need to understand the tax regime and any investment codes, capex write-offs, etc. And of course, finally, understand the ownership of the mining license. So that is all provided and done for you within the SAMCODES. You just got to go and look for it. And I want to just leave you with a thought is, a successful and growing mining industry requires certainty concerning services such as power, water, rail, and ports. We need a competitive labor force, and we need enduring, long-term, investor-friendly mining policies. And if you think I'm pointing the finger at government, you're dead right. The government have just failed miserably in providing us with friendly, long-term mining policy that attracts money, that people build mines, and we create jobs. So I'd really big shout out to all of you with your political connections, is keep urging people, government, to just understand that this industry can still do wonders for the country. So there's a slide I put together many years ago, is just to point out to people, if you go out of the 2 or 3 of our big cities and away from the little holiday resorts, South Africa is just very simply a country of farming and mining towns. And that it is your primary industries like mining and farming, agriculture, that drives growth and creates jobs. And also that mining needs deep pockets. And I know the government's keen on transformation and it wants small miners. It is very, very difficult being a small miner and a small farmer. Transnet are not going to send 200 wagons to your siding, and you're producing 150 tons of coal a month or iron ore. It just doesn't work like that. And so we need to protect and grow big companies. And then we need to be smart around how we support exploration and juniors. There's got to be a place for them, but it cannot be at the exclusion of wiping out the big players, which is happening on the Sishen-Saldanha line, it's happening on the manganese line, and it's happening on the coal line to Richards Bay. We're just losing billions and billions of revenue per annum. And all of that bad policy and lack of certainty has played out on the JSE. And I'm sure Annelie will talk about that. But this slide, it's to December 21. I need to add December 22 to it. But you can see we've gone from just over 800 listed companies in the late 80s to last year we were down at, I think, 309, 310. That is tragic. We were a top 10 global market cap stock market, almost unthinkable, but we were. And that was in no small measure due to the contribution that mining made. And we need to turn this around. Investors are hamstrung. They have so limited opportunity of where to invest your retirement funds. And mining can still play a very big turnaround role. So that is it for me. Thank you very much.
Ken is the chairman of the SAMREC committee, which is responsible for the SAMREC code. He is also the past chair of CRISCO. He's got over 30 odd years experience in the minerals industry, focusing on platinum and gold. His expertise is in resource project management, mineral reserve and resource estimation. And as well, he is the director of Pivot Mining Consultants. So Ken, if you would like to start sharing your screen, we can hand over to you.
Okay, well, good morning to everyone. Glad to have you on this course. What I'm going to do is sort of go back to basics and talk about the SAM codes from a pretty basic perspective. So we've got a good 2 hours to do it, and please feel free to interrupt me if there's something that's unclear or if there's a question. You don't need to wait right till the end to do that. It's really good to be interactive if possible. So let's move on. So the basis of this, and I think Bruce has given us a really nice overview. So this is a statement from the CRISCO website, and I'll talk about CRISCO in a moment. And important aspects are the mineral industry is a vital contributor to national and global economies. I think we all know that that's entirely true. And this statement came out a while ago, but it's still true, never more so than at present, with soaring demand for commodities that it produces. And we know that, for instance, battery minerals have started to become really important, but they're not the only metals that are important or minerals that are important. It is truly an international business, and we all know that our exports in this country are largely mineral dependent. And it depends on the trust and confidence of investors and other stakeholders for its financial and operational well-being. And I think Bruce has highlighted many of those aspects, that what the codes are able to do is provide confidence to investors and other stakeholders. So, however, unlike other industries, it's based on depleting mineral assets, the knowledge of which is imperfect prior to commencement of extraction. So as opposed to a factory or some other commercial enterprises, we don't always know what's going on underground or where we're going to mine. And the truth is that we know less about it at the beginning than we do at the end. And we make the biggest decisions right at the beginning. So developing confidence in the mine and the asset is really, really important. So it's therefore essential that the industry communicates the risks associated with investment efficiently and in a transparent manner in order to earn the level of trust to underpin its activities. So that's what the basis of the reporting codes is, to ensure that there's a level of trust and understanding of things, of mineral assets for which knowledge is imperfect. This is a typical life cycle of an asset. Starts right on the bottom left, where we find out about potential deposits, evaluate an area, look at the risks, do some prospecting. We come through a preliminary economic assessment or scoping study, develop a pre-feasibility study, a bankable feasibility study, and then we get into actually having a mine. And then so we're going from exploration, which is can easily be 2 to 10 years, to an evaluation, which in this case is 3 to 5 years. A development of the mine itself, that would be 1 to 3 years. Production, which easily 10 to 50 years and longer, and then closure. So that's the life cycle that we're looking at. And most of the work that we're doing is in the exploration, evaluation, and development aspect. Although obviously during the production, we also report resources and reserves. So CRISCO, which is SAMREC, is one of the 14 countries that is part of CRISCO. And CRISCO's mandate is to promote international best practice in the reporting of mineral exploration results, mineral resources, and mineral reserves. So we're going to be talking about the reporting of exploration results, mineral resources, and mineral reserves, which is the basis of the SAMREC code. So first, let's look and see why the codes have developed. In a moment, I'm going to talk about BRIEX, but it's good to understand the background to it. And we all know that the world is becoming more and more requiring better governance. So good governance is an important aspect. Technical excellence is the aspect that most practitioners are using the SAMREC code or using the code to report would be using. So making sure that the appropriate scientific and engineering principles are applied. And the result of that is reliable reporting, which the financial sector is one of our main clients, and other public reporting. And importantly there, I've said minimum requirements. So SAMREC code and the other codes that form part of the CRISCO family, the codes are minimum requirements. They're not to be the benchmark to try and aim at. They're what are required as a minimum. It's important that we see it from that perspective. So let's just start by going back and looking at where the reporting of mineral resources and reserves were in the latter part of the previous century. So during the latter part of the previous century, there were no codes that had been developed, or only late in the first code was really 1989, but there was not really a consistent reporting of codes. And as a result, there were a few quite fantastic debacles. So in the 1960s, there was a Poseidon nickel boom and bust. This is in Australia. And it followed what we've seen in a number of places, and BRIEX's carbon copy of it, where what is reported is tons and grade, and they keep getting better and better, but there's no substantiation for it. So eventually the share price gets completely oversold, and people are buying shares that are way out of kilter with the value of the underlying asset. So those people who buy shares and sell them on the way up, that's fantastic. But at the top, when it's discovered that there's no merit in it, all value is lost and a huge amount of money is lost. So that happened in Australia. So the Australian Stock Exchange looked at a proposal from JORC, the Joint Australasian, so it's Australia and New Zealand, Joint Ore Reserves Committee, for a way to establish a reporting code, which they developed and first published in 1989. It was largely based on some work done in the US by Hoover in the 1930s, and was published in what became known as SEC, the Securities Exchange Commission, in the United States Industry Guide 7. But the Poseidon adventure was not the only one that happened. BRIEX is the one that most people are more familiar with. So 1997, Bre-X did exactly the same. A gold deposit in Busang in Indonesia, and they kept putting information into the market that was false, and the price went up and up. And there are a few slides to show what happened. Enron and Shell, they've also had great issues with misrepresentation of mineral resources or mineral reserves in their case. So that's the background. So in order to get that improved, the codes have developed, and they've come all under one umbrella under CRISCO. And SAMREC is one of the leading countries in CRISCO. So this is the Bre-X situation. So it was a gold deposit in Indonesia, and David Walsh, his picture's there on the right, he found this deposit and had it incorporated on the Toronto Stock Exchange, and slowly but surely they did drilling, and you can see just by the red numbers where they kept reporting more and more ounces. So in a period from 1998, so that shouldn't be 1998. So from 1992 onwards, they in the 5 years, they pushed up the number of ounces by 6 times, and everyone was thinking this was, well, it was a gold mine, but it was really going to make them a lot of money. But they had some due diligences done, and there was no evidence of gold. And probably one of the most famous situations is de Groisman, the geologist who was running it. He left on a helicopter. When the helicopter arrived on the other end, he wasn't on board. The situation is that, or surmised that he was either pushed or jumped from the helicopter. There's lots of speculation whether he's still alive or not, but there's been no news from him, and there has been no evidence that he actually died. So that was a tragedy in itself. But the result was that the price of the shares fell from a few $100s to $2.50, $2 Canadian dollars, and everyone was selling. So a lot of people lost lots of money, and obviously there were people whose pensions and the like were severely affected. This is the report, and it says in the first paragraph, we very much regret having to express the firm opinion that an economic gold deposit has not been identified in southeast zone of the Busang deposit and is unlikely to be. So it was a terrible thing. So that really put the cat amongst the pigeons. Obviously, these people resigned. It wasn't long after that Walsh died of a brain aneurysm, and the whole process went on and on. Obviously, de Groisman was no longer there, and it went to various courts. By the time it actually was finalized, a good 10 years later, the only person left alive was one of the accountants, and they couldn't really pin it on him. So it actually went nowhere. So a lot of people lost lots of money for no good reason. As a result, we developed the CRISCO family. This is the CRISCO family. So CRISCO is the international reporting umbrella organization under which all the codes fall. All the codes are essentially the same. There are some nuances between the codes due to aspects like geography and what minerals they report and how they are incorporated. So, for instance, Europe is much more aligned to things like aggregates and dimension stone, because most of their base metals or their precious base metals and other metals have been mined out. The Canadians, the SIM standard, the Canadian Institute of Mining Standard, which is the basis of what we call the National Instrument 43-101, it's actually a law. Chile has a similar situation where it is a government organization, and many of the East Europe, the European, Asian countries, they are semi-government situation. So each one is slightly different, but they have a lot of tenements that are identical. And as a result, the reports are essentially comparable between them. So if it's measured under one code, it will be measured under another code. So these are them listed again. We will provide this to you so you can see some of the details. We were one of the first. So the Australia, South Africa, United States, Canada, and Chile were the 5 countries that set it up. And as I say, we're up to 14, and every year or so, more countries join. So this has become quite a large or significant organization to support the reporting of mineral resources and mineral reserves. I've discussed this with us already. So it's the important aspect that for me is really important is that mineral resources and reserves are based on depleting assets for which we know less at the beginning than we do at the end. And we need to communicate those risks clearly to the investment public. Listen, I'm putting this up to emphasize two or three aspects. So CRISCO's mandate, and we follow that with SAMREC, obviously, it's a required minimum standard. So if we're reporting under SAMREC, it's a requirement that it's a minimum standard for public reporting. So when information goes out into the public domain, that's when it is important. The other important aspect is that we restrict ourselves to solid minerals. So oil and gas are excluded, as is water, but brines has, although we don't have brines in this country, brines is part of the CRISCO family. So it's to play, our minds are based on depleting assets, imperfect knowledge at the beginning, but we need to understand that developing a mining project involves technical expertise, substantial capital investment. It's always long-term and carries a huge amount of risks. Now, that doesn't mean we should be scared, because we know that there are rewards as well. So there's a balance between risk and reward. This is figure 1, which is one of the aspects that is central to all of the codes. On the left-hand side are the mineral resources, inferred, indicated, and measured. On the right are the mineral reserves, probable and proved. And to go from inferred, which is the lowest certainty, the category with the lowest confidence, with more geological or geoscientific information, we go into indicated and measured, and we go from resource to reserve by doing economic studies, and we have all the modifying factors. I'll explain some of these in a little bit more detail later on. But this diagram is central to understanding the codes. In the codes, there are 17 definitions or standard definitions that are currently identical with all the different codes, and these are them. So public reports, the competent person, which we'll talk about this afternoon, exploration targets, exploration results, mineral resource, and under that would be indicated, inferred, and measured resources, modifying factors which take resources to reserves, and then under mineral reserves, probable reserves, proved reserves, and then the different studies that help us get from resource to reserve, being scoping, pre-feasibility, and feasibility studies. And this diagram is just to show how these are all connected, and the connection between the reporting code and public reporting is obviously through the competent person, who's also central to the reporting codes. So importantly, I think Bruce has highlighted quite a few of these aspects. Why are these codes so important? They promote best practice, which is obviously a really good thing. Common language, so when common language and common concepts, so when reporting is done on one project or one mine, then there is understanding of how they compare, and effectively it's a sort of risk assessment. If we're reporting a measured mineral resource for a coal mine compared to a platinum mine, we have some idea that what is common. So that makes them the projects or transactions comparable. As Bruce highlighted, non-technical professionals are able to understand aspects of mining which they may not have otherwise understood. It's a basis for the valuation of mineral assets. Importantly, it's also a guide for competent persons. And one of the things that we've put into the SAMREC code is Table 1 at the back, and that helps to highlight all the aspects that would be important to have when one's reporting a mineral resource. The codes are also self-regulated, but there's accountability of the competent persons. And by having reporting under the different codes, there's different categories, there's a form of risk mitigation. So the codes generally are related to stock exchanges. So SAMREC, the important is supports the Johannesburg Stock Exchange, but the other codes are also important for their own code. So the JORC code from Australia supports the Australian Stock Exchange, and the SIM standards, or the NI 43101, those are supported in the Toronto Stock Exchange. Now, various other stock exchanges like Hong Kong, London as well, they don't require any particular code. The code just has to be nominated. So this is just some important understanding from the TSX, the Toronto Stock Exchange. So they are the largest or the largest number of listed entities in a single stock exchange. So they provide access to capital, they provide liquidity and training. They're visible globally. They've allowed great growth in the minerals industry, and their market is mostly the junior miners, whereas other markets like ours, for instance, is more the major mining companies. The TSX has a very tailored listing criteria, which is well understood, and they provide some value-added services that support growth of these assets. This is the number of financings that took place in the last 5 years. You can see the TSX by far the most by value. So 48% of all finances have been through the TSX, and TSXV, which is TSX Venture, which is like the junior part of the TSX. 36% of all capital mining, equity capital in the past 5 years has been raised through the TSX, and 40% of the world's public mining companies are listed on the TSX, but that doesn't mean that they're the highest value, strangely enough. So this is an idea of the market cap, and you can see the LSE, which is the London Stock Exchange, is by far the highest by market cap, which is the orange bars. The blue bars are the number of companies. The TSX is by far the most number of companies. They're also second highest in market cap. So let's get on to what's closer to home, the South African Code for Reporting of Exploration Results, Mineral Resources and Mineral Reserves. And the latest version was published in 2016 and is obviously applicable from then on. There were three other versions before that, so this is the latest version. So just to give some idea or some history of it, as I said, JORC was formed in 1971. They published the first code in 1989. In 1991, the Institute of Mining Metallurgy a code was produced, and SAMREC was formed in 1992. The SME published a guide in 92, and then CRISCO, which is the Committee for Mineral Reserves International Reporting Standards, that was that's the full definition. They formed an initiative, or it was formed under the Canadian Metals and Mining Institute in Canada, which became CRISCO. The important event was 1997. The Denver Accord was happened, as I said, with Australia, Canada, South Africa, the UK, and the US. and they formed that's where the definitions were agreed. And those definitions have been unchanged to date. We will, that's probably going to change in the future because there are a whole lot of developments. So that formed the basis of all the reporting codes since then. The first code that we produced was in year 2000. The Canadians produced one in 2001. But importantly, the SAMREC was adopted by the JSE, and the professional bodies, the GSSA and SIMM, have got various aspects of their bylaws for people who are members of those organizations. And we'll talk about this when you talk about a competent person this afternoon. So SAMVAL, which is the valuation equivalent, was formed in 2002. And that's the same year that CRISCO was formally formed in its current format. So we've had 2000, we produced our first SAMREC code. It was updated in 2007. There was some restatement in 2009, and then 2016 was the latest form. So, and we've had a SAMMARC, which is the oil and gas code, and SAMESG, which is the other guidelines for ESG, have been formed in the meantime as well. This is just an idea that the reporting environment is a bit like a jigsaw puzzle. There are lots of aspects that need to come together. In the yellow, we've got the different organizations that support competent persons. We've got the government, which is in brown, the MPRDA, the DMRE, and the royalty bill. The JSE listing is in the middle, and we've got the red, we've got the three main codes. And then we've got the competent persons and competent evaluators. So it's very much a jigsaw puzzle that all fits together in order to help the industry reporting mineral resources and mineral reserves. So SAMREC falls under the SAMCODES Standards Committee, and the purpose is to provide standards and recommendations for the guidelines of reporting of mineral resources and reserves and evaluation of mineral assets in South Africa. So there's an organization, a strong organizational background to the codes to ensure that everything is done in a really good way, ethical and well-supported way. The SAMCODES are supported effectively by the Geological Society and the Southern African Institute of Mining and Metallurgy, but there are a whole lot of other stakeholders that provide valuable input. So EXA, the Engineering Council, the Institute of Mine Surveyors, Geomatics Council of South Africa, SACNASP, and all of those, they provide valuable input to the code. So it's an industry-wide organization. And that, as a result, we have the SAMREC, SAMVAL, and SAMMOG committees, which provide the codes, and the SAMESG committee, which provides a guideline. We're well aware of the GSSA which, and the Southern African Institute of Mining and Metallurgy. They are learned societies with large memberships within, mostly in Southern Africa. I'm not going to go into a lot of detail about the SSC, but essentially they run help to run SAMREC. So they're the reporting organization to which SAMREC reports to ensure things are done properly. SSC and SAMREC meet 4 times a year, every quarter, and that's to ensure that we up to speed with developments and various things that go along with that. Let's go and look at the aspects of the code itself. Let's not get too bogged down in the stuff that goes behind it. So the code is a minimum standard, and I fear that I'm repeating myself, but I think it's important that some of these things are repeated on a regular basis. So minimum standard, it applies to solid minerals. It does not include oil, gas, or water, and it's for reporting of for public reporting. Now, public reporting is an aspect that we'll come into a bit shortly, but that's every time a company puts something out in the public domain, the reporting mineral resources and mineral reserves, they should be using the SAMREC code. And that's particularly important for the JSE listed companies, but also for non-listed companies. So let's look at the JSE. The JSE has adopted the SAMCODES for all of their listing requirements, the SAMREC and SAMVAL. There are readers panels, and the readers panels are there to ensure that the reports that are put out, the competent persons reports, valuation reports that are submitted to the JSE are compliant with the requirements of SAMREC and SAMVAL. They're not there to validate whether it's a good investment, but to validate compliance. And that I think there's going to be some discussion about that at a later stage. Bruce did mention Section 12. Section 12 of the JSE listing rules present the requirements, and that's the front page of Section 12. They're in some ways a subset of the requirements for SAMREC, but they deal with both listings and with ongoing reporting. So where reporting happens on an annual basis with annual reports, they're also that's requirement is to use and be compliant with Section 12 requirements of the JSE listing rules. Once again, this is minimum standard solid minerals, but the code very pertinently says the present information about mineral assets to investors and potential investors, to their advisors, and also to satisfy regulatory requirements. It also provides guidance for competent persons, and the principles that are applicable to the code. So the three principles that we look at are materiality, transparency, and competency. We'll have a look at those shortly. Now, importantly, the code is not a prescription or set of rules. It's just too difficult with the number of mineral commodities and the number of deposits to be prescriptive. And it's also not a stick to punish competent persons. It is more a guide to help competent persons to report, and for those that need to know, particularly in the financial environment, that they can understand it. It's also there to ensure aspects such as data integrity. So the importance of public reporting is governance, and as we know, governance has become more and more important. It also helps to apply the application of good practice. So good practice is important in reporting of mineral resources and mineral reserves, and reporting by experienced and responsible people. So the codes are there to make sure that experienced and responsible people use good practice to report mineral resources and mineral reserves. As I said, we come back to public reports. Public reports are prepared for the purpose of informing investors or potential investors and their advisors on exploration results, resources, and reserves, and they're not limited to annual reports, quarterly reports, press releases, information memorandum, technical papers, website postings, and public presentations. So any form of public declaration, whether it's written or verbal, actually effectively comes under that. And so that's what the codes are there to do. It's and in practice, what should happen is that when an announcement or a report is made or press release, the competent person should be provided the opportunity to ensure that what is put into the public domain is in the correct context. The code itself, these are the main reporting headlines. So there's a glossary of terms, there's a forward introduction and scope, there's discussion about competency and responsibility, there's reporting technology, there's aspects about general reporting, then the three main categories: reporting of exploration results of mineral resources, mineral reserves, a discussion about technical studies and what they mean. And then there are specialist reporting requirements for coal, diamonds, for industrial minerals, and then for metal equivalents. And then at the end, we have a checklist for the guidelines. So that's table 1. And that is to be reported on if not, why not basis, which we'll discuss shortly. Table 2, the guidance for technical study. So what would be required for a scoping study or a pre-feas or feasibility study. And then some recommended or suggestions for table of contents, for author certificate, and for guidance for compliance statements. The code is broken up into effectively 3 aspects. So we have a definition. So those are in this yellow or gold color. We have code, which is highlighting those aspects from the definition, and then guidance, which is there to help the application of the code and the definition. So when one reads the code, one needs to see how those are put together. And the 3 principles, as I said before, materiality, competency, and transparency. So materiality, relevant information that advisors would reasonably require and expect to find for the purpose of making reasoned and balanced judgment. So that's what a materiality is supposed to be. Competency, the reporting should be done by qualified and experienced persons who are subject to enforceable professional code of ethics. So that's one of the critical pillars of the code. And transparent, the reader of the public report must be provided with sufficient information, the presentation of which is clear and unambiguous to understand the report and is not misled. So it needs to be all the information, the good and the bad, and needs to be put in such a way that can be understood. So materiality, under that, we're looking at all relevant information to enable a reasonable and balanced judgment, to inform investors and their advisors. It might have an impact on the public perception and value of the deposit. So anything that would do that, obviously impact the value, and needs to be disclosure of all material aspects. And that's, as I said, the good and the bad. Transparency is looking to make sure there's sufficient information, there's not silence on any issue. So all aspects are presented. It's balanced reporting, it's unambiguous, it's clear, and importantly, it's also not misleading. The competency that comes to the competent person must be suitably qualified, suitably experienced, have a professional membership, belong to organization with enforceable code of ethics, and should not be unduly influenced by the commissioning agent, and then will be held responsible for the reporting. The underlying aspect for the competent person is the competent person must be satisfied in their own mind that they're able to face their peers and demonstrate competency. So when a competent person puts something out into the public domain, it's important that they are prepared to defend it to their peers and that they can. So if they're doing using some strange logic, they need to be able to present why it would be applicable. So it's important that they can justify it. Now, we've discussed the benefit. These benefits are the same as we discussed earlier, but it's always important. The graphic highlights the why we need to have code. So Johnny's talking to his mother and says, "I'm hungry and I want a snack." And Mommy's not really wanting to get up to go to the kitchen. Says, "Sure, help yourself." Johnny's very happy, gets into the kitchen, and he's already after the cookies, but Mommy's thinking an apple and orange from the fridge would be better. And his comment is, even though we're both talking English, we're not speaking the same language. So that's why the codes are there, is for us to understand what is being presented, and it's not ambiguous. It's important that the presentations are relevant, so it's not a square peg in a round hole. I've shown you a similar picture before. What the reporting is meant to be. So it has to be signed off by a professional, a competent person who takes responsibility for the information. Importantly, it's the individual that takes responsibility and not the company. It must be based on reasonable assumptions that are clearly explained, which is where we go back to the competent person must be able to defend themselves to their peers. It must be consistent in its use of standardized items and definitions, needs to be unbiased, identify the potential risks and the uncertainties, be balanced and not misleading in the format that allows the comparing of similar projects, and must be understandable to reasonably informed investors. So these are all aspects that are important for the what it's meant to be, what it's not meant to be. So reporting under SAMREC is not a guarantee of good work. It's also not a cookbook or recipe of how to do a mineral resource or mineral reserve estimate, and it's definitely not confirmation that the work is good. So it's definitely not putting lipstick on a pig, in other words, making a project that would not be viable appear viable. So that's definitely not what it's supposed to be. Important aspect is that the code has the code, which is what we're probably familiar with, but that the competent person reports through a professional organization. In this country, we have 6, 2 geological, 2 engineering, and 2 for the surveyors. But the importance of that is that these organizations then hold the competent persons responsible for the work that they do. They have a code of ethics, and also they have a disciplinary procedure. And the disciplinary procedure needs to be set up. Can only kicks in when there's a complaint. The SSC, the SAMCODES Standards Committee, maintains a complaints procedure. So it goes, the complaint, which needs to be in writing, would go to them for initial investigation, and that's to ensure that the complaint is directed at the right to the right place, and also to make sure that there's some sort of substance to the reporting. So, and that's all aspects of public reporting that could be complaints could be delivered on. Unfortunately, there are very few complaints made in our industry, which is not always so good. So a competent person's report, and it is required to comply with the SAMREC and SAMBAL codes, and should not be less than 6 months. This is for the JSE. Must be less than 6 months prior to the date of publication. So when it's published, it mustn't be older than 6 months. It needs to be updated. It can be updated prior to a pre-listing statement if it's category 1 transaction. The competent person needs to declare if they are not independent of the issuer. So there are times when a company would have an employee do mineral resource or mineral reserve estimate. For instance, Anglo American would do exactly that. All the large mining houses would do that. And there needs to have, for the Johannesburg Stock Exchange, there needs to be indicated which parts of the code are referred to, and that is put into a table at the end and on all the pages of the competent person's report. Now, the competent person's report doesn't always have to have all of those aspects in if it's not with a JSE, but it still should have all the minimum requirements of a competent person's report. For the JSE, it will contain a valuation section. It must be published in full, and it would have gone through the readers panel for compliance only prior to publication. So let's look at the table 1 or figure 1 of the code. Top left, exploration results. So those would be early reporting, and we'll talk about it shortly. Reports, grades, and tonnages in ranges. Then, and doesn't necessarily have to have been demonstrated to be economic. When we get to mineral resources, we've demonstrated that there's a reasonable prospect of eventual extraction. In other words, there's a reasonable chance that from a technical and economic perspective, it can be reported. And those would go up in level of competence from inferred to indicated to measured. All those reports are in situ, so it's not taking any mining factors into consideration, and the confidence is improved by geoscientific knowledge. When commercial aspects are applied, we go from resources to reserves, and we then apply the modifying factors. And the modifying factors are mining, metallurgical, infrastructure, economic, marketing, legal, environmental, social, and governmental factors. And they go to the mineable estimates. And we'll talk about a point of reference a bit later. But importantly, indicated resources can only be made into probable mineral reserves by application of modifying factors. Measured mineral resources can be either proved, and please note it's proved and not proven, either proved or probable mineral reserves after the application of the modifying factors. So exploration results, then we go up to mineral resources when we've demonstrated technical and economic potential. With the increasing geoscientific knowledge, we go from inferred to indicated to measured. When we apply the economic factors, modifying factors, we go from resources to reserves, and we go from probable. We can report probable and proved, and depending upon where we are, we can from which basis that would be. Okay, as I've said before, we've got a very broad range of solid minerals. So bulk commodities such as coal, bauxite, iron ore, manganese, base metals, lead, zinc, nickel, and copper, precious metals, PGMs and gold and silver, precious stones, diamonds, emeralds, and other stones as well, mineral sands such as rutile and zircon, energy, coal and uranium would fall under those, but not oil and gas, rare earths, industrial minerals, and there are a huge number of those. So we got a very broad area that we cover, hence we have guidelines and not prescriptive aspects to the codes. These are the core definitions or standard definitions. They're the same as the Crisco ones. And let's start by looking at a site visit. Now, we've put in there a site visit is required, should be undertaken by a competent person and the appropriate members of his team. If it's not undertaken, good reasons must be given. And COVID was one reason why site visits didn't happen, but there were innovative ways of doing it with drones and video calls and the like. There would be other reasons, which would be Ebola would have possibly been one, where there's conflict in an area that might be another. But they've got to be good reasons for that. But having said that, I have not had an experience where a site visit has not made a huge difference to understanding the deposit. And it's much more than understanding the technical aspects. It's generally understanding the context in which the deposit is found. And important things like that would be how close the community is, what sort of infrastructure is available in the area, those sort of things. Here are some examples of how core has been kept, and how boreholes have been marked in the field. And that would be important aspects to consider when doing a site visit. Obviously, the better the core management is, the more likely one is to believe the results. Top left, you wouldn't be in a situation where I went to site and I stood outside the core yard and looked at the core boxes. I mean, that wouldn't be very good. The top in the middle, we have some examples of the core that's not in good condition, and we have some that is properly stacked and properly labeled on the top right. The core obviously is not always in perfect condition because of the structure of the rocks themselves. And then there are various ways in which the position of the hole can be marked. And we'd like to see that those have also been rehabilitated properly. Here are some examples which are horrendous. Top left and bottom left, the core, obviously the boxes have not been looked after very well. The core's all jumbled up. One wonders whether that would have any information. Similarly, top right, core boxes in a desperate state. The handling in the core is also quite critical. Where it's been cut, you can see that the cut in not all cases is one goes through the same angle throughout the hole, and in the bottom right, it's probably a 2/3, 1/3 situation. And then we've got right in the middle, we've got some grinding. So all those aspects that would help you to assess the quality of the information that you're getting, important aspects of a site visit. We've discussed this general minerals. Looking at coal, the important one is we call it coal resources and coal reserves, and the reporting of reserves, we're looking at run of mine and saleable estimates. So there's definite markers where we would have coal. For instance, in base metals, most of the time we would look at head grade and tonnage at shaft head, whereas coal is looking at what's saleable or run of mine, and obviously must be indicated which is which. Diamonds and gemstones, so stones, they are use exactly the same structure for figure 1, reported mineable production estimates under diamond reserves. We've discussed the degree of confidence, so it's geoscientific knowledge and confidence, so that tons and grade are reported must reflect the different levels of geoscientific confidence and different degrees of technical and economic evaluation. So there's normally quite a short list of critical aspects. So important that we have a good volume, deposit volume, so that's a geological model, and we have good information about the chemistry. So that important aspects, obviously the volume, density is one of the critical ones that is often overlooked. The way the sampling is done is important, and the chemistry and how good the analyses were. So we need to make sure that the information available truly represents the information about the deposit itself. Okay, coming to exploration results. So exploration results are information generated from exploration programs that may be used by investor, but do not form part of the declaration of mineral resources or mineral reserves. So when they're reported, they are reported on a separate table, not in the same table, and they have to be expressed as a range of grades and tonnage. And there's not, it's not certain that they will be able to declare a mineral resource later on. So effectively, and not part of a formal declaration of mineral resource and reserves. They include all the relevant data to the exploration, the mineral property. And I'll emphasize it again and again. The reporting needs to be both positive and negative. So where a company is reporting in intersections, they generally try and report only the highest ones. All of them should be reported to give a balanced reporting. Exploration results, it's important that the work done, and various work can be done at this stage. So it could be various surveys, remote sensing, geophysics, geochemistry, could be sampling or drilling, assaying, all sorts of things. But there must be some physical evidence of the mineralization on the property of interest. It's no good inferring it from a neighbor. You can't always infer that you're going to have mineralization because on the property next door there is mineralization. It has to be physical evidence. Historical data which can be extremely useful, can be included if the competent person has had assessed that the data is suitable. And obviously data from adjacent properties can be used, but once again, competent person must ensure that it's properly understood. Balanced reporting is important. So selective, only certain parts of the data, that really isn't acceptable. Under exploration results, we have exploration targets. We effectively have two types. One is speculative, and one is tells you something about what is there. And once again, that's reporting ranges. So you might be in a situation where a company says, we expect to find between 50 and 100,000 ounces in an area. That would be speculative, but under exploration target, we want them to say that they X number of tons at this grade, which represents the 50,000 ounces, and X tons at X grade, which represents 100,000 ounces. And that's another aspect that under the codes, it's very flippant for executives to report, for instance, gold ounces without any supporting information. And that's not acceptable under the SAMREC reporting. So tons and grade are required. And an informed investor would also want to know something like a depth, potential mining method, and a few other aspects. So those, a very high level statements can be pretty misleading. Where a company is expecting to, hoping to have in an area some mineralization, then it would be speculative, and they can report it as an exploration target. There would obviously have to be a description of why it's been done. So if they haven't done any concrete work to do it, they can report it, and it is speculative, but must once again be a range of tons and grade. However, there are times when they've actually done some work, but the work is not sufficient to demonstrate either technical or economic potential, but they still want to report it, and then they can do that as well, but that's an exploration target. So it's much lower in confidence than mineral resources or mineral reserves. Mineralization is used for the concentration of material of possible economic interest, and it cannot be estimated with sufficient confidence to be defined as a mineral resource. So it's basically what's in the ground. Once again, balanced judgment and balanced reporting is required. So now mineral resource, this is the first big step in the life of most projects. A mineral resource is a concentration of the kinds of material of economic interest in the Earth's crust in such form, quality or quantity. So sometimes we would be looking at quality. So some metals, some reports don't report grade, they report quality. Quality and quantity that are reasonable prospects of eventual economic extraction. So that requires some judgment. The location, quantity, grade, continuity, and other geological characteristics of the mineral resource are known, estimated or interpreted from specific geological evidence and knowledge, including sampling. So in our world as geologists, it comes down to geological confidence in the location, in what the deposit looks like, so the geological model, the tonnage, the density, all the physical characteristics, the grade, and obviously the mineral content. Now, one of the aspects that it's regularly asked is what are the confidence levels on reporting of mineral resources into the various categories of indicated, inferred, indicated, and measured, and we don't put those on. We don't say what those could be. That's up to the competent person to make that judgment. So importantly, it's a concentration of material of possible economic interest in the Earth's crust, and it does, and it must be sufficient confidence to be classified in the inferred category. Portions of the deposit do not have to have may be excluded because they're not economic, So we've got to be careful of where we draw the lines of potential economic interest. For instance, great depth is an issue. At some point, for instance, if you're mining from surface, you may get to a point where refrigeration is required, and then that would step up the cost quite significantly, and obviously the technical requirements. And you might say the mineralization is there, but it cannot be declared as a mineral resource. So that would be the potential no longer exists at depth. Mineral resources, the in situ mineralization, it can include dumps or tailings, and would be identified through exploration, all the geological work we do, sampling, and we wouldn't apply mineral modifying factors, but we would do some assessment to ensure that we've got that correct. So we would apply some assumptions to determine the reasonable prospects for eventual economic extraction, so that we can demonstrate that and face our peers. So reasonable prospects, it implies a judgment of the technical and economic factors. It must be a realistic inventory at the time of reporting, and assumed and justifiable technical economic conditions that it might be economically extractable. So important aspects will include things like depth, cut-off grade, yields or recoveries, and sometimes specific minimum thicknesses. For instance, a coal seam that's too thin would not be considered appropriate to declare as a mineral resource. We have the word eventual in there, and that we've put some guidance, and that depends on the commodity and the life of the mine. Judgment is required. So we need to meet a reasonable test, and we need to be sure that other competent persons would come to similar conclusions using the same circumstances. The word eventual does allow some relaxation of the standards, and looking forward, the forward-looking of mineral prices. And that's very different to mineral reserves, where that is not the situation, where then you need to have a bit more definitive pricing and obviously costing. So there will be cases where a material that is below a cutoff would be included in a mineral resource in order to make sure that it passes the eventual reasonable prospects of eventual economic extraction. But we do not include, unless we're looking at a mine, things like dilution and those other aspects. So we need to clearly discuss when we're putting our documents together what we've included and what we haven't, and it needs to be properly presented. So inferred, the important aspect of inferred is that we need to grade or geological continuity are sufficient in their own right. So we don't have to have both. We must be able to verify the geology, but we don't have or the grade. So that's the critical aspect there. So this is an example where we might have struggle a bit. You can see this is it actually happens to be an iron ore deposit, and you can see there are a whole lot of places where mining might take place. And you might say, well, we can mine from surface, but there's not continuity, so it may or may not be in an inferred category. So there would be limited measurements of the sample that has been taken, limited amount of data, and because of that, it's inferred, and we do not allow inferred mineral resources to be converted into mineral reserves. Only it's got to be one level up. So under the CRISCO, it's reasonably expected that the majority of inferred mineral resources would upgrade to indicated mineral resources with continued exploration. So it's important that we are not so speculative that it's got potential, but we know that if we do more work, we're actually not going to find a deposit that's any better. The Canadians have put together, well, let's put it this way. So there will be times when we're doing a mineral reserve or doing a mine plan that parts of the inferred mineral resource would be included in that design, but we need to fully disclose what it is. And it's good. One of the ways to do that is to show what would be, obviously the rationale for the inclusion needs to be explained, and you're showing the results with and without the inferred resources. Now indicated, we're going up one category. So we must assume geological and grade continuity. So it's not one or other, it's both. And we've obviously done more work, more confidence, and we've been able to demonstrate viability, better viability of the deposit, deposit under consideration. And we will, this under indicated, we can convert a resource into a probable mineral reserve, not proved, only probable. So it's going straight across in figure 1. So inferred, indicated mineral resource can be estimated with the level of confidence sufficient to allow appropriate application of technical and economic parameters to support mine planning and evaluation of economic viability of a deposit. So this is in the Canadian Institute of Mining standards. So they're saying when you get to indicated, you would be in a position to be able to do some mine planning, and obviously that would help to allow the conversion of an indicated mineral resource into a probable mineral reserve. So it needs to be based on detailed and reliable exploration gathered through appropriate techniques from a location such as outcrops, trenches, pits, workings, and drill holes that are spaced sufficiently close for geological and grade continuity to be reasonably assumed. A measured resource, obviously we've got geological and grade continuity. Those are important to present. And we can convert a measured resource into both probable and proved mineral reserve. It's the only type of mineral resource that allows conversion into proved mineral reserves. The important aspect here is more work has been done so that we know what the deposit looks like. So geological model is good. So we've got quantity, grade, densities and shape and physical characteristics are estimated with sufficient confidence to allow the application of modifying factors to support detailed mine planning and financial evaluation of the economic viability of the deposit. So we've got probably data that's much more closely spaced, and it's much easier to see where how good the deposit is, and have a really good confidence in it. So, and the Canadian some standards, their guidance says can be estimated with confidence sufficient to allow appropriate application of technical and economic parameters to support production planning and evaluation of the economic viability of the deposit. So they're trying to give some guidance as to when what a measured mineral resource is. And all of these, the classification requires application of sound scientific and engineering principles and a judgment, and obviously that's why experience is required. As I said before, it can be converted into approved or probable mineral reserve depending upon how the application of modifying factors is concerned. And typically what we would say is that you're looking at the lowest confidence of your modifying factors to define what level of mineral reserve you are going to declare. So the mineral reporting, the way in which it's done, should we want each of the categories to be reported independently. So reporting measured and indicated together, unless one is reported both separately, is not allowed. The Canadians want they won't allow inferred to be summed with indicated and measured. So you will see in some of their reports, measured and indicated are reported together, but in those cases, we would want the measured and indicated to be reported separately. Similarly, reporting the content is not sufficient. So the number of gold ounces or the number of tons of copper, that's not sufficient. The tons and grade must be reported as well. The Australians report, they call their reserves all reserves. We're happy to use that interchangeably. We obviously prefer to call it mineral we call ours mineral reserves, but we've got to be careful that we don't confuse ore and reserves. So ore and reserves applies having done technical studies, which are much more detailed and obviously supported by a full information on the modifying factors. So when we look at mineral resources, we shouldn't be calling them ore and we shouldn't be calling them reserves. Only once we've applied the modifying factors and done a pre-feasibility study or better. Important aspect is when one's reporting is the level of accuracy. You can see in the graphic at the bottom, 2 + 2 = 3.984. We really shouldn't be reporting decimals on tons and individual tons and even hundreds or thousands of tons, depending upon the size of the deposit. Remember that we're reporting about an estimate, not this is not a calculation. So that's another aspect that should be avoided, calling it a calculation. Deciding on the classification of inferred, indicated, or measured, that obviously takes some skill judgment from a competent person, and that's why we'll talk about competent persons later today. That's why one of the reasons why the 5 years of experience is required. But just to give you some idea, this is just a cartoon about inferred. Exploration results would be effectively saying, we know there's a lake somewhere we can go fishing. Inferred would be on the lake saying, oh, there must be fish here, but not having caught one. Indicated would be we can catch them, and measured would be we've actually caught one. We've got a really good idea. We've got the weight of the fish and all of that sort of detail. So modifying factors, important aspects here are what is included. So these are include but not restricted to mining aspects, processing and metallurgical, infrastructure, economic, marketing, legal, environmental, social, and governmental factors. So all of those aspects would be included as modifying factors to go from mineral resource to mineral reserve. So mining would be aspects such as the mining method, the costs, the losses. Metallurgical would also, important things are recoveries and yields. Infrastructure, we need to have infrastructure, and that needs to be costed. If power is required or water has to be found, those are important. Economic would include costs and supply and demand. Marketing, we would include the cost of sales and the price of the commodity. Legal aspects are do we have the rights? Do we have all the legal permits that will allow us to mine? And do we is it so we have all the right permits to mine? Environmental, obviously there's a lot of information about environmental these days, and that needs to be brought in. Likewise with social impacts and the costs, and the government can also provide some sort of constraint. And it's unlikely that any one person would be able to do all of these aspects, and that's why we would bring a lot of specialists in in order to do that. So mineral reserves, once we've got to mineral reserves, we've now demonstrating economic and technical mineability. And we've included diluting materials and allowances for various losses. And importantly, we're looking at pre-feas or feasibility studies. And this is then reported at the report of the mineral reserve needs to be at the time when it is declared. And the reason for that is that the various, particularly economic assumptions in some cases of forward-looking cost revenue from the sale of metals. Those are defined, that could change. So that's why we date all of our resources and reserves, because we want the assumptions to be set at a certain date. For reserves, it's much more critical because we don't have potential. We disseminate, our declaration says at this date, we can justify that it's technically and economically feasible to mine. And that's why we date them accordingly. I briefly mentioned reference point earlier, and a reference point, what we do is particularly for reserves, well, it is for reserves because resources we would declare as in situ. Reserves, we want to define at what point we are reporting. For precious metals, precious and base metals, we tend to report what I said, head grade. So the feed to a plant in tons and grade, although all the costing would include all aspects of the metallurgical process and all the costing and all the marketing and transport and everything that gets the metal sold. So the reference point typically for that is shaft head. For industrial minerals, coal and bulk commodities, it can be at different points. So it might be at the gate. So it's sold at the gate. It might well be that a particular deposit has a number of products and that each one would have a different specification. So then those specifications need to be highlighted. So for instance, coal, you might by a screening be able to produce metallurgical coal and a thermal coal product. And then that would be then decided where it goes. For many bulk commodities, there may or may not be processing. So it might be sold as is, or at the port, or even at where it is consumed. So the important point is the reference point needs to be clear in where that point is, so that the person reading it can understand exactly where it is. Important aspect is a mineral reserve requires that a pre-feasibility study or feasibility study is done for a project, or where we're looking at a mine, a life of mine plan has been undertaken. And a life of mine plan, in most cases, we're really talking about a life of mine plan without significant capital. So if a new shaft is required, it would be advisable to do a feasibility study, even if it's on an existing mine. Inclusive and exclusive resources. So when we report resources and reserves, we need to say whether the resource is reported inclusive or exclusive of the reserve. So if this red area is the resource, and we're reporting the reserve as inclusive, then the whole area under red, even though we've got the blue, would be reported. So the whole red area would be reported as resource, and the blue area would be reported as reserve. If we're doing exclusive, then only the area outside of the blue area, as we see it now visible, would then be recorded under resource. Interestingly enough, the reporting standard for the United States, SK 1300, only allows exclusive reporting. So in this case, you can see the blue would be the mine area, and that would be part of the reserve. So that would be reserve, and for exclusive, only the red that we see would be reported as resource. These are some examples. So you can see that the where the mineral reserves are reported exclusive of mineral resources. So the resources are reported on the left, and you can see where it's exclusive, the tonnage of the resources is much less. Further down, you'll see at where it's inclusive, the tonnage is much bigger, and that indicates that the difference in the reporting. And there are merits for both ways of doing it. I'm not going to try and justify each which is better, because, as I say, it depends on the situation. As we said much earlier, the codes are there to help with valuation, and it's important to understand that our work, or the work from SAMREC, or from reporting of resources and reserves, will go into valuation. So typically inferred mineral resources would use the multiple of exploration expense as there, and market comparisons. As we go from indicated to measured, we would then go into DCFs, discounted cash flows. And in fact, you probably when you're going you will when you're doing declaring a reserve, you would certainly be looking to use a discounted cash flow to demonstrate the viability. And for valuation, you would then also use comparative methods, market methods to do a valuation. Now, just some of the aspects that are a little bit outside of the norm. So industrial minerals are also can be reported under a SAMREC code. There are a huge number of them, and they all have their own specialities. One needs to be talking to the right people to make sure we do it properly. So in many cases, these are defined by a specification. For instance, aggregates are defined by not only by shape, by size, but also by shape. The different other industrial minerals also have specifications for which they need to be reported. So all the aspects that are in the code apply to industrial minerals, but there are some specifics. So the key principles of the SAMREC code apply, and it may be that assays are not relevant, but some sort of quality criteria is applicable. And in many cases, deleterious minerals or physical properties are important. So for instance, in bauxite, the content of iron and silica are important for reporting. So those are aspects that one needs to know, and that's why experience is important when reporting. So the likely product specifications are important, and there must be a saleable product that would be important here. Multiple products are expected in many cases when you're talking about industrial minerals, and as I said earlier, each of these needs to be put in some sort of way to make sure that it's understood what is being reported. Metal equivalents. So metal equivalents would be where you, for instance, have a copper deposit which has lead or zinc. So it's polymetallic, and one wants to report as equivalent of only the copper grade. So you want to take the lead and the zinc and make it equivalent to the copper grade. It needs to be done in a very transparent way. And the important aspects here is that the three things that are important: the grade of all the individual metals needs to be known, the recoveries of each of those through the designated plant, as well as the price of each needs to be incorporated. So it makes it a little bit more complicated. And then when reporting, the calculation needs to be shown so that the reader can be aware of what that is, how that's going to work. So still all the principles apply, must have reasonable potential to be recovered and sold. The one to which it's reported should be the one that has the most contribution to the in the deposit. The metallurgical recoveries or yields are important. So you need the grade, the recovery, and the value, the sale value. So if you don't have all of those, one shouldn't be reporting metal equivalents. As I said earlier, we have guidance in the form of a table of contents at the back of the code, which does help. We have an appendix that is has a suggested competent person certificate, which is very useful, and that's always good that that's put in at the end of a document to demonstrate the viability. And just before I do questions, one of the things that I haven't mentioned is the if not, why not statement. So at the back of the code, we have table 1, and table 1 has an extensive list of all the aspects of the code that should be reported as minimum standards. And we require that the reporting is done on if not, why not basis, which means that you go through the table 1, and where you have the information, you record, and what we suggest is recording the paragraph number in your report. And if you haven't got it, for instance, if you haven't done site visit, then you put in there why you haven't. So that gives the investor, it helps with the transparency and materiality. And it also is important, well, I've certainly found that incredibly useful to go through table 1 to see when, what aspects I might not have done. And there's some ones that catch people out really quite easily. The survey, making sure that the survey coordinates are all done on the same basis. So there are quite a few of those. And the important aspect here is that the codes are reported when it's mandatory to do, if not, why not, when we're doing a maiden announcement or where there's a significant change to a material project. So the first time it is done, that's important that if not, why not is done and published with the report. And where if a company has a number of projects and one of them, which is an important project, has a material change, that is also another trigger for if not, why not to be reported. Okay, I think that's the what I've prepared. I think we've got quite a lot of time left. So are there any questions?
Joseph, yes, you have a question?
Yes, thanks a lot, Ken, for your presentation. I appreciate it. I've got 2 or 3 questions. I think the first one is around the CRISCO, I think, membership that the SAMREC team have. I just wanted to find out, when you guys convene or have conferences, obviously there are some key learnings that come out of that. How are those translated back as ways of continuous improvement to us? Does that just come through an update of SAMREC, or is it just something that sits just with the committee, the SSC, in this regard?
Okay, so Joseph, the CRISCO meets every year, and each of the 14 countries has 2 representatives on the CRISCO committee. And so their job is to present to CRISCO what is happening at the individual codes, and also to report back to their parent organization about what's the developments that are happening elsewhere in the world. So, for instance, aspects that we at SAMREC are watching with real interest is that JORC is in the process of doing an update of its code at the moment. And one of the aspects that they've been asked by the ASIC, which is the Australian Securities Commission, to look at really carefully is the definition of a competent person. So we are watching with have a watching brief to see what's going to happen, and we're in contact with them all the time, and the people in the SAMREC committee and SSC are updated on a regular basis on those developments. And where those developments are relevant, they will then be brought into a potential update of the code. An update of the code is a substantial work. So the last one took about 4 years. Australia's busy with theirs at the moment, and they have been busy for now, I think, just over 3 years. And part of it is that although the work is done by volunteers, and it has to go through some regulatory steps. So, for instance, SAMREC code goes to the JSE and goes to the Financial Services Board, and actually gets a note gets published in the Government Gazette when it gets updated. So these are really significant bits of work that are done. So what we do is we watch, we liaise with our counterparts from the other codes to ensure that we are up to speed with what they're doing, and if necessary, we would incorporate that in a revised version when we do one. For the SAMREC code, it's probably soon we'll have to look at a revision, seeing as how we now 7 years since we did an update. So it's probably a good time to do it, but we're also watching some other things in the international space before we actually start that.
Then the second part is that as sort of SAMREC is custodian of the code itself, how does it play a role in ensuring, for example, compliance, or do you guys sample a bit of the reports that are published just to make sure how, you know, the people that subscribe to it are complying to what's written in the code, or that does not happen at all?
So we're reliant on people who have reviewed reports to advise us that a report is substandard, and and then there's a complaints procedure where that happens. As I said earlier, it's not done anywhere near often enough. I'd love to say that we have a large number of people who review reports and can help to improve the standard. But having said that, the readers panel has done a fantastic job, because all of the reports that for the public domain go through the readers panel for the JSE, and they also review a selection of annual reports every year. So the standard of reporting has improved over time, but there are still certainly poor performers. The Canadians have done sampled a few reports, and they have found that about 20% of reports are fully compliant, about 40% are virtually compliant, so there are some small aspects, and then there are 40% that are not compliant, and then obviously they take action. But we haven't had the resources to do that sort of study here, so we're fundamentally reliant on complaints, which is probably something we should try and address.
The 6-month validity of a report.
Yes.
Okay, so if a company has and it's just a resource report, and it was done a few years ago, I don't know, let's call it 5 years ago, yet they are a listed company, so they need to keep including that resource estimate within their annual reporting. Now, if a report is only valid for 6 months, every year they would just have to change the dates, because I mean, nothing's changed. Obviously, there's no drilling, the report is still valid, the resources are still valid. In terms of your cutoffs, won't have changed. It's only resources.
Not necessarily, Catherine. So it's a tough one, that one. So where a resource is done and it's reported on a regular basis, the 6 months is actually for transactions. So when a transaction happens, everything must be within 6 months. But for annual reporting, there are certainly circumstances where the reporting is quite a long way out of date. And yes, if there's been no drilling or no other work that's been done, that can justify that the resource should be unchanged. However, if substantial changes to the economic environment have changed, a resource may well either no longer be potentially viable, or they might be actually more viable than it was before. So
sure. And as the CP, it would be your responsibility to go through the reports, pay special attention to the cutoffs as stated. Are they still relevant? Would they still be applied, today, etc.? And yes, assuming they're all still valid, etc., you would still be able to include those without going back to the original person, and updating that report.
Correct.
That's great. That's what I wanted clarity on.
So, and that's the competent person's call would be that.
Yes,
so yes,
absolutely.
So if the company says they're too lazy to go and ask the competent person, they're actually not doing themselves. They're doing themselves a disservice.
I don't think it's ever laziness as it is more than they don't want to spend money, because they know that to get a report reissued, it's never just a signature and a date change. It's, So
yeah. I think let me tell you an interesting story that I've had. So I had a situation where it was for Canada, and I got contacted by the company, and we'd done a resource for them a number of years before. And they phoned me and said, please reissue the report today with the change of date. And for some reason, I was suspicious. I never quite worked out why. So then I went and looked on their website and found out. And I said to them, no, I'm not going to do that, because you're mining, you've mined, it would be 5%, more than 5% different. And they gave me a lot of grief about it. And I found out subsequently someone else had done a resource report, and they were too lazy to include that. And also in Canada, they have an interesting one that there's a time period of 30 days between when you declare a resource and when you have to have it fully documented in the public domain. So I think there are lots of times when companies they don't want to go to the trouble and cost and effort to actually have it reissued when they should.
Definitely. It's just difficult sometimes as a CP to justify to your clients why they need to do certain things, and it's just always a battle.
Yeah.
But thank you.
Mr. Kat?
Oh, hi.
Miss Katz.
Yes. I just have a follow-up question. My question is like in relation to what Catherine was asking about. So now, say you don't wanna just change the date every year on that on those resources that were reported by a company or an asset that was acquired. So what if you don't have raw data, for that specific operation, and you haven't conducted any new exploration? So is it justifiable that until you do get new information, you continue just changing, the date every year, since there's no production or no activity happening on that asset?
So certainly, if there's no technical change, so there's no new data, all of that, then it can be justified that there is no change to the tons and grade. The only change that would really be something to be aware of are the non-technical aspects. So economic aspects. So if the metal or the commodity that's if the price has changed significantly, and it can change both ways. So if the price has gone higher, then the resource might be more. If the price has gone lower, the resource may no longer exist. So that's the one. And also there may well be situations where legal or other commercial aspects have changed. For instance, a environmental area might have been declared a World Heritage Site or something like that. So those are things that one would have to be careful about, that although the technical stuff is unchanged, there may be factors outside of the technical that would have to be considered before one just changes the date.
Leslie has over 35 years experience in all aspects of coal geology, ranging from greenfields exploration, feasibility, due diligence studies, competent persons reports on various operating collieries, South Africa, Botswana, and Mozambique. She is a committee member for the SANS 10320 code, and she's a competent person with respect to coal resource estimation on the Johannesburg Stock Exchange. So Leslie, if you will go ahead.
Great. Okay. Just a quick comment. I was on the committee for SANS 10320 with the introduction of the second edition. The committee doesn't meet anymore, and I suppose if anybody wants to revise it a third time, we would reconvene. But at the moment, there's no call for that. However, let's get going. How do we report coal resources in South Africa? Well, almost exactly the same as you report any other commodity. So we follow Crisco's three main principles: materiality, transparency, and competency. We report according to the SAMREC code. Clauses 48 to 59 apply specifically to coal, and we include table 1 in our reporting. And in fact, clause 49 specifically says that you must consider SANS 10320 and the 2020 edition, which is the second edition. So what is SANS 10320? It's a South African national standard. The first edition was published in 2004 after the coal industry actually requested a standard that gave one guidelines on how to estimate and report coal resources and reserves. The current edition, the effective date was back on the 1st of January 2021 and is published by Standards South Africa, which is a division of SABS. It gives us the standards, the definitions, and the common terminology for public reporting according to the SAMREC code. And it details how you evaluate your coal resources and your coal reserves so that your results can be understood with reliability and confidence. It also gives you methodologies that should be considered when you prepare your public reports. Now, you must use 10320 in its entirety. You can't just pick bits and pieces that suit you and ignore the rest. And if not, why not also applies. If you haven't done it, explain why you haven't done it. And it lets you know that the reader appreciates that you've considered something, and hopefully you've considered something sensibly. And if you have a question about something, sure as nuts, the reader's going to have a question as well. So put in a sentence and explain it. And a little digression here into the English language, a word called shall. Most of us understand the meaning of shall as, you know, oh, I'll go and do it sometime. Actually, the true meaning of shall is must. So when the national standard says that something shall be done this way, you're not allowed to do it any other way. You have to do it that way. So just bear that in mind. So what is a coal resource? It's coal of economic interest in or on the Earth's crust in such form, quality, and quantity that they are reasonable prospects for eventual economic extraction, just the same as for minerals. The RPEEE, it's that part of your coal resource for which there are reasonable expectations that you will be able to mine it. You will be able to produce a product, and in coal we have two types of product, either an in situ product, which we often refer to as a raw product, or beneficiated raw, a beneficiated saleable product. to look at your RPEEE, there's a couple of things you've got to consider on a physical point of view: your true seam thickness and the depth below surface, your potential mining method, your key coal quality parameters. If it's full of ash, nobody's going to buy it from you. If the sulfur is very high, nobody's going to want to use it anyway because of the potential for pollution. The theoretical product yield. If it's great coal, but you're only going to, once you've washed it, you're only going to get like a 10% yield, you're probably not going to make any money out of it. And what is your target product quality? What's your surface infrastructure around by your deposit? What are your natural and man-made features? And what is the time period over which this extraction is possible? And then touching on what Ken's just been talking about, what's the current price? What is the forecast for the price in the future? What are the economics of your coal industry at the time? There's something in coal that I don't think we have in other commodities, and that's called points of observation. We have two of them, two types, physical and quality. So a physical one, that's easy. It's a coordinated point in space plus the thickness. So a borehole collar would be a point of observation. The top of a coal seam would be a point of observation. If you add the thickness, then you've got a description of your entire coal seam at a particular point in space. A quality point of observation, you have two types again, either in situ, also known as raw, and washed coal. And you've got to consider those two independently, depending on what you expect to sell. So very quickly through your coal terminology, coal, it's for other commodities, you talk about mineral ore. A coal deposit is your mineralization. The roof of a coal seam is the same as a hanging wall, and the floor of the seam is the same as a footwall. The coal quality is equivalent to talking about the grade or your mineral content. And a coal processing modifying factor is exactly the same thing as a metallurgical modifying factor. Conversion factors, these are considerations that we take when we're doing a geological study to convert coal exploration results to either inventory coal, which is what company keeps record of but is not publicly reported, and or the coal resources. And these things are geological factors, things like coal quality, geotechnical characteristics of your deposit, things to do with mining, your coal quality, the coal processing, the local infrastructure, the economics, marketing, and so on. So it's very similar to modifying factors, but they can be more conceptual in nature. Something else that's very important for coal is your reporting basis. Your in-situ moisture and your in-situ density are the technically correct reporting bases for coal resource estimation. You can use other bases, but you must state what basis you are reporting on. Most commonly in South Africa, and to be quite honest around the world, is air-dried basis, simply because that is the basis that we do most of our analysis on. It does give you a slight variation in your final tonnage estimate, and you need to take that into consideration. Your in-situ density, also called your raw density, is the adjusted density as you derive from the laboratory determined relative density, which is either true or apparent, and it's adjusted from the as analyzed moisture content to the equivalent in-situ bed moisture, and you use the Preston-Sanders formula to change the base, to determine your change of moisture basis. That sounds like a huge mouthful. And currently there's little in-situ moisture data available in South Africa, simply because, as I've said, air-dried is the most common reporting, analytical and reporting basis. I think the difference in tonnage for most bituminous thermal coals in South Africa is around about 2%. Okay, so coal has what we call deposit types. Two have been defined in South Africa. The first one on the left is called a multiple seam coal deposit type, and that's your standard coal types in South Africa. So if you think Witbank type coals, that's what that example is there, where you've got your one seam down at the bottom and it goes up to your 5 seam at the top. The seams are relatively thin, they're a few meters in thickness, and they're separated by sandstones or shale that are many times thicker than the seams are thick. That's kind of our standard coal deposit type. The raw ash content, so the in situ ash content, is usually less than 50%. Now contrast that with the Waterberg type deposit, which, as you can see from the diagram, the common name of the barcode deposit is very descriptive. And here you've got very thin bands of coal, they're sort of decimeter thickness, interbedded with thin bands of mudstone of very similar thickness. And that entire package can be up to 70, 80 meters thick. The in situ ash content is also much higher, simply because there's so much mudstone in it, but it's usually less than 65% ash in the raw state. So examples of this, as I mentioned, the Waterberg coalfield, particularly zones 5 to 11, also known as the upper sequence, and parts of the Soutpansberg coalfield. So the lower part of both the Soutpansberg and the Waterberg coalfields are more the multiple seam deposit type, so the example on the left, while the upper parts are more like the diagram on the right. So it's important to have that distinction because we estimate our resources slightly differently depending which coalfield you're in. So in South Africa, in coal, we tend to use drill hole spacing as a proxy for data density, and we use it in conjunction with all the other geological data that geologists regularly use. So things like mapping and remote sensing and geophysics and trenching and channel samples and all the rest. What we've done in South Africa is we've set some minimum borehole spacing in order to classify our resources into the usual categories of inferred, indicated, and measured. And they differ depending on your coal seam deposit type. So on the left, we've got the multiple coal seam deposit type and the thick interbedded on the right. So you will see that the spacing for the multiple seam is significantly less than the spacing for the thick interbedded seam. And that is simply because the thick interbedded seam is a lot more regular. Okay. I've given it to you there in terms of spacing between drill holes as well as the data density spacing. So for example, multiple seam measured, it's less than or equal to 350 meters between borehole collars, or 8 drill holes per 100 hectares. Okay, and the diagrams below just represent the difference in spacing for you. Now, that's all well and good if your coal field or your coal deposit stretches on forever and nothing changes. There's no faulting, there's no dolerites, there's no washouts, there's no paleo highs. It's as flat and boring as the countryside between Landsberg and Beaufort West. Then you can rely on those kind of distances and densities. However, the moment you've got things like faults and dolerite intrusions and washouts, then you've got to increase your data density to make sure that you cover all changes in your deposit so that you don't overestimate your continuity of your deposit. Here's something else to take into consideration. On the left, I've got a drawing showing where your boreholes are drilled. So the little white dots represent your borehole collars, and the circles around them are circles of influence representing your measured, indicated, and inferred areas. And I'm just using multiple seam deposit type as an example here. So we've got lots of, it kind of looks like caviar in a way. We've got lots of black circles surrounded by a slightly darker gray, and then a bigger area surrounded by the lighter gray. Up at the top towards the right-hand side, there's a line that says limit of coal deposit. And just north of that, there's a drill hole that didn't intersect any coal. Over towards the northwest, we've got one borehole out by itself. And then down towards the southwest, we've got 3 boreholes in a line. So when we work out the area that we could report resources for, we ignore the isolated borehole because we have no continuity between that borehole and the cluster of boreholes just to its southeast. We also ignore the 3 boreholes in a straight line just to the southwest. We need boreholes that are in a triangle to actually get an area. And there's no continuity either between those 3 boreholes and our cluster of boreholes to the northeast of them. We also ignore the drill hole that didn't intersect coal. And we chop our area off along the limit of the coal deposit. Well, that's pretty obvious. You know, we know there's no coal there, so we can't include that area at all. Please note that what I'm saying is we ignore these boreholes for the area of coal resource reporting. We do not ignore them for coal deposit modeling. They are very important to tie down the extremities of our model. So their data, even if a hole does not intersect coal, it's very important that we know that there is no coal there, but we don't use it for when we're reporting the resources. This slide, it looks terribly busy, but what I've basically done is summarized for the 2 deposit types, multiple on the left and thick interbedded on the right, all the various parameters that you need to take into consideration when you're classifying your resources. How many cored boreholes do you need to, for example, have an indicated resource in a thick interbedded seam deposit type? Well, it's 1 cored borehole in 100 hectares. Why do I say cored as opposed to something like percussion? Well, we need cored boreholes so that we can get reliable samples, so that the analyses we need to do, and we need to do a whole bunch of them, there's usually about 7 or 8 that we need to do as a minimum on each sample to get a reliable coal resource estimate out, to get our quality data. And we don't get that with percussion holes. So the definition is you have to have a cored borehole. You also need a certain minimum sample weight for different analyses. So you need to work out the thickness of your borehole dependent on the thickness of the seam, or the diameter of your borehole, sorry, compared with the thickness of your seam, so that you have sufficient sample weight to do all the analyses that you require on a per seam basis. What else do you need to consider? Well, your seam thickness cutoff. So there's a minimum cutoff that defines a coal seam. That's 50 centimeters. Anything below 50 centimeters is not a coal seam. However, you're going to put cutoffs depending on the kind of machinery that you envisage using to exploit this deposit. And those cutoffs are going, or the machinery is going to be dependent on the type of mining you envisage. That's going to be dependent on the depth. Are you looking at open cast? Are you looking at underground? Are you looking at CMs, or are you looking at some other equipment? So that's where your minimum and maximum seam cutoffs come into account. First step, you will use your full seam thickness above your minimum cutoff. You're also going to apply quality cutoffs. Ash is the first thing you're going to think about. Most applications for coal only take coal with quality of a limited ash value. You're also going to look at the volatiles that you've got. You're going to look at things like the sulfur content and sometimes some other chemical things like the phosphorus. You're going to make sure that your conditions for RPEEE are met. You're going to look at the confidence that you have in both your physical and quality data, and you're going to look at the continuity in both the physical and the quality data. Have you assumed the physical quality? Well, continuity. If so, you've only got an inferred resource. However, if you can confirm the continuity, well, then you're looking at indicated or measured. Just a note, if you have an inferred resource, you have to preface your number by the word approximately. Then there's a whole lot of things about significant figures for your tonnage estimates, depending on what type of a resource you've got, inferred, indicated, measured, and the size of that resource. And that is done so that you don't mislead the reader, so that he is of the opinion that you know a lot more about your resource than you actually do. And then right at the bottom, can you use this resource to support a pre-feasibility or a feasibility study? So inferred, no, you can't use a resource for that. But indicated and measured, both of those resources can be used to then support a feasibility study or a pre-feasibility study. And just a word of caution, if you think back to the earlier slide, your drill holes must be relatively evenly spaced over the area of consideration. Don't have a situation where your drill holes are all over on one side of the property and your estimated resources for the entire property. That's just dishonest. Okay, this slide just summarizes our coal resources. So it's traffic light colors. So where it's green, that's good. Where it's bright orange, that's not so good. You need to do some more work. So the lowest matching criteria determines the appropriate classification of your resource. Your confidence is low. You don't have much confidence in the integrity of your data. You've had to assume your seam geometry and the structure. And this is all going down to, well, probably I've got very few drill holes, very little mapping and that sort of thing. You don't know much about the quality of the coal, whether it's the in situ or the washability. You've got an inferred resource. The more you work you do on your deposit, obviously, the more you know about it, and the more likely you are to be able to upgrade your resource to either indicated or measured. And a word of warning, when you report a coal resource, the quality that you report depends on the type of product you intend to sell. If you intend to sell the coal as it is, as it comes out the ground, in other words, a raw or in situ coal product, that's the only analysis you need to do. However, if you're going to beneficiate this coal because you want to export it to Japan and they only want really top quality stuff, you have to have done the washability analysis, which takes a whole lot more sample mass. So you've got to take bigger samples and you've got to have done all that washability and you've got to report that quality as well. Okay, now what can I report when I've gone through all these motions, done all these sums? I'm going to end up gross tons in situ for the full seam thickness. Am I allowed to report that in the public? No, I'm not. I've then got to apply my geological loss factors, which gives me my total tons in situ, and I still can't apply that, report that. The next thing I have to do is work out my mineable tons in situ. And to do that, I take my theoretical mining seam thickness, and that's based on the equipment that you want to use. Okay, I'm going to use a CM, but it can only take a 3.8 meter cutoff. So then you're going to decide where you're going to mine. Are you going to mine from the floor up 3.8 meters? You're going to take that slice of coal, you're going to use your samples and figure out what the quality is for that band, and you're going to apply that to your resource estimate. You're going to have applied your geological loss factors, any depth cutoffs, any strip ratio cutoffs, if that applies in open cast. You apply all those loss factors to your GTIS, and that will give you an MTIS number, and that is what you can report publicly. And that is what your mining engineer is going to use when he starts working out his reserves. So you're going to apply both minimum and maximum seam thickness cutoff. Just bear in mind, usually with open cast, yes, you're going to apply a minimum cutoff, but your maximum 9 times out of 10 is going to be the full seam thickness. So you're not going to leave anything behind once you start mining. You might only start mining where the seam's a meter thick, but you will take everything after that. The theoretical mining height is either the full height of the coal seam if it's open cast, or it's your optimal selected part of the coal seam, which is for an underground situation. It includes any defined internal parting material that is non-coal, so a sandstone band or mudstone or something like that, that you have been able to identify in your logs and correlate, okay? But it doesn't include any external planned dilution. The theoretical product yield is a laboratory estimate. So when you go and you do all your analyses and you do your washability, they will come back and say, well, you know, at a density of 1.65, you're going to be able to get, let's say, 75% of your coal mass is going to meet your target products. That's a theoretical product yield. There is another product yield called your practical product yield that comes out of the coal processing plant, and you must not muddle those two product yields up, and you need to state, when you state your resources, what your theoretical product yield is. It's a density separation yield, as well as the size separation yield, and sometimes it's both of them. And usually, as I say, it's dependent on either your quality or cut point density, and 9 times out of 10 it's density, because that's how coal washability plants work. They don't say, oh, I'll produce you a 26.375 CV coal. They say, I'm going to cut at 1.6 density. In a big box in red there, I've said the public reporting of coal resources must be on an MTIS basis only. And you've got to state your reporting basis, so that's your moisture content, so it's air dried, you state what the moisture content is, what the yield is, what the coal quality is for each and every line entry, plus your tonnage. So they tend to be quite big, complex tables. You can't state a measured and an indicated resource as one number unless you also state them as separate numbers. When you state them as a combined number, just remember that you need to state all the qualities and everything as this red box above, and you've got to state them as a weighted average. Okay, this diagram just shows you how we move from exploration results and inventory coal on the left of the diagram, which may not be publicly reported, into the public reporting space on the right, which is surrounded by the red box. Okay, this is the diagram that is in SANS 10320, and I'm sure you all recognize this sort of thing where you go from, okay, so inventory coal is maybe a little bit different. Reconnaissance does not apply in public reporting at all. It's only something that countries are allowed to, companies, sorry, are allowed to whisper about amongst their own staff and not to anybody else. Once you get into public reporting, it's exploration results, and all you can say is, I drilled X number of boreholes, they were so deep, I intersected coal of X amount of thickness with this kind of qualities. You may not say how many tons you might think are there. You're not allowed to do that. Once you get to coal resources, then you can start talking about tonnages. And you all know this diagram. It's exactly the same as for all other commodities. We just put the words coal resources and coal reserves up on the top. Works exactly the same way. Okay, so now we move on to coal reserve reporting. Again, just like with other commodities, we use modifying factors to convert from a resource to a reserve. And we usually do this in something like a PFS or an FS. And we look at the same things as we do for all other commodities. We also apply table 1, and we consider all those modifying factors individually. And we justify them. If not, why not? Okay. Again, a coal reserve, it's an economically mineable part of a measured and or an indicated coal reserve, coal resource. So if it's measured, we get to approved reserve, and if it's indicated, it's probable. Sometimes measured can be probable as well. We include dilution and contamination, and we allow for losses that may occur when your material is mined or processed. And we define it by studies at PFS or feasibility level as appropriate. And we include all our modifying factors, and we shall demonstrate. Remember, shall is you have to do this on pain of death. And we show that we can reasonably justify our extraction. Okay, so I've tried to do a similar little diagram here as what I did for resources, and it was so much easier because there's only 2 categories, and it doesn't matter what deposit type you have. It all works exactly the same way. The starting point is an MTIS coal resource, okay? And you can use either indicated for probable or and measured, or measured for proved. You include dilution, contamination, mining losses, and your moisture correction factors. So that's probably something that is fairly specific to coal. And to justify your RPEE, you either have to have a PFS as a minimum requirement for a project or a life of mine study for an operation. Your confidence in your modifying factors would be moderate in a probable reserve, but it would be high in approved reserve. and your confidence in your estimation would be similar, moderate and high. And yes, you can use them to support PFS, FS, and life of mine studies. Okay, similar to the resource slide, what am I allowed to publicly report? So go through the motions. We start with a little bit confusing mineable tons in situ reserve, which is at the theoretical mining height. We then do an MTIS reserve at the practical mining height. So there's the difference in the two mining heights. The first one, you include your layout losses, your depth cutoffs, your strip ratio cutoffs, whatever. The second one, you go your practical mining height, your dilution, and your maximum mining practical mining height cutoffs. You then get to your extractable tons in situ, where you put your layout extraction factors in, and none of those three categories may you report publicly. The only two that you may and shall report are your run of mine, which includes your contamination, your mining recovery efficiency factor, your run of mine moisture correction factor, and then your saleable reserves, which include your practical product yield. I mentioned this earlier. This is what comes in from your plant, and your saleable moisture correction factor. However, bear in mind that if you are selling a raw coal product, so you're not beneficiating it at all, those numbers could virtually be the same thing. 9 times out of 10, when you're selling a raw product, you do de-stone it, so your tonnage will go down a little bit. Again, in the red box, I'm just telling you that your reserves, you've got to report run of mine and saleable. You can't only report one and not the other. They both have to be there. And like with resources, you cannot report probable and proved as one number unless you've also reported them as separate numbers. And you should also report all the qualities that go along with that. And just a note at the bottom, you can no longer report an MTIS coal reserve. You used to be able to do that, but you may no longer do that. Okay, so just to say that you've got to have a mine plan with a specific mining method. You've got to know your
5 minutes, Leslie.
Okay, I'll be there. You've got to have your minimum, maximum mineable thickness, your coal quality cutoffs, you've got to apply. You've got to have your practical mining height. So either the full seam or the selection that you've got, and you've got to include any planned dilution in that. Your run of mine coal reserves, which are quoted as delivered, are a specific public reporting requirement, and you have to state what your contamination and your moisture correction factors are, because they make a difference to the tonnage. The more moisture you have in your coal, apparently the more tons you have. But because moisture takes energy to drive it off and you can't use it, you actually lose tons when you get rid of the moisture. So that's why you have to state things like that. Your practical product yield is your net yield of your target product. So at the end of the day, what is your client actually going to get from you? And this is all from your coal processing operations, and it's to do with your cut point density at a specific coal particle size range after applying all your coal processing discount factors, and preferably this is on an air dry basis. If your product is sold as raw or in situ, your yield is 100%. And your coal quality has got to be reported per product type. So if you exporting coal and then your middlings is going to Eskom, you've got to report those two separately. You can't report them as one. Okay. Or if you're selling some coking coal and then the balance is going to Eskom, you've got to report those two separately. So you've got to, and then last comment, you've got to include your run of mine and your saleable reserves and all their yield and their quality and their moisture. Whoops, sorry, that wasn't supposed to happen. And I have no idea what happened to that. The last slide, what it actually says, I'm going to stop sharing, is that the SANS 10320 is not a free document like the other SAM codes are. It is available for purchase from SABS. So please contact them and buy it. I don't know what the price is at the moment. I think it's about R1,000, and you get your own copy with your own name on it. So please don't plagiarize it. A lot of time and effort went into developing this thing. So thank you very much.
And with us this morning, we have Hannes Bormann, who has some 40-odd years experience in the mineral industry, in both production and contracting environments, and as well as hard rock mining in various South African gold and platinum mines. His broad experience is in feasibility and due diligence studies in South Africa as well as internationally, also in Central Asia and the various Russian republics. Hannes is also a director of Pivot Mining Consultants, and he's going to talk to us now about resource, or rather reserve issues, as well as technical studies within the SAMREC code. So Hannes, over to you. Just let me know when you want to break.
All right, I will do that, Tanya. Good morning, everybody. As Tanya said, my name is Hannes Bormann, and I've had the good fortune of running around the world paid by my clients. So that's quite nice for me. This morning we're talking about technical studies and reserves in the SAMREC context. And instead of having a PowerPoint presentation, I'm going to walk you through Table 1, SAMREC Table 1, in terms of what is the requirements for a competent business report or a technical study or whatever. And then we will take it from there. When you do a study, and one of the important things is, okay, the technical studies is now not applicable to exploration results, but when you do mineral resources and mineral reserves, you must always study always state what the level is. Is it the scoping, pre-feas, feasibility study? The Canadians talk about PEAs, which is preliminary economic assessments, etc., etc. So your reader must know at what level the study is done. You must, and I think other speakers have reiterated or spoken about, that you can only declare a reserve once you've done a pre-feasibility, at least a pre-feasibility study, or a life of mine study. So you cannot declare a reserve based on a scoping study or a PEA. That is not sufficient. That is that point. And what is also important in that people use modifying factors often in a study, but they don't put it in one place where the transparency can be seen. What exactly are the modifying factors that you've applied to move your resource to your reserve? In other words, what dilution, what geological losses, what mining losses, constraints, like on a coal mine, for instance, you won't mine a seam that's thinner than 0.5 meter, or there's a wetland or something that prevents you from mining in that area. So any and all modifying factors, and I think people had spoken to you about that, I'm not going to repeat it, must be in a table where your reader can see it and have a context in which you have done your reserve transition from a resource or your reserve declaration. So you must also say, how are you going to mine this? So, you know, it's on your mineral resource, you have to give an eventual economic, or the chances of eventual economic extraction. So that's a sort of a mini valuation that you're doing to say, I can declare resource because there is an eventual economic extraction. It doesn't have to be now, but I'm sure other people have elaborated on that. And if you don't, then you must state why you haven't spoken about it. And it's that, if not, why not principle that comes to play. So you also, on the modifier factors and assumptions, your mining methods that you're going to use, your minimum mining dimensions or pit shell, internal, and if applicable, external mining dilutions. Oftentimes people talk about dilution, but you're not sure whether it's included in your economic horizon that you're mining or is sitting outside. So once again, for transparency, you have to specify where the dilution is lying. You can't just say 5% dilution or 8% if you haven't specified it, so that your reader can understand where you're coming from. Your mine design criteria is very important. I mean, what that means is, for instance, what do you assume is your development rate going to be on a flat end, in a crosscut, in a raise, in the stope? How many meters per month do you think you're going to mine or centaurs in your design that you are putting into this thing? And, you know, so that people can understand what your thinking is about it. And at the end of the day, they have to make up their own minds on whether they're going to accept your parameters that you've put in or not. And does it make sense? I mean, to put, say, 100 meters development in a raise with conventional mining, how are you going to do that? It's not possible. So you'll discard that. You have to talk about the infrastructure that you're going to put there, because any mine will need infrastructure. Are there roads that you have to upgrade? In a pit, what's your mine haul roads? What's your buildings? Are the buildings sufficient? Do you have washing facilities, and are they sufficient for the amount of people that you have employing on the mine? So all these things you have to put in. If you say you're going to mine 80,000 tons a month from underground, your machinery that you've got in place to mine there, and this is now a mechanized mine or whatever, can you do what you say you're going to do? So in the end, what it comes down to is your study must be congruent. In other words, what you say you want to achieve, can your machinery, your infrastructure, your power, your water, your everything, can it do that? And can your plant process that? You know, so what you must do, a lot of people are doing what we call paper mining. You design a mine and you look at it, and then a client looks at this design and says, yeah, you know, we've designed 80,000 tons a month, but can't we do 100,000? You know, just push it for me to 100, because the numbers look better. And you can't do it because now you've got a step change. Maybe you have to have other machinery or whatever. So it must be congruent. Mining efficiencies. In other words, you cannot say, for instance, I will have 100% of my vehicles 100% available of the time. Because there are things like breakdowns, shift changeovers. You have to service the truck or whatever equipment you have got. So you've got a percentage availability and a percentage utilization, and you multiply the two. So you've got an 80% utilization and an 80% availability. Then you've got a 64% utilization, or that you can use this machine. And you must work that into your numbers. Grade control, how are you going to do it? You must specify that in your study. Geotechnical, English being my third language, geohydrological consideration, closure plans. That's something that's swept under the carpet quite often. You know, we'll deal with that later on, and they thumbsuck a number. You must actually be able to quantify how did you get to that number. And then, of course, your personnel requirements. And one thing that people often miss with personnel requirements, they say, well, I've got so many shifts, so many people, and they have got so many equipment, so equipment and people times shifts, I'll have so many people. What they forget is two things. One of it is, what about the people going on leave? So you always have to have say 10% more people or 12% more people, because people are going for a month on leave. So you have to cater for that. You have to cater for people that's on sick leave. So always build that into your model as well, so that you do not fall in the trap of just putting the minimum required people that's got to be in there. One thing is important is, if you've worked on a mine, you will know that building up to the mine planning for the year ahead, for the life of mine, you go through iterations with your resource plan or your resource statement. And you add and subtract and carry on and look at the plan, and you say, maybe we should do this or that and so on. And then when you do the reserve, you must make sure that you've got the correct resource plan to convert to a reserve. Often we find that when you do a due diligence on a mine's competent persons report, that the resource that's being used, or the version of the resource that's being used, doesn't tie up with the resource that was actually declared in the end. So you must, that's why you have to state, what is the name of that file that you've used, so that people can make sure that the correct one has been used. Because if your geology is wrong, everything else is wrong. So you must then also, the cut-off grade that you get to your reserve is quite important. And you must be quite clear how you got to that. What are the parameters and so forth to get to the reserves that you want. And often, and especially, you get to mines that's got a copper gold mine, for instance, and then they talk about copper equivalents. They convert the gold to copper, depending on which one carries the most weight. You've got copper equivalents or gold equivalents, where the conversion has taken place, and hopefully everything will be smelling like roses. So if you use quality parameters, like equivalence. You must be very sure in your mind that that is done correctly to get you your cut-off grade. If you use the wrong ones, you will either leave ore behind or you'll mine waste as ore. And it's very important to this one. So if you go in and, like for instance, on the platinum mines or gold mines, or say the platinum mines, and you go in with a conventional mining method, or you go in with a semi-mechanized or mechanized method, room and pillar method, then you must be able to describe and justify why you have gone in with that. Why have you gone in with a semi-mechanized or a mechanized methodology where you've got a lot of dilution rather than a conventional method with less dilution? But of course, your mechanized methodology can give you more tonnage. So it's a play-off between cost and benefit that you get, cost-benefit play-off that you do that. So you must explain in your study that. On open pit mines, of course, what is important is pit slopes, slope stability, and strip ratios. And all these things play a role, well, on number one, on safety. You do not want a slope failure on top of a lot of people. That close your mind down. So you have to do a lot of geotechnical work. And I have seen so many studies that they call a definitive feasibility study, or that other misnomer, bankable study. Do not use bankable, please. Only the banks can decide whether it's bankable or not. It's a definitive feasibility study. It's your final study. So the people come in and say, oh, yeah, we've done everything to a definitive feasibility study, but we must still do some geotechnical drilling, because that's the last thing that they want to do. And then you say to them, it's not a definitive feasibility study because you do not know what your slope angles are. You do not know your rock qualities. You do not know at what angles you can go in. You can kill people in the process. So that plays a role, and with it goes water. You can have, if you've got a dry slope, you can have a steeper angles, pit slope angle. But if there's water involved, then you have to be more conservative or mine it in a different way. So be sure that you have done your homework on this. And then strip ratios, of course, people would like to have the lowest strip ratio. Your client will pressure you to come in with the low strip ratio. But safety. You cannot compromise on that. So for underground mines, you have to include a discussion on the mining method. Once again, are you going to do room and pillar? Are you going to do conventional? Are you going to do a combination of it? What methods are you going to use? And do these methods, what is the industry norm? I mean, if somebody tells me he's going to move a stope on a conventional way, 25 meters a month, then I say, give me your socks so I can smoke it as well. You have to discuss it, explain it, and say why you're using it. Is it economic? Is it technical reasons or what? You also have to bring in your geotechnical considerations, which is your pillar sizes, your regional pillar sizes, is it up dip, down dip, pressed mining, what are you going to do? And explain why you're doing it. The mine design characteristics, once again, what are your assumptions as far as development is concerned, as far as capacities of your conveyor belts are concerned, etc. Because are there any bottlenecks in the system or not? You mine more than your conveyor belt can handle, or there's a blockage in your conveyor belts going upstream. And then, of course, one of the last things people always think about are ventilation. And I've seen many studies that have been tripped up by ventilation. So get the ventilation guy in early in the study. Do not wait till the end and then bring him in. Bring him in early. It's going to save you time. It's going to save you money, so that he can help you. Maybe you'll have to blast bigger tunnels to handle the air that is necessary for the volume of mining that you need to do. And if you cannot blast bigger tunnels, then you have to reduce your production rate because of the ventilation that's available. And of course, ventilation is very, very expensive. Okay. Once again, a discussion on the mining rate. How many centimeters per month? How many tons per month? How many cubic meters per month are you going to mine? The equipment selected, why you've done that. Are you going to use, say, for instance, on a mechanized mine underground, a 35 or a 25-ton truck? Are you going to drive it up the decline out of the mine, or are you going to use conveyor belts? What equipment are you going to use? The grade control methods. Are you going to do diamond drilling? Are you going to do face chipping to see what the grades are, etc.? Once again, your geotechnical and hydrogeological considerations underground. You have, for instance, on the platinum mines, where they mine both Merensky and UG2, on the older mines where they've mined out the Merensky, and then they come in and mine the UG2 below it. And you get, in some areas where the middlings between the Merensky and the UG2 is not that good. It's fairly narrow, and people haven't had indicated that they've mined out an area, but where they've actually left pillars, and then you can have falls of ground on the UG2 horizon, which sits below the Merensky. So you have to, on your geotechnical, you have to be very careful that you know what you're doing, and the size of the pillars and the regional pillars, and to work safely. And the hydrogeological consideration, how much pumping are you going to do? Is there underground water coming down dikes or something? Like, I don't know if you guys can remember, any of you, but in the 1980s, Driefontein mine, which was the highest grossing mine in South Africa, if not in the world, gold mine, was nearly closed down because they went into a water pocket. And John Foster, who was a prime minister, personally went underground to go and have a look-see, because Driefontein at that stage was one of the biggest contributors to the income of South Africa. Health and safety of the workforce is important. You cannot expose people to dust, smoke. One of the things that's been brought in, I think 2 years ago, was that no conveyor belt can be on the intake airway. Because if the conveyor belts starts burning, all that noxious gas goes back into the working areas where the people are, and they will be killed. And still today, I get people that has got conveyor belts in the intake airways. And you say, well, don't you guys read the law? But in any case, so make sure that you look after your people. And that goes for heat as well. I mean, heat stroke is a well-known health and safety issue that we have experienced in the mining industry. Staffing requirements I've touched on for making sure you've got sufficient people, taking consideration leave, sick leave, etc. Dilution, and making sure that people, one of the sources for dilution is overbreak and underbreak, of course. But then you also get people that, we've got a saying in the mine, you get what you pay for. So if you pay people tons or centares, they will give you tons or centares, whether it's ore or not. And they will go mine, especially where there's maybe pothole situations on the platinum mines. They will mine portions of the pothole just to get the centares or the tons out. And that gives you dilution that you haven't planned for. And then, of course, recovery. There's people always assume certain recoveries and so on, but you got to get that in a mine plan. You've got to make sure that the test work has been done properly, and you do not take the recoveries from other mines or what previously had happened and so on. So you must be careful. You must discuss it and say, how did you get to these recovery numbers that you've got in your plan? So if you've done optimization, in other words, you have just quickly done the mine plannings and so on, and you've made some broad assumptions going in, and then you say, but I can mine smarter than this. I can, maybe if I fix up my rails, I can transport the ore faster out of the mine, and I can mine then at a higher rate. Because mining, underground mining especially, is actually a civil engineering thing. You clean the face, you take the ore out. It's all about ore transport, or waste transport. And if there's a bottleneck there, then the rest is not going to work. You cannot blast the face that's full of rock. So you will do all sorts of things to speed up the mining, and that's optimization. And if you've done it, then you must discuss it so that the reader can see, but you've applied your mind to the design of this thing. Of course, like with anything, you must talk about the constraints that you are experiencing, practicality. I mean, you on a conventional mine, you cannot drill and blast 3 or 4 times throughout the whole mine, because you've got ventilation districts and so on. So there are practicalities that comes into place. You will often, one thing that you can do is to look at the mine and ask yourself, is this mine plant constrained or mining constrained? Because sometimes you cannot mine too fast because a plant can't handle. And if you have got huge stockpile sitting on surface, that's capital that you've expended. And you should not do that. So, because that's, you don't receive an income from the capital that you've expended, having huge stockpiles on surface. So if you've got plant constraint or mining constraint, so you must look at ways and means of taking constraints out. or what they out of the system, blockages or bottlenecks. And for instance, one of the things that you can do is to have better grinding media in your mills, that you can get a higher recovery, or in some cases, on the copper mines, you can have a dense medium separation that could take out the waste before the ore goes into the plant. So the plant can then process more ore. So these are the type of practical things that you can do. Access, if your shaft is too small, to put your people down, so that they can have sufficient time on the face to do your drill and blast every day, then you have to do something about that. Another thing, exposed mineral resource or reserves and stripped mineral reserves. What often happens, or happened in the past, and I think still happens, people never learn in the industry, is if the commodity prices go down, you have got, normally on a mine, you've got what they call a strip ratio. Now I'm talking underground and maybe, well, on surface as well. You have to strip or replacement ratio underground. A certain amount, underground, you have to do a certain amount of development for every centare that you are mining. Because if you don't do that, you'll fall behind on your available reserves that you can go and mine. So what you want to do is you want to have at least a year of available reserves, not resources, reserves. In other words, there's been opened up, that's been developed, it's lying there, you can go in and mine it. Now what management sometimes do when the commodity prices fall, they stop the development, because development is a cost. It doesn't give you income. Mining gives you income. And they hope for the commodity prices to pick up again quickly. Then a year down the line or 2 years down the line, all of a sudden you don't have face available anymore. And you have to expend a huge amount of capital to get the development back again. And you have to get the reserves available so you can mine at the rate that the shaft is designed for. It doesn't help you to have 100,000 tons a month shaft, but you can only do 60,000 tons a month out of it. Then you're not sweating your assets. And everything down the line, your fixed overhead stays the same, but you haven't got the income to cover that. So bottlenecks, draw control, you have to do on, for instance, on your diamond mines, or copper mines where you've got massive mining, to make sure that you do not pull waste, but only ore. So on the metallurgical and test work, on the mineral reserves, you have to discuss the source of the sample and the technique to obtain the sample, laboratory and metallurgical testing techniques. So what is this about? And I'm sure that they talked in the resource section about this. If you do a sampling, you want to have representative samples. You do not want a single hole high grade sample that you're putting through and you base your financial model on that. So you must say, what's the source of the sample? And the techniques to obtain it. Are you putting it through a riffle? Is it composite samples? How many samples were taken and so on? But that's been covered under the resources. And then what goes with it is your QA/QC. In other words, your quality control, your quality assurance. Quality control is at the drill. how did you get the samples? It's not contaminated. It's actually what it says it is. And in the laboratory, have they tested it correctly? You put in blanks and all sorts of things in there to make sure you get the, and then the metallurgical testing techniques. We have seen places where they put samples in, they grind it in a little ball mill, and then they take that and they test it. But they don't clean the ball mill before they put the next sample in. So you get contamination of the samples, and you get skewed results. So the metallurgical testing techniques must be stated, must be discussed. So the basis for assumptions or predictions required regarding metallurgical amenability and any preliminary mineralogical test work already carried out. So that's basically if they had done some work before and you are taking that work from maybe another company that had done work before, and you compare it with what you've got at the moment and see if it sort of matches up. And if you have done that, what were your assumptions? How did you do that? Under the mineral resources, the possible processing methods and the processing factors that could have a material effect on the likelihood of eventual economic extractions. Now, in the end, you are going to decide in your study what is the process that you're going to use. In a pre-feasibility study, you've looked at all the options, the optionalities of the processings and so forth. Like, for instance, you will have a gold mine, and all of a sudden you realize, but there's a lot of free gold in this deposit. So you'll rather send it first over a riffle table to get the free gold out, and then you process it further through the mill and the whole process of getting gold out. You will also have things like refractory ore that is very difficult to get the gold out because it's so finely disseminated in the ore, that the metal is, you can mill it to bug dust, you will still only get 36% or 35% extraction, whereas you should get in the middle 90s. So then you put it through either biox or autoclaves, or you roast it or whatever to crack open the rock so that the cyanide can get to the gold. So that you must describe, justify, tell what is the equipment, the plant capacities, the efficiencies, and the personnel requirements, so that your client or your reader can have transparency and understand how did you get to that. Because at the end of the day, you want him to feel comfortable with the study that you have done. As I said, you want in your study, as you go along, you want a representative sample or representative sampling to take place. So you must discuss that in your study. How many boreholes did you use? How many boreholes did you discard? Was it composited? How well was it composite? Does a composite include a little bit of waste above or below the ore? And all these sort of things. On the plant itself, you should have a detailed flow sheet on the mineral reserve, or a diagram and a mass balance, especially if you've got a multi-product operation, because which is typically of a PGM operation, where you've got your 5 platinum group metals, you've got nickel, you've got copper in there, which each one's got to through a different process, different recoveries for the elements. And so the client wants to see, did you, in the metallurgical test work, take cognizance of everything that goes into the plant? How's it going to be treated? How are you going to get out? What's your recovery factors? You must also say, well, deleterious elements, in other words, say for instance in gold, you get two kinds of refractory ore. You get the one is a refractory ore where the gold is so finely disseminated in the rock that you have to find a way of, it's like a nut with a kernel inside. The gold is a kernel and you've got to crack the nut so that the cyanide can get to the kernel. You dissolve it and you can have the correct extraction. Then there's another refractory element to the ore, that there may be a lot of carbonaceous material in the ore that would absorb the gold and not let it be extracted. Well, that's the deleterious element of any bulk sample or pilot scale test work, and the degree to which the samples are representative for the ore body as a whole. So, of course, you do laboratory test work, and you've got to have pilots, plants, pilot scale test work that you've done to confirm that what you've got in the laboratory in a pilot test work. So you've got to discuss all of that. The process by which you are going to extract the ore, you must state whether it is a traditional, well-used method, or is it a novel method in nature. So, for instance, I've recently been to a diamond mine in Sierra Leone where they bring in new technology. The technology is well tested in the industry, but it's never been used in the gold mining, in the diamond mining industry, where the technology works on X-rays, differentiating on the ore and waste on color. In this case, the diamond dike was quite dark, nearly black in color, whereas the waste rock was granite, which is a much lighter color. And they had a 98% success rate in getting the diamond ore to one side and the waste to the other side. But it's never been used in the diamond industry. It's been used in other industry. But in the pilot test work, they found this application. So it's a new one, and you have to give a explanation about it and what your opinion is about it or not. So we get to infrastructure. You will have either a green fields or a brown fields. A green fields being there's nothing, and you have to start the mine from scratch. Brown fields means there's already an existing mine, so you're extending the mine, or you're using the current mine's infrastructure to mine a deposit close by. So you must talk about the current state of the infrastructure of the, or the ease with which infrastructure can be provided or accessed. You can, on paper, you can say, oh, the infrastructure is there, but it could be in a decrepit state, or in a case like many mines in South Africa, it's been vandalized, and there's costs involved to get it back to where it was. So in your mineral reserve, you must state that you have the facilities that's there, and especially bulk facilities like water and power. Is it sufficient? Is it in a correct state to do the mining, to do the processing that you want? Yeah, that's the processing plant, the tailings dam, the leaching facilities, the waste dumps, road, rail, port facilities, water and power supply, offices. I mean, that's the whole list is there. And then you must have a plan showing where each one is going to be. And as I said, it is mind-boggling how quickly a mine can be vandalized or stripped of anything that's got copper in it. So when you do a study, make sure that you look at everything and that the equipment that is on the equipment list or the asset list is actually there and in a state to do the work. I've gone to mines where you've got a whole equipment list of drill rigs and things, and when you get there, I don't think you will get anything for the scrap. And then you must also show that you've looked at the logistics. One of the logistics, for instance, on a gold mine is that you provide for a helicopter to fly the gold out to Germiston to be refined there or not. How are you going to transport it? So you've got to look at the logistics on roads and rails and things like that. On the environmental and social side, and this is something that you have to be very prudent about. It's like the SAMREC codes. Environmental and social is like the SAMREC codes. People do the whole design, and at the end of the design, they say, oh, okay, what about the codes? Or what about the environmental and social as an afterthought? Whereas you should take this into consideration right from the start. Then you don't have to do double work later on. People will come to you and say, I've got a license to do this X, Y, and Z. Then you say to them, well, show me the license. No, we've got the license. Our partner's got the license. Well, show me the license. The partner will get it for you, and then you never see the license. So you either yourself or you get a specialist, an environmental and social specialist, to come in and do this work, to confirm that they actually have got a mining license or a prospecting license for the area that addresses the country, host country's environmental and legal compliance requirements, and any mandatory and or voluntary standards or guidelines to which it subscribes. Nowadays, if you go to the bank or a financial institution, they will want this, see that the environmental and social studies have been done to the International Finance Corporation's IFC or the World Bank standards. They've got standards that they put things to, and Australia's got their own, for instance, as well. So you have to make sure that this environmental assessment had been done to those standards. Otherwise, it'll just have to be done again. And make sure that the client actually has got the license for the mine that he wants to mine. You have to identify the necessary permits that will be required and their status. Having got the permit in the first place, it might have it will have an expiry date. Have they lapsed? Have they put in applications for it? For the license. There was a year or two, maybe still, many companies that were mining without a water use license. But they could mine because they have done the application. It was just the government was taking their time giving the license. But at least you must see that if it's going to lapse soon, that they have done a new application for this license. one of the other things that had happened a couple of years ago, two places that I know of, was that companies like platinum mining companies had licenses to mine the PGMs, the platinum group metals, but they did not specify in the license that they want the copper and the nickel. So some smart guy came in and applied for the copper and nickel license on the same property, and he was awarded. And all of a sudden, now the mining company has to back pay this guy that hasn't lifted a finger for the copper and nickel that they've taken out over the years and going forward. So you have to be very careful with the licensing, that it includes everything that you want to mine where you are. You must, yeah. So as I said, make sure the licenses are still valid, permits, and whether there's a reasonable basis that they will get a new license going forward. I have seen on coal mines, for instance, where the guys couldn't get a new contract, or they were fighting with Eskom on a new coal contract that lapsed. And while they were in negotiations, the mining licenses had lapsed. And that's not the situation that you want to be in. So you must identify and discuss any sensitive areas that may affect the project, as well as any other environmental factors. I mean, one of the things is burial grounds, where people have been buried, and you have to move the graves. And those are sensitive cultural things, or cultural areas that are sensitive for the community that stays around the mine. Because you must remember that not only do you have to have the legal permits, licenses to mine, you must also have a social license to mine. The social license to mine is the community that lives around your mine. Many mines have been closed off by the community because they were unhappy about something. So your relationships with the local community has to be prioritized as well. So yeah, there's what they call the interested and affected parties. And you must make sure that you've spoken to everybody, every man in his dog, because they are all people that, and you will sometimes find that you have got around the mine 2 communities or 3 or 5 communities, and one community wants to be the only lot that talks to the mine and get their people hired. And then there's infighting between them, and you get into the crossfire. And that's a minefield that you don't want to be in. You must identify any legislated social management program that may be required and discuss the content and status therefore. If you have to have a mining license, you have to have a social license plan, a SLP. Social and labor plan, yes, sorry, social and labor plan. And that would be things like you commit yourself to build a school, town hall, boreholes of water that you give to the community, whatever. Sometimes the mines get into financial difficulties, and that's the first thing they cut, is their social labor plans. They don't just deliver on it. And the community is now waiting for you to deliver on it. And then that's when the fun starts. Outline and quantify the material, socioeconomic, and cultural impacts that needs to be mitigated, and the mitigation measures where appropriate, and the associated costs. Typically, this is where you have to move communities off the ground. of the mining ground. You want to mine there open cast, but you've got a settlement sitting there with a graveyard. And what typically happens is you go build houses, new houses for them. Then you may live in a shanty, but your commitment to him to move is to go build a brick house with hot water and everything. In new projects, when you do an environmental study and labor study, please do a baseline study, because what you will find is there are people living on the mines or in that area where you want to go and mine. The moment they see drill rigs coming onto the area, you might have, say, 20 houses or families living on that place. The moment the drill rigs come onto the ground, within a couple of months, that community would have grown from 20 to 100, 200 families living on the ground, because they know you will have to build in new houses. That is something on a practical side that you have to take cognizance of when you do a study. You have to describe the valuable or potentially valuable products, including suitability of products, co-products and byproducts for marketing. Interesting thing is when you do, say for instance, gold or platinum or diamonds, you've got a product and you declare your reserves in terms of grams per ton and tons of ore. For coal mining, you have to declare your reserve in terms of the product that you're selling. Is it a beneficiated product or is it the wrong product? So it's well, a beneficiated product as received or dry. So if your contract is with, say, Eskom, and you've got to deliver coal at a certain CV, calorific value, then your reserve is defined in terms of that product that you're going to deliver. In terms of a platinum mine, you've got your PGMs, you've got your copper, your nickel, all of that byproducts that you're going to sell. So you must, in terms of your marketing, specify exactly what they are. And can they be sold or not? You have to describe the products to be sold, the customer specifications, the testing, the acceptance. You've got to talk about the market. How big is the market? Are they there? Is it the growing market? Is it the stagnant or is it the declining market? Do you have offtake agreements? In other words, offtake agreement is that you've got already a contract that they will take the product from you. And that's important, especially when your client is going to ask for money from the banks or from a private equity firm or financial institution. Because they want to see, will you be able to sell your product? It's fine that you can produce it at a suitable cost and so forth, and in the general market is worth selling. But if you haven't got a client that says, yes, I will take this, and you have got a market, then they will not give you money. Of course, things like gold and diamonds and platinum, there's a world market. There's always a demand for it. But on things like coal and other commodities, you will have to provide proof that you've got an offtake agreement. You must also state the prices and the volume forecast and the basis for these forecasts. And this is a tricky one, because people, what if you want to value a mine, or say that my reserve, because your reserve is that which is saleable. Now, what price are you going to use? What gold price are you going to use? What exchange rate are you going to use? Is it the average of the past 6 months? Is it the average of the past year? Is it the today's market price? Is it a forecasting price that you get from the banks? The only thing that you will be 100% sure of is that it will be wrong. Whatever you use will be wrong, because it changes every day. But you as an expert need to make an assumption, and you must justify that assumption on these prices and volumes forecast. What is the basis of it? So you have to state and describe all economic criteria that have been used for the study, such as the capital operating costs, exchange rates, revenue, price curves, royalties, cut-off grades, reserve pay limits. And we've touched on all of this already. But tick the boxes, make sure that you've answered these, you've discussed it and motivated it, that you can give a good explanation why you've used it and on what basis. You must also state how confident you are about these criteria that you've used. In other words, you can say, well, I've used this, and this is the basis that I've used it on, but I'm only about 60 or 70% sure that those will be the correct ones, so that your reader can understand. And that is why you must always put out and say, it's an estimate. Never say, it is the net present value is this, or the market size is this, because you never know. So always use the word estimate in your documentation. So otherwise they can take you to the cleaners. To tie up with, I was thinking about something, you know, when we talk about estimation, when you do your tables on reserves or your financial modeling or whatever, please take into consideration the level of accuracy that you work at. Because everything, starting with geology, is an estimate. So to report tons to the nearest 1 ton, or sometimes to the point 2 decimals of tons, doesn't make sense. Rather report things to the nearest 100 tons, or round it off to the nearest 100 tons, or because I know the computer says to the nearest ton or to the nearest 2 decimals of tons, but apply your mind and say, we are not working exactly like this. So we do that. So the point of reference that they talk about here is your ROM pad, or in other words, where are you delivering the ore? Does it go straight from the mine into the plant, or is there an area where you put it down and from there it's taken to the plant? And that's normally or usually your ROM pad. You have to indicate where your run-of-mine pad sits, so that they will understand what are you reporting here? Present the details of the point of reference for the tonnage and grades, reported as mineral reserves. Yeah, and that's your mineral reserves is normally your run-of-mine tons, and the point of reference is the pad. Production costs, in other words, your costs, you must be quite clear what you're doing. You know, what are your assumptions concerning the production costs? Does it include certain things or exclude it? Does it include labor or exclude labor? Have you got labor separately? And it's often mines have got different costing structures. They've got activity cost structures, or they've got production or unit structures and so on. So you have to be careful on how you report them. Does it include or exclude transport, treatment, penalties, exchange rates, marketing, and other costs? All those things must be specified in your model, so that you must also say, what have I done to ameliorate or to take care of the deleterious elements and the cost of penalties. In other words, you sometimes get, say for instance, on a coal mine, you have to deliver a product at, say, 22 megajoules per kilogram. That's your CV. But you only manage to do 21.5. So Eskom will still take it, but you'll pay a penalty because you're not delivering it at 22, you're delivering at 21.5. So that's a penalty, and you have to show where it comes into your model. So you have to have a clarification of those things. So you must justify your assumptions. I mean, where did you get these costs from? Are they industry norms? Did you get quotes from contractors? Normally with a definitive feasibility study, you have to have a quote from 3 contractors that have quoted. On a pre-feasibility study, it's not that onerous, but you can get from one contractor a quote for doing the transport or whatever. But you must state clearly what your assumptions are. Or on a life of mine plan, you say, well, historically, this is what they've paid. This is what they've been doing. And you say, this is my assumption going forward with these costs. So, and that includes your transportation, treatment, penalties, exchange rates, marketing, and other costs. And you must have details of allowances made for royalties payable both to government and private owners. Now, you all know that there is the Royalty Act that's come into play. What I've often seen is that people don't understand it. For instance, you'll get gold being produced on the mine, and you've got a financial model for the mine. Then people treat that gold as a refined product, because there's one royalty formula for refined and another royalty formula for unrefined. Now, the gold produced on the mine is unrefined. It's only when it's 99.9%, 99% pure, having gone through the refinery at Germiston, that you can apply a refined formula on it. So in your price versus if you apply a refined price, then you have to apply a refined royalty. But if the price that you get, because what happens is if you send gold to the refinery, they will deduct a certain amount from the price that you get from them for the gold you've delivered, because they've got to refine it now. So you cannot use a gold price of refined gold in your model and not deduct the cost thereof that you pay to the refinery. And then you must also then sure that you do not mix up your royalty formula when you put that in your financial model. You must state the type, extent, and condition of plant and equipment that is significant to the existing operations. There is always, a new plant will have better efficiencies and lower maintenance costs or operating costs. An old plant will have higher operating costs and lower efficiencies. It's just the nature of the beast. So you must talk about that in your report. What is the condition of the plant? And what are the assumptions that has gone in? How did that impact in your assumptions as far as cost and recoveries are concerned? And you must provide details of all environmental, social, and labor costs considered. And that would include things like, for instance, around your waste dump, digging those trenches around and putting boreholes in to prevent acid drainage plumes from moving away from the dumps. Those are environmental costs ongoing, pollution control dams, all these sort of things. Social and labor costs considered. What have you considered in terms of your social, in what you've said? You're going to build the schools, you're going to put water balls and water for the community, whatever you've got in there. So you must give details on that. And your labor costs, the additional labor costs that you've considered for people on leave, etc. All the studies you put in a risk assessment. And there are various ways of doing risk assessment. You must do of the technical, economic, social, environmental, social, economic, political, and other key risks of the project. So normally what happens is you talk about, when you talk about a risk, it's a thing where you say, okay, what is the probability of the risk happening? And what is the impact should it happen? So, given an easy example, you get into your car. And what is the probability that I will get into a serious accident where I will end up in hospital? It's fairly low. What is the impact? Catastrophic. It can lead to death, or it can financially ruin you. So the probability times the impact gives you the risk. And then the risk, you can then say, what am I going to do to mitigate this risk? And it's a lot of things. I won't drink and drive. I will keep to the speed limit. I'll make sure my car is always in a good condition. And these sort of things. So those are the steps you've taken to ameliorate the risk, to manage it. And then you sit with what they call residual risk. After you've applied these things, you're sitting with a risk so that they can see that. This is one way of doing it. Another way of doing it is to say, well, the risk is here, say for a mine, a coal mine. The risk is that the license or the contract with Eskom will not be renewed. That's a risk. What is the impact? Well, the impact is that the mine will close down. If they can't renew their contract with Eskom. So what can they do about it? How can they manage it to mitigate it? And then you can say, for instance, well, they'll start talking to Eskom long before the contract ends. They'll start talking to them and get a feeling that the contract will be renewed, and or look for other offtake agreements with other people, other power stations, or whatever. And then you will have the residual risk after you've done that. What is the chance of something like that happening? So risk assessment is very important for financiers and investors and so on. Do not skimp on it. Do a workshop with everybody around the table, all the disciplines. Let them sit and listen to each other. Because often you will get someone from another discipline giving very good input into another discipline's area of expertise. On the economic analysis, and here they talk about scoping study, pre-feasibility, feasibility. And as I said earlier on, and other people has also said, you cannot declare a reserve based on a scoping study. It has to be at least a pre-feasibility, feasibility, or ongoing life of mine study. So basically a financial study is an income statement. At the top, you've got your production, tons, grade, whatever. Then you've got your financial section, what your income will be if you sell that. The next tranche is your working cost. It's going to cost you to do that mining and processing. Then your capital. What capital is needed to start up the mine, to keep the mine in business, etc. And then you will get to your royalty section, because royalty is based on revenue, not on profit. Then you'll get to your tax section, where the tax is worked out that they have to pay. And then you will get your EBITDA, what they call earnings before interest, tax, and amortization or depreciation. And then you deduct your tax and your royalties from it, and then you get your net cash flow. And on that net cash flow, you do your net present value. When you present it, it must be on an annual basis, using the mineral reserve on an annual production schedule for the life of the mine of the project. You can't do it just for 3 months, 3 years, and say we'll get to the rest later. A lot of mines do that. They've got a 5-year mine plan, not a life of mine. The life of mine could be 18 to 20 years, but they do only work 5 years to see where they're going. You have to discuss the net present value of your cash flow, either be an EBITDA cash flow or a net cash flow, which is after tax and depreciation and royalties. The internal rate of return is the one thing that the clients fight you the most about. They want as low as possible internal rate of return so that they can have the best NPV, net present value. And then, of course, there's a payback period of the capital. So what is a payback period? The payback period is you take the sum of your net cash flow, and when it becomes positive, that's your payback period. So it might be, it's negative, 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 and eventually it becomes positive, and those are, say, 3 years. And in the last year, you work out how many months. So it's 3 years and 5 months or whatever. That's your payback period. And you also look at your maximum exposure that your client will have. So, and that is the sum of the negatives till it becomes positive. You also do a sensitivity or other analysis. So what you do is there's a technique that you could do in Excel. We call it the spider graph, where you check how the net present value changes with commodity price, with grade, with capital, operating costs, and other significant parameters. If you've got a big project, it would be advisable to also do a Monte Carlo analysis or something like at risk or so, where you take your input parameters, whether it's diesel, electricity, labor cost, all inputs, and each of those things have got their own distribution curve, and also then your production tonnages, your gold price or your commodity prices, the grades and so forth, and each one has got a distribution, its own distribution sign, and an upper and lower limit around the center. And what the model does is it takes random values out of each one of those things, and it creates a net present value. And you run it for 5,000 iterations. And then you get a graph. And the graph will say your most probable value is this. And then it's got a band also, 5% or 95% confidence that it will fall between these two values, and so forth. That will give you a good indication of how robust this model is. And then, I don't want to make it complicated, but there can be relationships between things. I mean, the grade versus revenue, there's a direct relationship between those two. As the grade goes up, the revenue will go up. And exchange rate will also have a relationship with your revenue. So, but the people that will do the valuation section will talk about those things. And once again, use to the nearest 100. Do not use to the nearest rand your values. And it's estimated values. So we get to section 6, and I must now start. Hurry up. So once again, the same as what we said earlier on, you must specify exactly what mineral resource you've used, what model, the specific name, because it can be the wrong one, and then everything else is wrong. So you must then also state clearly what kind of mining you're doing. Some people will assume that you will understand if I talk about pillars, if I talk about the size of the pillars, that you will understand I'm mining underground, and they don't mention whether it's open cast or underground mine. You don't use pillars in an open cast mine. So be clear that it's easy to read and people understand. You also have to talk about the type of mineralization. Is it a massive ore body? Is it the greenstone belt deposit? Is it a steep dipping dike type of mine? So that they understand that. The domain or the ore body, you can also get, what is that word now? In an ore body, you can get different areas that has got different characteristics. I can't remember the name of that now, but in any case, so you must say where you're doing it. So the mineral reserve statement is you will always have what's included in there. Does your mineral reserve includes, because sometimes it includes stockpiles, it sometimes even includes tailing dams, because there's material that you can rework there. So you must be very clear in what you say about the mineral reserve statement. Is it just the ore body? Does it include stockpiles? Does it include the tailing dams where you can go and rework to get some residual gold out there? When you do your modifying factors, you must also reconciliate. Say for instance, you put in there, I've got a 5% mining loss underground, for argument's sake. Then historically, in certain facets, that's the word I was looking for, certain areas of the mine, you had different mining losses because of the condition of the ground. Some areas you can have a 7 to 12% mining loss, in other areas 3%, on average maybe 5%. But if you work on a definitive feasibility study, you must be exact. And you can look in the areas historically, what have they got in that certain portion of the mine, and say my mining loss in this area was 7%, my mining loss in this area is 5% or less. So you must reconcile what had happened in the past with now. Performance parameters. You will say, well, historically, the face advance was 8 meters a month. Now we've got in the plan 12 meters a month. How are we going to do it? Are we using now hydropower drills that we can get 12 or 15 meters a month? Are we going to use the old machinery? What are your assumptions? Oh yeah, assumptions and your modifying factors. So you must talk about, not just give it in there, but give historical. And if you don't have historical, talk about industry norm. If you've got a mining loss of 0 in your assumptions, you must discuss it and say why you've got 0 when the industry norm is X or Y. Factors including a comparison with the previous reserve quantity and qualities, if available. So you must also do a comparison with previous reserves, quantities and qualities. So in your reserve statements, or at this A table, you must say, previously this was the reserve, the tons and the grades and so forth. Now it's this. Why is it different? Well, it could be that I've mined out a portion of the mine, so the mining portion is X. But then also, because of the changes in commodity prices, I've discarded certain amounts of the resource from my reserve. So it's now smaller. Or better drilling had shown that it is not what I thought it was. So I've also discarded, or I've added it in. So you must do that reconciliation from previous to currently. And then you must also talk about, if applicable, if appropriate, report comment on any historical trends. In other words, has a grade gone down or up, or what's going on this mine? You describe and justify criteria and methods used as a basis of classification. So we all know you've got your reserves as proved and probable, not proven, but proved and probable. So you must now say, why have I used proved and X amount proved and Y amount probable? You, as previous people had talked about in your ore resource, if you can take some of the measured into probable, but you cannot take some of the indicated into proved. Now, if you've taken some of the measured resource into your probable, you must explain why. There's a confidence factor, one of the modifying factors that you're not so sure about. So you'd rather move it into probable than into proved. Or if you've moved everything from measured into proved and everything from indicated into probable using your modifying factors in both cases, you must also discuss that. So that changes, and also what your confidence is. So for instance, a confidence issue would be to move measured, some of the measured into probable because you have no confidence enough to move it into the proved section. Okay, then there is, that's actually the reporting side, where the proportion of the probable mineral reserves that has been derived from measured mineral reserve, if any, and why you've done that. If you've got your reserve statement, you have to, if you've got both open pit and underground operations going simultaneously, with residues, stockpiles, remnants, tailings, existing pillars or other resources, you must categorize them separately and not just give a reserve, because then you're not transparent. And your reader needs to understand where these reserves are coming from. So you must detail that. So once again, the next point, number 3, is where is your reference point? Say where is it? And it's normally the run-of mine pad. From the mine to the run-of mine pad, and there it stops. And if the reference point is different, such as a saleable product, clarifying statement is included to ensure that the reader is fully informed. I mean, you get what they call a crush and screen situation on a coal mine. So it comes out, it goes straight into a crusher, it's crushed, screened, and put out. It doesn't go to a ROM pad first, and from there onto this thing. So the reader is fully, is it the saleable product or is it still run of mine? What is your reference point that you have got? So the reader will understand that. Yeah, we've spoken about the reconciliation with the previous mineral reserve estimates. So once again, as I said, you had, say, 1 million previously tons in the reserve. Now you've got 800,000. Why is there a difference? Has it been mining? Are there economic reasons? Are there any other factors that have come into play have you drilled out that area and found out that it's not the quality that you thought it's going to be, the quality reasons and so forth. Or you could add to the reserve that you previously discarded. Now it goes back into the reserve. The economics have changed. It can go back, resources can go back into reserves that you previously discarded. So do that reconciliation and you write a section on why it's different. Once again, as we have said, only measured and indicated mineral resources can be considered for inclusion in the mineral reserve. Then this 0.6 is a bit contentious for some people. So when you say you must state whether your mineral resource is inclusive or exclusive of mineral reserves. What does this mean? It means, say for instance, you have got 5 million tons in resource. And you've got 2.5 million tons in reserve after you've applied all your modifying factors and economic factors, etc. So when you say you report your resources, one way is to say, my resources are 5 million tons, and it includes reserves. Or you can say, my resources are 2.5 million tons, and it excludes mineral reserves, because the mineral reserves are now 2.5 million tons separately. There is a bit of a controversy, not controversy, because if you look at the mine plan, at the resource and the reserve, what is, and it's drawn out there, you will sometimes see a reserve sitting inside the resource, or the reserve sitting outside the resource area. And because they are drilled for some reason there, and it's fine to be declared as a reserve. So to have it declared exclusive, it depends on the people. Personally, I will include the mineral reserves in the resources, but that's, you can do either or. Okay, Tanya, my 2 hours is about up. Are there any questions?
Joseph, go ahead.
Thanks a lot, Hannes. I think you shedded some light onto some of the items there. I just wanted to ask maybe more of your opinion, particularly on the risk assessment. You know, most of the times when you look at reserves, you're looking at long term and not necessarily, you know, short term, but sometimes when you conduct risk assessment, you know, there are always short-term issues that are happening that obviously probably make a shift in how you perceive risks. So I just wanted maybe to hear your opinion in your experience, how you have handled the risk related to reserves more on a long-term approach rather than more focused on short-term.
Okay, thanks, Joseph, for that question. The thing about reserves on the long term is, as I said earlier on, whatever commodity price and exchange rate you use will be wrong. As we've seen, you know, it goes up and down depending on the politics, on sentiment, on a lot of things. So the risk is always there. And you have to look at it in that light. And I think all investors do that. But then there's other things also involved in risk, and it's not only commodity prices and revenue. There are things like country risk that you have to take into consideration. in the long term. You know, how stable is the country? How stable is the region where the mine is? And you have to take cognizance of that. Things can get better or they can get worse. And then also your on the long term, your community around the thing, and environmental, because a lot of things comes up in terms of environmental issues that you are faced with. What people often don't consider is the water issues. If they've got water coming out of the mine, especially on the coal mines, for the rest of your life, you will have to look after that water. Make sure it's not a once-off thing, and on environmental as well. You will have to, long after the mine is closed, you will still have an obligation to mitigate that risk. Did that answer your question, Joseph?
Yes, certainly, Ernest. Thank you very much. Yeah.
Okay,
Good
thank you.
perspective. Good
I
perspective.
see Marlon has got a hand up.
Yes, good morning, Anas. I hope you can hear me properly and I didn't miss anything. Anas, I just want to find out your view. Now, when we report reserves on an annual basis, we do report the cut-off grades, but seeing that, I mean, previously, now with the cut-off grades, you've got two conflicting views. There's a economic cut-off grade, and then you've got some operations with technical limits. But we all know that cut-off grade is not a fixed number, because it all depends on your cash flow on the individual period. So some mines report their cut-off grades out of their first year of mining, and some report as an average over the life of mine. Now, normally these cut-off grades, and if you look at the financial evaluation, you look at NPV, but NPV is not a good measure, especially if you have a mine life in excess of about 31 years, because then any changes in NPV discounting factors does not mean anything. But has there been thoughts on looking at these cut-off grades and standardizing what you quote? Because there's a vast difference if you look at the life of mine over a certain period.
Sorry, Marlon, the audio was not that good, but my understanding what you're asking is, you know, the cut-off grade that's been established when the mine started versus a cut-off grade as a mine carries on, and how to manage that. Is that the question?
Yes, Anna, sorry, my mic for some reason is not connecting properly. So I hope you can hear me a little bit better. I'll try and speak louder.
I hear you better. Yes, I hear you.
It's just my question around the cutoff is we quote a cutoff. Now, a cutoff is not a fixed number, because your cutoff varies on your revenue streams and your costs per period over annualized basis. Now now we normally use some scheduling optimization software which estimates the cutoff in an individual period. So has there been thoughts on what cutoff are the guys reporting? Because is it the cutoff of, let's say, the current year that you're busy declaring in, or is it a cutoff over the average of the life of mine? Because some financial metrics like NPV, say post 31 years, does not really show you the true value of what's still left in the ground.
Okay. My answer to that question is, if you look at net present value, I will not work out a net present value longer than 30 years. Reason being, the time value of money, the effect that mining will, after 30 years, will have on your NPV is so small because of it's been discounted for 30 years to today's money. It's not really worthwhile doing it, and it's not going to add value. And as you stated, the cut-off grade is actually a short-term thing because of changing commodity prices, changing costs, electricity prices going up by 25% instead of inflation, and those sort of things. So, first of all, but you cannot then, or let me take another step back. When I do NPV models or financial models, I always work in real terms. Now, you get real and nominal. Nominal is costs going up with inflation, and then you have to also let your commodity prices go up with some method. And then when you've got a discount rate, because certain things go up at different ratios. I mean, your labor will go up, say, with 10%, your electricity goes up by 25%, your fuel goes up by 40% or whatever. So what discount rate do you actually use to discount your revenue stream coming back? That's why I stay away from it.
Yeah.
There's one caveat on that, and that is the tax is undervalued when you work in a revenue in a real model. But coming back to your question about the cutoff grade, if you work in a real model, the effect of differences going forward is then so much smaller. And you can do it this year, and you work out the cutoff grade. Next year, when you do your model, you'll use a new cutoff grade to determine your reserve going forward. Because you, as management, you don't just sit back. You adapt to your conditions around you. If things change, you have to change. Otherwise, you're dead. So, I don't know if I answered your question.
No, you've answered it. Yeah, it's just that we've been playing with it now. Normally, when you get these market cycles, you get the high and the low. Now, when you follow the actual analyst forecasts and all of that, especially if you were on a high, as in, let's say, a few years ago, and you're on a low, then you get these violent swings in reserve numbers, because when you look at the new prices and you evaluate, you get those violent swings. I mean, obviously you can do sensitivities, but they don't show you the true picture. But I know we've been dabbling with trying to normalize those violent swings, because it doesn't serve any purpose to come in and say next year, okay, the prices are low, the costs are up, I'm going to have a 20% drop in my reserves. And then coming 2 years later and say, no, I'm going to add the 20% back because everything has normalized. So it's just that up and down. I don't think it creates investors, almost like investor confidence. Because if you look at the overall trend over, let's for argument's sake, say a 10-year period, the trend and the trend line, even if you draw a straight line, is the same. But those individual periods, you have these 10, 25%, depending on the operation, you have like more than a 10% spike in reserve numbers up or down. And I think that some people might say that don't outright understand it. Do these guys know what they're talking about? Because they keep on putting stuff in and taking it out, or taking stuff out and putting it back in.
I fully agree with you. I fully agree with you. You should not do that. I mean, my feeling is that you on your reserves, you should take a stand and try to keep it not ignoring your cycles, that commodity cycles that's going through.
Yeah.
But you try to keep it as smooth as possible, unless there's a fundamental reason that you think the commodity prices will now go down and stay down, or it'll go up and stay up for the next couple of years. I would rather, as you say, keep a sort of average and work off that when you do that. But for your internal consumption, For your internal consumption, I would think that you should look at yearly cut-off grades.
Yeah.
Because you must also remember, sometimes you go past an area with which you've discarded because of a cut-off grade, but because the infrastructure is there already, you can go and mine it. Because there's no cost to get to it. It's there. And you can mine below the cut-off grade. Kevin.
Hannes, so probably unlike everybody else, I'm an accountant.
Okay.
So a question that I had though is that
Yes.
when you've determined your present values, you've then said, fine, that'll be my reserves. But we operate if you're a multinational, you operate in many countries.
Yes.
Your present value that the geologist is determining is wonderful. Unfortunately, that country has exchange control restrictions. And so the cash is absolutely useless with regard to the holding company and the shareholders.
Yeah.
Is that something that the group reporter of the group reserves should take into consideration? Or is it another one, investor beware?
One of the things, Kevin, and thank you for the question, that you must remember, when the geologist does his reasonable prospects for eventual economic extraction, or RP, EEE, or whatever they call it, he only has to make $1 or R1 in order to declare a resource. It doesn't have to be profitable. That's the one thing. The other thing that I have spoken to other guys when doing valuations of mines, we talk about what are modifying factors. One of the modifying factors is political things. But I have never seen someone taking politics into consideration when declaring a reserve. Politics come into your discount rate. That's where you bring it in and say, okay, my WACC, or my weighted average cost of capital, is say 8%. Now I add another 3% to that for country risk. I add another % or 2 in for exchange controls. And that is where you handle those things. But on your reserve itself, you apply costs and revenue and all those sort of things and the other stuff to get to a reserve. So to put it in a nutshell, a reserve of, say, copper, an equivalent, everything else being the same, that you value a mine in Botswana and you value a mine in Sudan is the same. But it's through your discount rate that you bring in your country risk and all these other things to come to a different value for the mine.
So, yeah. So you then end up with I'm an accountant, the illogical position that the geologist is declaring an increase in reserves.
No.
But at the holding company, they're impairing the mine because you actually can't get any value out of it. It doesn't make sense, but I get that's what the position could be.
Okay, the geologist doesn't declare a resource, a reserve. He only declares a resource. In other words, the total ore body. What the mining engineer does is to declare a reserve. In other words, how much run-of-mine tons can you get out of that ore body, out of the resource?
So that's my just misuse of words, but you know, the report from the country would declare an increase in reserves, but at the holding company, they'll impair the mine because they can't get access to the cash. It seems an illogical position, but I guess it's one that can happen. It's one I've seen, particularly with Argentina, because Argentina has been on exchange control restrictions for the last 5 years. So I've seen that occur. It just seems an illogical position that reserves are increasing, but the company saying actually the mine's not worth it.
Kevin, I agree with you in a sense. I mean, take for instance, there is a lot of coal in the middle of the Kruger National Park. This is a resource. Is it the reserve? I don't know. You'll never get a permit to mine it. So you cannot declare a reserve there. I don't know if I've thrown the cat among the pigeons now, but yeah, but you're right.
Yeah, it's you know, it's something, you know, where I've been chatting with geologists and trying to work out, you know, if I see an increase in reserves, I have a natural inclination to say the mine is worth more.
Yeah, if you've got an increase in the reserves, then yeah, it should be worth more. But
the political risk comes in after that number, which means it's actually worth less. It just
yeah, well, you measure your worth in your NPV, not in the reserve.
Yeah,
that's where you measure your NPV.
Yeah.
And we start off this afternoon looking at diamonds. You'll remember in his presentation, Ken noted that there were a couple of additional guidance required for diamonds and coal and various other commodities. We've had a look at diamonds already, at coal already. So we are now going to have a look at diamonds. Okay, so the reason diamonds are different is because they are extremely low grade. If you have a look at this diagram over here, you can see that the grades of both kimberlite pipes and alluvial diamonds are factors of 10 higher than others. Also, particularly with respect to alluvial diamonds, their variability is extremely high. Other differences between diamonds and other deposits, we can't use quality as a substitute for grade. And there are some strange things when it comes to valuing particularly placer deposits. Also, there's a specialized field of diamond valuation. With respect to gold, platinum, most other commodities, the price of gold is the price of gold is the price of gold. Not so with diamonds. Every single diamond can have a different value depending upon its size, shape, color, and so forth. And there's a particular relationship between diamond size and diamond value. And these are the things that come into play when valuing or evaluating a diamond deposit. Over the last few years, we've also seen an increase in the number of listed gemstone projects. These deposits have many similarities with diamond deposits. And so the guidelines that we talk about with respect to diamonds are typically applicable to other gemstone deposits as well, certainly in terms of principles. So when we look at this figure, which you all know very well, we're just going to take a brief trip through to see what is similar and what is different from other commodities. Certainly when we look at exploration results, there's not much that is different to any other commodity. This is the type of data that one would collect during our exploration program. And here are some of the things that you wouldn't collect in any other project. Things such as microdiamond data, kimberlitic indicator minerals, diamond sales data, and your size or value frequency distribution. When we look at exploration results, we can certainly include historical data and information if it is relevant and reliable. Now, we're not talking here about presenting historical information as historical information. Rather, we're talking about using the historical information as relevant to what we expect to recover from our own property. For example, in this picture shown here, there is nothing wrong with presenting the grades that the diggers recovered from the Kimberley Big Hole 100 years ago, just as long as you don't try to claim that that should be the grade where you are now mining some 700 meters below surface. The other thing that we can do when looking at exploration data is to use data from adjacent or nearby properties. But once again, it has to be relevant and there should be some justification of continuity, particularly in terms of geological setting, bedrock conditions, depositional environments. So, for example, if that was your project over there, you wouldn't use the data from that worked out section as being relevant to your property. As you can see, everything is completely different. And likewise with kimberlites, simply because the premier mine occurs on the property next to yours doesn't mean that you must necessarily expect the same grade on your pipe. Also, looking at adjacent or nearby properties, you really want to make sure that there is some physical evidence of assumed continuity. Simply because your property is next door to one that has a dike on it or a gravel run does not by itself provide justification of continuity. We would want to see some sort of physical evidence. In the example shown here, this is a gravel run running north to south. And people always say that geology does not stop at fence boundaries. Well, in this case, it did. Not because of the fence, but because the fence was fortuitously at a place where there was a fault, and this fault resulted in a change of depositional environment. With respect to classifying exploration targets in terms of conceptual or speculative and your pre-resource estimate, pre-resource mineralization, there's no difference to any other mineral deposit. All of the issues that Ken discussed earlier under exploration targets and exploration results, they all hold good for diamond reporting as well. So we're not going to repeat it, just to note that when you talk about diamonds, we need to have both quality and quantity. In other words, we need to know something about the volume, the grade, and the diamond value, without leaving one out. And a very good example is here, if you have a diamond deposit of, say, 150 to 200 million tons and grades of plus 2,000 carats a 100 ton, well, it makes a very big difference if your diamonds look like that or that, which is why diamond value is specifically important. And again, you can't only state the included carats as a single number. We need to know all of this information as well. When you look at kimberlitic indicator minerals, they are extremely useful in providing indirect evidence for potential discoveries, but it's only in primary deposits. Indicator minerals are not applicable to alluvial or marine deposits because it's completely meaningless whether you do or don't have indicators in your secondary deposit. These indicator minerals are useful only in the early stages of ranking exploration targets. So they're really important for exploration targets, exploration results, but you can't use them further up the chain when looking at resource grades or values. And they also have limited implication as far as project value is concerned. Project value, not diamond value. If we move then on to diamond resources, this is the definition of what a diamond resource is. And so if we take that one at a time, the first one, again, exactly the same as any other commodity, it needs to have reasonable prospects for eventual economic extraction. Again, the same thing. You need to demonstrate that you have RPEEE through a high-level reasoned assessment, as well as justification. And you would look at things such as geological and resource parameters, your mining and processing issues, and various other issues that could affect it. Just a note on the eventual economic extraction. Some of the bulk commodities, this might be over 50 years. Diamond deposits generally are less than 20 years, and alluvial deposits are very much less than 5 years. The second thing we look at in our resource definition has to do with the geological model and sampling. Now, we don't tell you in the diamond evaluation, don't give you a drill or spacing sampling criteria. That is determined by the site-specific geology. And the things that you would take into account would obviously be things like the shape, the number of different facies or geological domains that you have, and the grade variation. And just to note that in complex deposits, such as alluvial deposits, it can be often difficult to ensure that your sampling is truly representative. So in these kinds of deposits, you will end up doing an awful lot more drilling and sampling than you would for other commodities to get a comparable resource estimation. Third important thing about a diamond resource definition is that you cannot identify a resource in the absence of reliable, verifiable sampling information from the property or your geological unit in question. So if you were sampling these kimberlites, and this was the one that you were interested in, you certainly couldn't take the grade of these deposits and use it for your kimberlite. You would need to sample those specific facies in order to get information for a resource. Also, if you were looking at the same thing on an alluvial deposit, if you only had historical results from these higher level terraces that had been mined out 20, 40 years ago, if you couldn't verify this information, you couldn't use it for your deposit at resource classification. Exploration target, yes. Resource classification, no. The volume needs to be based on more than just remote sensing or geophysics alone. We need to have some sort of corroborating drill data. If you have a beautiful kimberlitic anomaly, you couldn't only do an estimation of the volume. You would need to have some corroborating drill data. In an alluvial setting, you couldn't put a hole over here and a hole over there and then draw an envelope around the entire deposit and say that is my resource. And as with any other kind of deposit, please no spotted dogs. And then we also look, the basis of classification needs to be disclosed. As with every other commodity, we look at the same classification categories. Just to note that within diamond deposits, measured resources and as a result, proved reserves are very, very, very seldom identified. And we'll talk about that briefly just now. You can do your grades in terms of volume, area, or mass. Area specifically on marine deposits, where you can get grade per square meter. When disclosing information in a resource statement or a table, we always need either the volume or the tonnage, the grade, and the quality. And the other thing that's important in a diamond resource classification is you must have the bottom cutoff size. Also, when looking at classifications, we need to take into account the confidence in the data, not only the increasing geoscientific knowledge, but also the confidence that we have in our data. And that is determined often by the amount of sampling, but also the uncertainty in demonstrating spatial relationships. And this is particularly important when we look at low-grade large stone deposits. And these can be both kimberlite and or alluvial deposits. As with any other deposit, please disclose and justify your classification criteria. One of the things that we see in the alluvial world quite often is the individuals say, we believe that the result, should be called an inferred resource, or we think that it needs to be an indicated resource. We don't care what you believe or think. We want to see it through a systematic methodology with transparent criteria. As with other commodities, if we are using new, untested or non-standard methodologies, please, we need to have some detailed explanations, justifications, academic and technical references along with it. And just to make a note here about geostatistical estimation, these methods are well known and used in the kimberlite and marine environments, but they're not so acceptable in the alluvial field. If you do use them, please make sure that you motivate them, justify them, and describe them properly. And these are some of the other models that do need to be described if you use them, because not everybody is conversant with all the peculiarities of these different types of estimation models. We spoke earlier about the domains or the facies in kimberlite deposits as well as in alluvials. For every domain looking at a resource, please give some indication for every domain must have some information regarding all of these issues. What we come across very often is somebody will take a kimberlite deposit, they'll take a whole bunch of microdiamond samples and say, therefore, we have an inferred resource of X million tons. After doing some work, they say, whoops, all of this stuff out here is not actually commercial. So we now have an indicated resource of less than half of it. Remember the Crisco definition of a diamond resource, or of any kind of resource rather, that the majority of inferred resources should be upgradable to indicated resources with continued exploration. Talking about microdiamond studies, again, these are very useful for primary deposits, but they are not applicable for alluvial, or marine deposits. A diamond resource classification, you need both grade and value. Grade you can very easily estimate using microdiamonds, but diamond value requires macrodiamonds. You cannot do diamond value on microdiamonds, and if you don't have macro diamonds, you cannot get a resource. There are some circumstances where you can extrapolate as long as you have, or you can demonstrate geological homogeneity and continuity. You have a size frequency distribution, and you describe your extrapolation process in the necessary detail. Size frequency distributions, these are fundamentally important relationships, and irrespective of what resource classification you use, you need to provide a size frequency distribution along with a discussion of the size that you use, or the size of parcel that you use. Now, a size frequency distribution is basically a measure of how the sizes of our diamonds are distributed throughout the deposit. For example, if we look here, we can see that some 10% of our diamonds here on the in the blue line, the Neviar scroll deposit is greater than 30 carats. If, however, we look at the BHC deposit, we see there that 30% of our diamonds are greater than 20 carats. So it makes a big difference to the potential commerciality of your deposit, whether you have 10% large stones or 30% large stones. That is why these types of curves are really important. One of the many ways in which diamond deposits are different is that there is no such thing as an in situ grade. Every grade is a processed or a recovered grade, and that is dependent on the plant, the process that you use. So when describing resource grades, it's important to have a look at the relevant efficiencies of the sampling as well as the mining technology. And again, this process grade is not every single diamond, but it's at a stated bottom cutoff size. If you're referring to diamond sizes, please discuss the size definition that you use. Often people will use one set of sizes in terms of grade and a different set of size in terms of value. Please show correlations and conversions where you use these different systems. Okay, so when we look at an inferred resource on diamonds, we need volume, grade, and value. We need volume, grade, and value for inferred, indicated, and measured. But here it's only with a low level of confidence and where we have a reasonably small parcel. We cannot assay for diamonds, and statistical estimations have not been universally successful under certain circumstances. And this is pretty much how we would go about doing bulk sampling, using probe drilling platforms, using divers to take samples, on land, different kinds of drilling, pitting, and trenching. An indicated diamond resource, again, we need volume, grade, and diamond value. Here we require a more stringent level of confidence, and we need to have sufficient diamonds to allow an estimate of diamond value. And this is the only place where we give some recommended sizes for the parcel, and we'll get to that in a moment. I just want to identify that when you look at an indicated resource, it must obviously have a greater understanding of diamond grade, stone size, and so forth. Therefore, you typically would do that through a pilot plant in terms of either bulk sampling or trial mining. And this is how you would do it if you were looking at a primary deposit, an alluvial deposit, or a marine deposit. Just a bit of semantics around bulk sampling, trial mining. There's not a huge amount of difference. Typically, we use the term bulk sampling to mean that which we do to estimate the resources up to indicated classification. Trial mining then is the pre-feasibility study that converts your resources to a reserve. And realistically, a bulk sample can grow into a trial mining operation and can grow into a full-scale operation without too much effort. Okay, going back to the sizes of parcels. If you're looking for an inferred diamond resource, we recommend that you have a minimum of 500 carats valued or sold. For an indicated diamond resource, if you have a low variability deposit, such as we have here, typically a kimberlite, 2,000 carats, high variability, typically alluvial, 2,500 carats, and in the marine environment, perhaps 1,000 carats. And of course, you can see if that's the situation you're dealing with, then you're probably going to have to use a whole lot more than what we recommend. At all times, the competent person needs to discuss the rationale behind how many stones or carats that they use and the confidence that you have in that deposit. Looking at diamond values, we would like to see the value per size fraction of your diamonds. Your bottom cutoff size for your valuation must be the same as for your grade estimation. It's no use using a very low bottom cutoff for grade, but a very high cutoff for valuation. You get some really great results, but it's nowhere near realistic. The valuation of those diamonds must please be less than 6 months old. There are certain circumstances where you can combine an older valuation with size frequency distributions to model your value. And it's important to be aware of global or regional things that can change your diamond value. And here we've got a good example of what happened during COVID. Just prior to COVID, we had normal low values. We went into the holiday mode and prices increased. And then we fell off the cliff when COVID came in. So if you did a valuation here, you can see that 6 months later, it would have been nowhere near what it needed to be. A measured resource, this is where we need to confirm geological and grade continuity and have a high level of confidence. Now, due to the variability of most of the diamond deposits in terms of grade and value distribution, this level of resource estimation is generally not applicable for diamond deposits. It's not that you can't get that confidence, but it's generally too expensive to get there, and most operators don't bother. The example of a Rapa mine in Botswana, it's been operating for over 60 years, but De Beers has never upgraded the resource estimation to measured. So just to note that if you do see a measured resource in a report, please look at it very carefully, because this high level of confidence is generally not there. Then just to note that when looking at diamond reserve, the requirements are no different from reserve estimation on any other diamond deposit, keeping in mind the issues that you have with resource estimation. So in summary, you are going to, if you have anything pre-resource, that would be historical estimates, exploration results, mineralization. It cannot be part of a technical study. It cannot be converted into any reserve. An inferred resource will go through to a scoping study, or maybe included in a scoping study rather, but again, not converted to a reserve. And an indicated resource can be the subject of both a pre-feas or a feasibility study, and we land up with a probable diamond reserve, and the measured we don't deal with very much. And so I'm going to stop there.
So thank you, everybody. Tanya, I was very late in sending you my bio, so I thought perhaps I should give a short overview of myself before I jump in.
Good idea.
Thank you. So I am a scientist. I work in what many people are calling the ESG space right now, but I call myself a sustainable development practitioner. So traditionally in the environmental space, but stretching my work into community health, environment safety, well-being, etc. So what was typically become known as sustainable development, and now falls quite comfortably under the umbrella of ESG if you speak to other people out there. I have a master's degree in environmental management. I'm currently the Group Sustainable Development Manager for Goldfields, a gold mining company operating in multiple jurisdictions. And I am the Vice Chair of SAMESG, and perhaps also interestingly, the Vice or the Co-Chair of the International Council for Mining and Metals Working Group for Nature. So I'm still keeping things quite green, but on my day-to-day job, I do get sucked into things governance, things sustainable development, things community data reporting, disclosures, etc. So with that context, I'm going to give you a bit of an overview here that I think reaches into a slightly different content space to what you've heard today, and perhaps more importantly, a slightly different flavor. And we're going to be using some different words as we go along too. So we all speak English, right? So this is the part of the call where I'm going to actually ask you to consider putting on your camera. I'm not sure what camera arrangements were made earlier today or what the rules of the game are, but I would value some cameras on. And if not, that's okay, we'll be all right. And be prepared to maybe put up your hand in the chat or even say a few words as we jump into this thing. I think there's enough people on this call to be able to, give some meaning and integration into this set of questions that I'm going to ask you right now. So may you all kindly, by show of hands, give me an indication, and I'll open the chat too, of how many people on this call speak English. And if your camera is not on, you're welcome to physically raise your hand or virtually raise your hand on the chat. So I'm expecting a pretty big group here, right? I'm speaking to you in English. I heard Tanya speaking to you in English. So I expect that there will be lots of English coming through. How many people speak English on this call? Okay, the screen is showing me maybe half, maybe a little bit more than half. Thank you to all you brave people who put your cameras on. It's lovely. Okay, great. Now, you can put down your hands if you'd like. And you're also welcome to shout out these answers, but I'm curious to see how many people know what an ISKI is. This is an English word, by the way. What is an ISKI? Okay, so my Australian colleagues use the word ISKI when they're talking about a cooler box. The kind of thing you take into the field or to a picnic and it keeps your drinks cold. A cooler box. They call it an ISKI. That is their English legitimate word for a cooler box. I've got another question for you, and please feel brave, jump out if you'd like. I can also check out the chat. Is tea, when you have like that thing with a tea bag and milk and cookies, or is tea your dinner time meal after a long day of work before you go to bed? This one's easy. You can get it 50% wrong or 50% right, but I'd love to know what your view is. No
Both.
one.
Both. Both.
Probably both. So I grew up in KZN, and for us, tea was something you have with milk in a tea bag and lots of sugar if you're having a bad day. But my friends who moved to the UK after we finished studying call tea like dinner time. So they say, and we've probably all seen it on TV, right? Like your tea is ready, which means there is like dinner food available for you to eat. And so my feeling is, and on the slide that I've put up on the screen, we all speak English, right? And I'm like, well, do we really? And in my day job at my company on a daily basis, I think we all speak English, but we speak geology, we speak finance, we speak sustainable development, we speak HR. And as much as we're a small company and we're close to each other, we often say things using different words that have different meanings. And it feels like we speak a different language, yet we all speak English. And for me, in the sort of early phases of getting involved in mineral reserve and resource reporting, I kind of felt the same way. I thought, we all speak English, right? Like these words mean the same thing to me as they do to you, right? But actually, when I come with my sustainable development lens or my environmental management lens or my community engagement lens, I actually use different words or speak a slightly different language to my colleagues who come with these other lenses that I gave you examples of. And so when I talk to you about SAMESG today and ESG and sustainable development, I'd like you to be cautious and aware that I may use terms that are English, right? But English to me, or maybe English to my discipline or English to my company, and not necessarily English to you and your discipline and your background and your company. So with that in mind, be forgiving with each other as we try and find how the ESG space weighs into today's content. And if you have any questions or points of clarification, please feel free to raise them as we get into this now. I will definitely leave some space open at the end just for an open floor and discussion on relevant slides too. Okay, with that in mind, I'm just going to tell you that I'm going to cover like ESG, but from a mineral reserve and resource reporting space or lens, and I'm going to lens into SAMESG specifically. However, as part of the journey and discussion for the next hour or so, I'm going to also think and talk wider at times. So be prepared for a bit of mix and match, and I hope it addresses queries and content you're looking for here. Okay. So there is an ESG landscape out there. You're probably familiar with some of these concepts. And if you practice in my space, you're probably familiar with some of the bullet points on the left-hand side. Global Reporting Initiative, ISO 14001, JSE or JSE Sustainability Disclosure Guidance. And knocking on my door every day is the International Sustainability Standards Board that are developing sustainability disclosure standards, i.e. the stories and messages we need to tell about our business on how we think of and manage ESG stories in our own landscape. Some of the things that also tap into my language here is that the reporting codes and disclosures that we dig into or get our hands dirty with, they're not only related to SAMCODES or a Southern African context, but they do touch into the Canadian space, the Australian space, the new project sort of Crisco space, and PERC. And so you may or may not have had some sort of introduction to these today, but I think part of the messaging here around me is that if you work in a multiple jurisdiction kind of space, or you disclose to multiple listing requirements, then you're probably likely to see some more of these words crop up here. And the ESG considerations around these, from a reporting point of view, may be different, but from a conceptual and application point of view, a lot of overlap and a lot of struggling with the same challenges. But if I bring this closer to home and I talk about what we see and you've possibly already heard of in the South African space, I think 3 key ESG things that are very applicable in any resource and reserve kind of process is your social and labor plan, your environmental management program report, and financial provision for closure. And what I tried to do there was give you an ESG in something that is very topical as part of a mining permitting process, but recognizing that this may already be considered in work that we do around a reserve or a resource, certainly an asset that is a going concern. You know, these are required before you could even break ground. And so maybe ESG is not so scary, even though the landscape is big and it is changing. And then, of course, I wouldn't be doing my job as Vice Chair of SAMESG to say, watch this space, something exciting is happening. We do have a guideline on how to consider these things in a reporting space. However, the exciting thing is that this guideline is being updated. So not only do we have existing guidance that should be taken into consideration around all reserve and resource disclosures, it's going to get better. And I believe it's going to be more responsive to the challenges that we're seeing out there in this ESG landscape. I think it's going to be nice and user-friendly because there is quite an integrated group of people and specialists working on this. And I think it's going to speak to some of these new buzzwords that we see coming out here, whilst keeping us in a comfortable space around things like social and labor plan, EMPRs, and closure-related provisions and disclosures. Okay, I don't want to step away too far from ESG, and I want to make sure we all have the same understanding and the same foundation. E is typically environment, S is typically people, social acceptance, community, safety, human rights, security, and people within your workforce. So HR, typically HR related issues. So with that in mind, I want to just quickly elaborate on G. G is quite topical at the moment. There's a lot of debate about what G could mean in a reserve and reporting space, and how far do you go, or how close do you keep it? And the chats that I'm kind of hearing at is, as a minimum, keep it project specific, keep it target specific or asset specific. You're welcome to go broader, but keep that which is very relevant to that asset or target. Keep that on your mind and in your disclosure space. This landscape is changing. There is a lot of overlapping and duplication in considering this in the work that you do and how you report around it or disclose around it. And really some of the big challenges are those like 5 points at the bottom of the slide, where we talk about what is material for inclusion. There's a strong materiality consideration. I'm sure you've touched on it. How do you apply this in the ESG space? Where's the guidance? Where's the practical examples? What is in and what is out? Sometimes there is there's professional experience and knowledge that needs to be applied in these instances, especially when you're dealing with things like people or human rights, security. What is happening in an industry space? Are there working groups out there? What are they tackling and how are they dealing with it? What does it mean for us, or what could we learn from it? I spoke to you about other reporting codes that are tackling similar ESG considerations at the same time as us in South Africa. And I'm going to dip into that in the next few slides to show you where we're all landing. And the point is we're all landing in a very similar space. E is E, S is S, and G is G. A big challenge that we're finding in this space is that competent persons, what is their role in the related ESG disclosures? What do they take accountability for and what don't they? And what does this mean for subject matter experts? Or what do you call people who contribute to your report if they come from an ESG space with very limited environmental related qualifications and certifications out there to support this process? And then lastly, a challenge that many of us deal with is that we may have an asset that forms part of a bigger business, company, or a range of assets. We may have other disclosures out there which is relevant to our business or our target or our asset. And we, of course, as we're talking about today, need to consider things like environmental, social, and governance factors when looking at a target or a reserve and a resource. And what does that integration look like? What sort of runs side by side? What sits over here? What sits over there? And where do you kind of integrate it and blend it into your report quite nicely? I feel the guidance does provide for that. And this new improved guidance, I've had a sneak peek into the process, so I can say with confidence that I think it's going to, like I said earlier, provide an even better platform for applying these considerations when you are looking at your reserve and resource reporting requirements. And of course, determination requirements. It's not just reporting. That's really the end point. Okay, so slightly boring slides, but really just to get the point across. ESG typically includes all aspects of sustainability. I use the word sustainable development. It includes things or terms that are hard to define to an ounce, a carat, a cutoff grade, things like social license to operate, risks, stakeholder perceptions, and those kind of things. But just because we can't define it, in my opinion, as accurately as you can define other elements, doesn't mean we can get away from not applying it in what we're doing and when we're looking at targets. So that's just a bit of a caution out there. It's big, and you've got to work with someone who knows what they're doing in order to help you apply it. Environment is very biophysical. All right, it's the surroundings in which your project exists or your operation, and it's kind of things you can touch: air, water, surface and groundwater, of course, both of them, and how they interact with each other, and chemicals in the lithologies or the geology, land, natural resources, fauna, flora, humans, and their interrelationships with these biophysical aspects. I think this is a nice, comfortable space to define. I think scientists are happy in this space, and it works well. You're getting into a bit of a more difficult area to define very easily, and that's social. And that's because we're dealing with people, and people who are interested, impacted by, contribute to, or benefit from a project or a target or a resource in almost any kind of way. And so when we look at people like that, we would want to look at people's lives, the impact on their lives, their livelihoods, what they may do in an area close to a project that could be enhanced or depleted through those project activities. A social and labor plan initiative is an enhancement opportunity or example. How people organize themselves internally and externally to your project. So that includes, if you wanted to look at the big view of G, organized labor, cultural heritage, that's people and things that are important to them, which is largely biophysical in a South African context, but most certainly not only biophysical. Health and safety, I think in a South African mining context, you cannot talk mining without talking about safety, and a strong commitment to the safety and well-being of your employees and those communities who live around you, and other third parties that supply into your business, and then any other people sort of influencing or benefiting from your targets. And whilst you could argue that they may not be mining the gold, you may not be impacting on them directly with dust or something like that, I think what you've got to consider when you're looking at the social aspects around a project is that there is an influence that could really challenge your ability to successfully extract your product if you don't get on top of these social matters, or if you don't provide for these social matters, or if you don't identify potential risks or costs. Because I think that wouldn't be a true consideration then for what it means to take your resource out of the ground without considering what a social and labor plan might cost, or what non-compliance to something related to a health and safety concern could do to your project or your business if people had to protest, or you had to have a Section 54 issued and your facility had to be closed down. Governance, like I said, is the hard one. We are kind of straddling the space a bit, and we're figuring it out from a mineral reserve and resource reporting perspective. It's not that we don't know where governance could start and governance can finish. We don't know what the right application is at the right time that everybody is consistently and comfortably applying and agreeing to. And so that's why it could be very big or could be very small, and it could also be influenced by the nature of your target, the nature of your organization, and your jurisdictional distribution and site context kind of factors. So the view that we take from a sort of practicing point of view as we consider governance is we look at it as being project specific. So for example, something that the head of your project would be expected to know about and be able to manage or influence in that ambit of the project. And my great example around this is a risk management system. That's a great example of saying we have a risk management system in place. It gives us the opportunity to identify potential risks to targeting this resource, processing this resource and selling it as a usable product. And we have ways in which to consistently and transparently and comparably mitigate or manage these factors and report against them for our own internal purposes. And so that's my suggestion to you when you think about governance, is to always look at it as a minimum from a project-specific or target-specific context, and then decide how far would be appropriate for you to go, or how wide it would be for you to go. And that's just a little bit of an elaboration there. Sorry, I don't think I jumped through that fast enough. Okay, so that's it. That's ESG, that's the changing landscape, that's kind of the context in which our committee exists. But our job, quite simply, is to integrate all of these requirements into the mineral reserve and resource reporting process. And using this, we use a whole lot of guidance in place. Our committee, and that's the one that I'm vice chair of, and sort of aim to act as facilitators, are well established. They have a terms of reference. They have members who participate in this process, and it's a nice, diverse, and hopefully inclusive group. And there are obligations around how we govern ourselves and how we deliver into this space. And so, like all working groups and committees, we take our lead from SAIMM, GSSA, they're our sponsors, and of course what the SAMCODES agenda is and how we can contribute to and support into that. But I guess our ambit is around the ESG component, and it's been known as ESG or SAMESG for a long time now. So that kind of content or focus area, I think, is well understood, and the normal steering committee health and discipline processes are undertaken by doing things, for example, like reviewing terms of reference and regular meetings and that kind of thing. The other thing we do is we don't just look at putting ESG, ESG into reporting, but we look at other things too. We look at things that are topical in the ESG space that could cross-cut against all three, link it to other areas, and see how that influences the work that we are considering and looking at today. And I've just stolen this slide out of some planning we were doing for our 2023 steering committee to give you a sense of the kind of proposals that we're saying are relevant in this space, but perhaps you wouldn't think of directly, but rather more indirectly from a reserve and reporting space. And that is maybe another show of hands. It'll give me a good sense who I can ask questions of. Who's heard of the task force for climate-related financial disclosures? So not nature like you see on the screen, but climate. May you use a show of hands, obviously your virtual hand, just to give me a sense of who's heard of this. So this is climate, Paris Agreement. There we go, thank you. There's one person who's got their hand up. You've heard about this task force for climate-related financial disclosures. So basically this task force says that, thanks Tanya, there is stuff happening out there in the world. Climate change is very topical. Decarbonization and mitigating the impacts of climate on the global environment and industry and society is very important. But also investors want to know what it's going to cost your business or your targets. So I provocatively put task force for nature-related financial disclosures, which is in a beta development phase. So nothing we need to worry about today, but we have to know it's coming. But what it's saying is that investors are saying, we know that there's stuff happening in the E space or the S space or the G space. We think it's got an impact on your business, and we think that impact is financial, and we want to know what it is. And so by understanding these kind of things, I'm giving you a sense of some of the things that are really applicable in reporting, but more importantly, how we aim to keep abreast with what some of these influences are and where they may need to tap into the work that we're doing. Tailings is also quite a critical one, but of course has always been, there's no doubt about that. But I think in the tailings space, we've seen this global industry standard that is being expected to be applied by many mining companies out there. And that too comes with a real range of governance, engagement, and other ESG requirements. and could materially impact some of your financials or your life of mine financial modeling for a target or a resource when you consider some of the mitigation measures you have to put in place, like maybe a more expensive tailings dam if compliance with the code is a priority. And then some cross-cutting themes. These sound like big, difficult concepts. They can be, I must be honest. You really need to work with subject matter experts around this, but it just shows you that you can't ignore things like human rights, access to water, sanitation. You can't compromise that when you develop your project and want to put in a road that could compromise a community's access to water that they depend on for their livelihood. Artisanal and small-scale mining, you've got to consider that you may have a target in a place where artisanal miners, small-scale miners, or even illegal miners could negatively impact on the security or the land tenure that you have. Diversity, equity, inclusion, things like social and labor plans and mining charter requirements are looking at a more inclusive workforce that you also need to take into consideration and recognize that you may need to manage differently, and that may have a financial implication. And then, of course, the example I gave around climate mitigation. We also contribute to shared member resources on a website so that we can tap into each other's understanding of what's available and what's out there. And that, of course, links into the SAMCODES webpage. So there's a range of information available to support us as practitioners and those who want to tap into or work with us on the steering committee to advance our mission of integrating ESG into reporting. And then I suppose my last point, and I'm just going to quickly jump ahead here, I mixed up a slide, but I did tell you that there is guidance available. You probably need the help of an expert, whether it's a consultant or a contractor, but someone who's got some experience in the ESG or ESG space to support you in this. But this guideline is being updated, and I've cheekily called it SAMESG 2.0 as the update that's being worked on at the moment. And when we were trying to understand where the opportunities for improvement were and for simplification and more relevant practical application to guide users to deliver, what they think is a great product, we felt that there were some key issues that needed to be considered. And this was some of the early guiding principles in updating the guideline. Defining what ESG is. People need better guidance. They need to recognize where the cross-cutting themes are and what they look like. What is prescriptive and what is guided needs to be clarified. What about materiality or salience? And what kind of judgment is appropriate in these circumstances? And what exists out there from an industry perspective? We also recognize that the way in which the guideline is updated and how it feeds into the existing reporting codes and those requirements was quite important. And so a lot of recommendations from quite a wide range of stakeholder exposure and questioning through an ESG inquisition recognize that there's certain things that we really need to keep into consideration around the reporting codes when we do look at the guideline update. And then some minimum common denominators for reporting. These exist. Companies, targets, assets, people who seek permits and licenses are dealing with this already. And don't forget that there are strong ESG or sustainable development requirements in these programs. And it kind of means that you're already working towards it, even though they are mandatory or obligatory. And those are the Mining Charter 3 requirements, your social and labor plan, which is important for a permit, your environmental management program report, as well as your closure provision and rehabilitation trust funds. You don't get a permit without that. And then other things related to BEE arrangements, CSR or corporate social responsibility or investment arrangements, and any other latent and residual risks. They're there, they're built into the processes, and perhaps people don't always connect the dots that this is ESG in action. And then, of course, it does go beyond South Africa. There are well-known global initiatives that investors are expecting to see some visibility around. I gave you the climate change example. Depending on who your investor is and what their priority is, they may have a different expectation on you and your resource than another. And then just some other sort of peripheral aspects to consider to give us a nice rounded view. But what was very obvious when we started the guidance update was that the why is obvious. And so that's just something to remember, is that it doesn't really matter what your view may be. It seems that the why is obvious to many people involved, but the message is that we can't really escape it or avoid it. So that's something to be very prepared for when engaging in this pipeline and doing this work. And that, of course, applies to the guidance update, but obviously to the guidance that's required when you do the work. So that's my little slide. That was in the wrong position. It's just to show you that there is a process in place to update the guideline. There are key activities happening, stakeholders that are being engaged, code, evaluation, and other considerations that are also being linked into this process, and opportunities to support it within the SAMCODES, let's call it family of committees. So I'm glad I've seen something in the chat pop up while I was talking, which is great. I think that's perhaps an opportunity for me to also pause all my speaking for the moment and maybe open up the floor and see if there are any questions, points of clarification, or even comments, which would be really valuable in this process, and I'd be very happy to field or take. And I'll find a nice slide to rest on and see if we end up going back to any of those that I've discussed. I'll do it on this one because there's a picture there. Okay, Bruce, you've put a question in the chat. Would you be happy to repeat it and we can maybe kick off with you? I'm not sure if it's a question or comment. I can't really talk and read to myself at the same time. So I would definitely be grateful if you could do that.
Really, it was a question, and it comes from having sort of grown up in areas where there were no communities around mines. So my question is, where do we draw the line when communities endlessly move and surround new projects or existing mines because of government failures? And if there's no kickback, then miners will endlessly be forced to take responsibility for the growing communities. And what are the mining companies then thinking about all the royalties that they are paying over to governments?
Yeah, so that's a big question. And as important as it is to determining your resources and reserves, I think it also goes like way beyond. But just some thoughts or perspectives from my side to consider. You obviously have your minimum legal obligations and requirements that have to be met. I don't think mining companies should be expected to play the role of government. That's obviously government's role. But there certainly are in things like social and labor plans, which are updated and renewed every 5 years. So they're quite live documents and would be responsive to a changing social landscape, fortunately or unfortunately. But you know, they would have to take this changing example you spoke about, where there's influx into a mining area. These social and labor plans expect a commitment to things around local procurement, local development, local training and opportunities, more inclusive representation, and local resource use and all those kind of things, and perhaps aligning agendas where mining companies may be expected to do something, aligning that with the local development priorities of the area, where as a minimum being a catalyst and as a maximum maybe facilitating some of these opportunities. I think what we're seeing in mining, and that's certainly been my experience, is that host communities are often, and I note your point very clearly that they do evolve, they were not perhaps there when you started. Host communities often bear the impact, certainly the biophysical impacts like dust, traffic, those sort of things, of mining activities, and are often the least to benefit, or traditionally have been one of the lower beneficiaries rather than one of the higher beneficiaries, because of things like extensive royalties being paid but not reaching those closest to the mine. But our experience has been that those closest to you can also become allies, and that you could create opportunities where both you and your host communities, where there are opportunities for benefit for both of you, and where these communities can then become an ally and support you and help keep your doors open under difficult circumstances, because they feel that there's shared value with you being there. And an example of that is procuring through or from your host community or your greater host community area, where some kind of economic stimulation could happen through this, or employing through that. Now, some of these examples you may think are great stories, nice flagship projects or examples, but maybe unicorns and rainbows in your context. And so it might not be easy to apply this and be successful in every space. I won't argue with you there, but I think it's a recognition that there are perhaps some things you can't avoid, and maybe there's an opportunity to shift it around and look for other ways in which it can become more beneficial rather than challenging as an opportunity there. And if not, another thing is always just disclose. I think I've even been surprised when I truly understand some of the value that is given back from mining to a government, within a community, or within an area. And even your social and labor plan points some of that out, like, really easily. It's actually quite phenomenal. And we don't often think about it that way as a layman, I think, when it comes to mining. I'm not suggesting I'm speaking to laymen either. But when people know more, I think sometimes they may understand better. But South Africa is a very complex socioeconomic, space, and there's always going to be this demand for support from whoever can give it, I think. Kevin, your hand is up. Do you want to compliment Bruce, or Bruce, would you like to pick up further?
No, thanks very much.
Charlene, hi. No, I was going to add to what you were saying to Bruce. I'm aware.
I thought so.
Yeah, I was aware of a situation. I won't be specific, otherwise it's obvious. Where the local community is of a different tribe, talking within Africa, not just South Africa, than the governing political party. And accordingly, they're always sidetracked. And so as part of getting the local community on side, after several years of negotiations, there was agreements with government that a portion of the royalties can get paid to the local community's action committee, per se, with proper governance being controlled by government. And that works twofold. It reduces government being, or the perception that government's anti this local tribe, who are, effectively electorally disenfranchised. But it also solves some of your labor plan, because suddenly you are visibly giving back to the area and the community, rather than it being channeled from a department of a central government. So, there's 100 ways to skin a cat in this landscape. And the more the mining companies all give their ideas and share it, the actual better it'll be. But while everyone's still continuing to say, oh, this is an advantage, it's not an advantage. It's not a competitive game, because you're not mining at the same community. So, it is a shareable event that can work.
Yeah. And I think the reality, Kevin, is a general manager or a head geologist these days are spending their time and their effort and some of their budget on non-geological or processing or infrastructure related work for, to get that carrot out of the ground. The reality is that the mining space is changing. And so, you have to spend time around this and ideally find ways that, you get a shared value out of it. And I don't mean to sound cliched, but I mean, shared value, I think, explains it quite nicely, where the same activity benefits more than one person or party.
Yeah, and sort of so it's on the social side, it's trying to work out, as Bruce was trying to say, where does it stop?
Yeah,
I'm aware of another situation where a mine was being developed in the DRC, and people were blind in that, as they were developing it. So the trucks bringing in all the equipment and so forth were driving on the regular roads, and eventually, after 3 or 4 years of the building of this mine, the HIV infection along that road was far higher than anywhere else in the entire country. And eventually a different road was built that bypassed all the villages as part of assisting in the reduction of the spread of disease as a consequence of a mine being built. You don't think of all this as you develop the mine, but they are the social costs are more than just the local community. It can impact far wider than the area in which you're operating.
Absolutely. And then part of the challenge is also, how do you put this down on paper? How do you account for what you think could be a challenge or not on your life of mine NPV model? How do you do this? What are your modifying factors? How do you measure them? How do you assign a value to them? You don't always necessarily have to, but there's also a challenge there to bring this down. And some things are very easy, like the cost of energy or renewable energy, but some things are harder in that is space.
Yeah, I'd say one thing on your slide that you've got on the screen that really winds me up is financial provision for closure, because it took me more than 5 years before I retired in my previous employer, that actually closure commenced at exploration. And once you start doing damage as a consequence of the exploration, you must fix it. So it's not closure as in, well, we didn't develop a mine there. I don't care. You damage the environment as a consequence of exploration. It's financial provision for mining or extractive or whatever the right words are, operations from exploration, not at closure.
Especially from a non-greenie. Thank you, Kevin. Tony, you've got your hand up.
Yes, I just got a few comments that maybe might help in the discussion, hopefully, that, if you're trying to measure materiality or see that provisions are being made in the company or the project that you're evaluating, is really a couple of things. Do they have a stakeholder? Have they done stakeholder mapping? And are they updating that on a regular basis? The other part of the puzzle probably is a risk register. Do they have a good risk register that is realistic, that isn't rose-tinted, and is really looking at all of their risks? And then the interaction of those two is really the management of the social risks that become apparent out of the process. And, one of the things that is not always apparent to technical people is that there is a way of managing the social environment in a way. You can manage it under the same sort of principles as technical risks and technical issues. You just need to manage it. So then from that, if you're evaluating a company, if you've got some of those and obviously some other elements in place, especially along the governance side, then you can start to get some idea as to whether there's any issues there in the understanding of their risks and their social landscape and the potential materiality of those. But I agree totally that putting a value to it is quantifying it and not having it as a qualitative assessment is really, really difficult.
Yeah, and I agree fully. I think you put that together nicely, that local context and knowing how big and wide you need to go or appropriate you need to be, and how that interfaces with your business, your target, whatever you're looking at is critical. And if you can translate that into risk or opportunity or conflict, I think, and you know that you've got an idea of how you can manage it, I think you're more than halfway there. And you can use tools like materiality to indicate importance rather than just the NPV or the financial provision for not closure, but exploration and mining. But thank you. Yeah.
So it's more a risk assessment really, rather than a qualitative process.
Yeah. And in my experience, the tools you use to manage a risk like energy security, like the risk tool, or to manage something more like, let's say, risk to native title. That's an Australian example, a heritage or Indigenous peoples concern. It's the same tool. You put it on the same matrix. So, you know, you don't have to run separate systems in your business to try and figure things out. So yeah, I think that was a great grounding and reminder that it is actually what we do, and we can do it.
Yeah.
Thank you, Tony.
Okay.
The next hand that I see up is TCATS. So I can't use your first name because I don't think that's your first name, but please correct me if I'm wrong, and please go ahead.
Hi, it's Bishop.
I thought so. Hi.
Yes. So I have a question in regards to like environmental implications. So I'm new into this, you know, resource estimations and exploration and landscape of geology. So now what happens now in a case whereby I applied for a prospecting right, and then due to some internal, you know, fights and like community issues, I cannot start doing my exploration. Yeah. So now the time when I come back to try and do the exploration, you find your illegal miners who have done big excavations and they're left open, they're filled with water, there's big waste stockpiles. So now I'm exploring with intent to mine, but now the environmental liability that comes with the damage that was done by other parties, how do we deal with that?
So first of all, the easy part of my response is that you've identified some great E and S components there that are at play. But it sounds to me that there's also a land tenure link. And there's probably a very legal interpretation of what your liability is, and very legalistic and perhaps even black and white. And then on the other side, I guess your real challenge possibly is a legitimacy, because I bet that those miners who've come in or prospectors, whilst you'd step back, also feel that there's a legitimacy there that they have entitlement to this land. And so, you know, I'm not even sure I could solve that problem. There'd be a range of sort of legal and government and tenure related issues that would need to come together. But also, I would have to say, without understanding the dynamics here, that there's obviously a people element where there has to be engagement. But if I knew that that was a possibility in my space, I would look to my local community to see if they could help secure, like, the legitimacy, not the legally, but the more acceptable way of securing a target, or being an ally because of potential benefit to them in securing that target going forward, rather than either they themselves being a competitor or allowing, and this is what I've seen a lot in African jurisdictions, allowing foreigners, like not from that area, and I mean that term very loosely, coming in and exploiting a resource that could bring more value. But that's not a quick and easy answer, and not a quick and easy solution either. You know, I think there's many avenues that would have to be tackled all at once, including a strong government relations and community relations and competitive relations and legal sort of avenues that would need to be tackled. Kevin's hand is up, so I'll jump to Kevin, and then Tony, if you'd still like to raise a comment, please do.
Following on something else Tony was saying, you said during the presentation that governance is one of the things that's a real tricky thing to come up with a workable definition. I think the more impossible one is actually materiality. Because, you know, I sit on a page where I'm really left field. There's no such thing as I materially complied with the law. It's black or white. So, you know, there's a $20,000 US fine if I don't comply with this section on the mining license. Yep, non-compliance with the mining license is a huge governance issue. The $20,000 fine might not be material, but you've got a governance problem. So I think materiality is going to be the big one to try and conclude, because I think we'll end up in some manner or form in saying it doesn't exist. It's all material.
Yeah.
It impacts your host community, it impacts your government relations, it impacts your social license to mine.
Yeah.
So I think materiality is actually and I know that's going to in the ESG group, that's my problem chart. But at the moment I'm sitting in the page, I think it's definable. I actually don't think it's workable.
So I feel I have a I don't want to say a workaround or a counter, and I don't want to disagree with you. It is complex, but I would say that if I was trying to tackle it, I would do two key things. There is a lot of guidance out there in sustainable development type disclosure frameworks that basically say, in this context, I would expect you to consider materiality this way. And they may even give examples or further guidance on what they would expect to see for a gold mine operating in a West African country, for example. Maybe not that specific, but there is some guidance out there, okay? And it may not, the guidance certainly wasn't developed for use in this context, but I think it definitely is guidance that can be adapted or considered. The other thing that I would say is, Kevin, don't ever do this on your own. Your view is great, it's fantastic, but you need to have multiple parties influencing that process. And multiple parties could also extend to, literature, documents, guidance, and things that are published out there, or other thought leaders in this space or something like that. But the point is, Charlene shouldn't do it on her own. And neither should Kevin. But if we have a nice sort of diverse group of stakeholders, even within a mining company, you'd probably get a much better outcome. And then lastly, be transparent about how you got to that process. And I would never want to stand up in front of the SEC and say anything like to try and defend something that's so qualitative or can be. So I understand, I'm saying some nice things, but when you actually have to do it or defend it, it might be a lot harder. But be transparent about what you use to consider materiality. And if you say your materiality is only a financial threshold and it's only $100,000 or more, then just be absolutely consistent and transparent around that. Because I think that helps those external stakeholders, including investors and permit holders and local communities, in some instances, to get a sense of where their view of materiality may be different to yours, or yours may be limited. And they would have an appetite for that risk, or they wouldn't. But be transparent in your disclosure around that, if you can.
I'm totally on your page. It's actually literally trying to find one that works, because it's so difficult in this area.
Agreed.
It's not just being an accountant. It's easy to come up and say 100,000, 200,000, but 200,000 in one company is probably life-threatening if you're an emerging
absolutely
explorer. So it is a problem child.
So let's not underestimate it to everyone on the call, right? Like, don't take this lightly. You'll struggle otherwise. Okay, Tony's hand is still up.
Can I jump in
Tony.
then?
Perfect.
Materiality as well should probably also be thought of in terms of time constraints on a project. So, for instance, you can have something that's material where it's actually a fatal flaw for the project. It's not going to go ahead in terms of time. Certainly not in even the usual kind of project timeframes. So you might have some social issue that completely kills a project. That's happened a number of times here in Peru. You can also have projects, you can also have materiality that puts significant delays on the project. So, I think from the perspective of analyzing a project or doing these assessments on projects, one should be looking to see whether the company is actually identifying some serious risks, and it is taking a realistic, let's call it a realistic view of their risks in this space, and whether there are signs that they are trying to manage that risk down.
Yeah.
The other comment is that a lot of risk comes from communities that are excluded from the project. So what we find here in Peru is that communities that are actually outside of the direct area of influence, sometimes even beyond beyond the indirect area of influence, want to be involved in the project and are prepared to fight for it. So, and they do fight for it. So the other thing is, of course, is when you're in the scoping phase and you're doing your analysis of alternatives for different parts of the infrastructure, it's super important to be completely aware of the social context of that as well. Whether you build a pipeline or you build a road, a pipeline's less difficult to interdict by communities than a road. It's easy enough to block a road. So very early in the process, there are technical solutions, potential solutions, I should say, that can be looked at through the ESG lens.
Absolutely. I feel you've given a great taste of how complex this can actually be, and how I would really encourage anyone working in this space to have a strong feel for what you don't know, and bring in expertise and rely on whatever resources are available to you, free knowledge kind of resources, to make sure you tap into this and have a longer term view as well. I think there's been some great examples of this coming up here in the discussion. I also think it doesn't sound like you're on a mine, Tony. I heard like beautiful bird sounds in the background, and I'm feeling a little bit envious because I'm at my desk.
Oh, I'm in Lima. I'm not on a mine. I'm in Lima, and we've just it's a desert environment like the west coast of Africa, and we are busy with a cyclonic environment at the moment. So we have rain, amazingly enough, in the desert. So there we go.
Fascinating. Well, thank you. It does sound quite relaxing to me, but clearly it's not.
So I'm going to be talking about the competent person. And probably the first thing to say is that before we even get to the definition, the signing off of resources and reserves is the function of an individual natural person. So you or I sign off, our company that we work for doesn't sign off, and they don't take responsibility. So we've got to make sure that when we're signing off that we are competent and that we're happy to do it, because the consequences can be quite severe. But we'll discuss some of that as we go along. But in terms of SAMREC, and this is a Crisco definition as well, a competent person is a person who's registered with SACNASP, EXA, South African Geomatics Council, or a member or fellow of the SIMM, GSSA, or the Institute of Mine Surveyors of South Africa. So let's go through those abbreviations first. SACNASP, obviously a professional natural scientist. EXA is a professional engineer. South African Geomatics Council is the body that surveyors are registered with. SIMM, Southern African Institute of Mining Metallurgy, Geological Society, and the Institute of Mine Surveyors of South Africa. So those are the 6 organizations within South Africa that we consider competent persons. We'll get to recognized professionals in a moment. So those are the South African ones, and we have recognized professional organizations. And the important aspect of this is that one of the tenements of all of the reporting is that the organization that we use as our professional organization must have an enforceable disciplinary process, which enables them to suspend or expel a member. Obviously, that's quite dramatic, but that is a requirement. And when new countries or regions come on as members of CRISCO, strangely enough, that's actually the most difficult part of their membership journey. Then when we look at the recognized professional organizations, there's a list that is promulgated by the SSC, and that's kept up to date, and it's regularly, the organizations on that list are regularly reminded or queried to make sure that they are still the same organization and there are no dramatic changes. Obviously, a competent person must comply with all the necessary acts, and from a science perspective, we as natural scientists are required to be registered with SACNASP if we're practicing as geologists. So the next aspect of the definition is that a competent person must have a minimum of 5 years experience relative to the style of mineralization and the type of deposit under consideration and to the activity he or she is undertaking. So 5 years experience, it's not 5 years experience from graduation. You need the experience in the type of mineralization and type of deposit. So that's quite broad, and in the activity that's being undertaken. So if it's data collection or exploration management or geological modeling or mineral resource estimation, one needs the experience, the 5 years experience in that activity. So that's important that that's fully understood. If the competent person is estimating or supervising the estimation of mineral resources, the relevant experience must be in estimation, assessment, and evaluation of mineral resources. So it's important that the relevant experience exists. And the same goes for mineral reserves, obviously. So competent person, whether it's for mineral resource or mineral reserves, the same applies. Now, one of the aspects of the code is that the person called to sign off as a competent person must be clearly satisfied in their own minds that they're able to face their peers and demonstrate competence in the commodity type of deposit and situation under consideration. So that's a really important aspect, that a competent person must be prepared to defend themselves with their peers. So these are the three aspects that we consider important when considering a competent person. The first one is obviously the accreditation, and I've gone through those. The next one is that the organization must be self-regulating and covering professionals in the mining or exploration fields, or both. It must admit members on the academic qualifications and experience. And it's quite unusual in the world of competent persons that we've brought the surveyors in, and that's because of the history of mine surveyors signing off and determining all resources and reserves historically on the mines. And their qualifications, and no doubt, in my view, mean that they fit that bill entirely. The organization needs to have a professional standard of competence and ethics and have disciplinary powers. So that's the organization to which we belong. And all of those that I've mentioned certainly have all of those in place. As I said, the experience, minimum of 5 years, relevant experience in the mineralization, type of deposit, and the activity being undertaken. So these are the organizations that we've looked at. And obviously, 3 of them are statutory. So SACNASP, EXA, and South African Geomatics Council are statutory. The other ones are learned societies. And this is the list of recognized professional organizations. There are approximately 30 of them that we recognize. And many of these countries, there's a reciprocal situation with the other country. So for instance, we would recognize people from Canada and Australia and Chile and the like. So there's a reciprocal situation from that. So we can sign off on JORC and some standard determinations as well, or estimations as well. So it's important that we know which those are. Now, Charlene was doing with a hands up, but can we perhaps possibly try that? Who belongs to which organization? So who would be signing off on as a from SACNASP? If you can put your hand up. Okay, fantastic. So thanks for that, guys. You can put your hands down. So there are a lot of us that are in that situation. Now we're going to go and look at a bit more detail. So the relevant experience is a really important aspect, and I've said it must be in the activity that's being undertaken. And in a moment or two, I'm going to talk about lead competent persons. So the situation can be that you sign off as a competent person on one aspect of resource or reserve. So that would be, well, in a resource space would be, whether it's estimation or geological modeling, whatever it is. For a reserve space, it might be as the metallurgical engineer or the mining engineer. So all of those aspects, it's very seldom that, especially for reserves, that a person would be signing off on all aspects of the reserve. I think that very few people have the necessary qualification experience to do that. And once again, one must be prepared to face one's peers when one's doing that. So probably the best analogy that I can find for a competent person is in the aviation industry. And the reason I put this up is that when I said 5 years relevant experience, one can be a little bit blindsided. That says that if I've been working on a gold mine for 5 years, I've just become competent and I change job and I work on a coal mine, what experience do I have? Do I have to start from zero again? And the answer is really no. It's a matter of converting from one to the other. So let's look at the aviation industry. People who learn to fly generally start off with a private pilot's license, which is 40 hours of training, and then they are allowed to fly a private plane, and generally that's a single engine propeller-driven aeroplane. And as they progress, they'll do a whole lot of other qualifications, such as night ratings, multi-engine ratings, instrument ratings, and they will also start to learn different aircraft. Now, if they go and move on to a different aircraft, they don't go back to go and learn to fly again. They they take what they know and they go and learn what's happening. And that also, there are regular checks and updates for pilots. So they do medicals on a regular basis, and many times they will be checked on a regular basis. So that's how they work. Now it's similar to us, like they don't have to move from one type of airplane to another and go back and start to learn. We don't, when we change from a deposit or commodity or activity, that we don't go back to university to study. We have learned a lot of stuff along the way, and we can use that. And probably the aspect there that is important, the regular checks and updates, that would probably be what we would consider CPD points. So with us, we have a basic qualification, and we build our experience as we move along. And so if you've gone and been involved on a Wits gold mine, and you've learned a whole lot of stuff about being about gold and the sedimentary environment, and you go and work on a coal mine, there's a lot of sedimentological information and understanding that you would take along with you. So I find that a really good way to make an understanding. But it does mean we need to have regular training and continue to learn as we progress in these fields. So taking responsibility for resources and reserves. So we, as I said earlier, we take individual responsibility, and it's one of the aspects that I would suggest if you don't know what your how you protect it from a legal perspective by your company, then one has to be just make sure that one does know. And SACNAS, for instance, does have a way that you can insure yourself your public liability. But let's look at it from a number of aspects. So the documentation must be prepared and signed off in under the direction of a competent person. So that's the documentation. The public report, however, so what's put out into the public domain, which is often part of what the competent person has put out, is the responsibility of the board of directors. And that should include the competent person's name. And well, obviously, there are certain situations where that's quite complicated to do. For instance, press releases, they struggle to do that really well. Interviews and where what's reported in the popular press, not all of that would be properly related. But it's important that when a formal declaration is made, that the competent person sees that formal release and then will approve it, so that to ensure that whatever's put out is in the right context. Remembering that our three principles are materiality, competence, and transparency. So making sure that all of those are put out. Obviously, some sponsors only want the good parts, and we need to make sure that that whatever's reported is balanced reporting. So it's good. It's important that it's signed off by the competent person, but before it is issued into the public. So the competent person is personally visible and liable, having been named, having signed and approved, having the qualification and professional status. The CP enters a legal space where they can come into contact with investors, obviously pensioners, widows, orphans, etc., to whom they now have legal and personal relationship on a par with that of the directors. So it's really important that we understand the responsibility. It shouldn't be something that terrifies one. If one has all the right experience and we've done the work really well, there should be no reason why one should be scared about that in the slightest. This is a picture of Harry Truman, and this is effectively what he said, the buck stops here, he had on his desk. And that was saying that he was taking responsibility. So that's just an emphasis of the importance of taking the responsibility for the work that we've done. Now, what are the consequences of having made a mistake or doing really good work? Obviously, the first one is extreme embarrassment. And I think that we've all made mistakes on some place or other, and been embarrassed to do it. And if we get called a complaint has been issued against a person, and then there are various sanctions that could happen. And it's not just to the moment you make a mistake that you should be barred from practicing as a geologist forever. No, a whole lot of other aspects. The work can be corrected. If it's a smallish mistake, corrected without any real issue. The work can be redone by the original person or by someone else. There may be a requirement for the person who has been cited to undertake some training or mentored in some way. Suspension for a limited time, obviously that's quite drastic. And the membership could be revoked permanently. That's also quite drastic. But I think most importantly, the situation is with even the minor ones where a mistake is noted and it is corrected, there's potential reputational damage. And that, in my view, is actually much more damaging than being suspended or a membership being revoked. And then even if suspension is for a limited time, when the person has done their time, it's not always easy to come back and be considered a professional afterwards. So this is just an example of not the way we should be looking for work, just standing on the street corner to do it. So that's just a bit of fun for that one. Now, I spoke about a lead competent person a moment ago, and fundamentally, the underlying aspect of this is that the work required, particularly for declaration or reserve, requires a team. And the team will include geologists, mining engineers, metallurgical engineers, environmental and social specialists, economists, accountants, a whole host of people. And it's, as I said, I don't think that it's a situation where one individual can claim to be sufficiently experienced in all of these aspects to claim 5 years relevant experience. So we have a team, and that team must have a lead competent person. So the lead competent person will accept a full responsibility for the report, but it's not a case of just rubber stamping what other people have done. Obviously, they need to apply their mind, and a lead competent person would typically have a bit more than 5 years experience, would have probably been in a management situation and the like. So they would have more understanding of what is required. So it is recommended that there's a clear division of responsibilities within a team. So each person would accept responsibility and in their particular contribution. And a way of making sure that that's highlighted is when the author certificate is issued, that the sections that that person is responsible for are highlighted. It's often the situation that the sponsors or the commissioning agent want only one name, so then they would use the lead competent person, their name, but the other people would still have responsibility for their activities. So it's important that the lead competent person has enough experience to evaluate the work that others have done. It doesn't mean they have to be able to do it, they just need to evaluate the work in a proper fashion. Professionalism, so one needs to act as a professional, applying a proper scientific and engineering principles. And as I said, we have the SACNAS, for instance, requires that we have the right tertiary education. Similarly, with the GSSA, there are requirements for educational qualifications. Now, I will talk a bit shortly about the new chartered professional in the GSSA. So that's an important aspect. Once again, emphasizing that we have an enforceable code of ethics in the professional organization, and a disciplinary code is process is required. So these are the laws that apply. So for SACNAS, it's the Natural Scientists Scientific Professions Act. For engineers, Engineering Professions Act, and geomatics is the Geomatics Professions Act. GSSA and SIMM have incorporated in their bylaws various aspects about binding membership to work as as competent persons. So these are the aspects of the Code of Ethics. If you haven't read them in the GSSA's Constitution and the bylaws, it might be good for you to do that. One of the aspects that is important is CPD, continuous learning. It's important that as one develops in one's career, one keeps abreast with developments and growth, and obviously CPD points allows one to capture that. So let's move on to a new development. And Tanya, if you want to step in at any stage during this, I'd be very happy to hear. So the GSSA has set up a new category of membership, called a chartered member with chartered status, and that's to promote the professional organizations globally and allow professionals to sign off on public reports as defined by the CRISCO codes. One of the aspects here is that there are some jurisdictions which don't recognize the GSSA membership as for reporting as recognized professional organizations. And this is an important way to make sure that that can happen. So the GSSA is a recognized organization and a member of the Global Geoscience Professional Group. So we need to understand the reciprocity between the different geological fraternities throughout the world. So it's important that as far as professional excellence is concerned, the chartered status represents a superior state level of professionalism and ethics, which employers and clients might demand from the people doing the work for them. It's also of international relevance as members of the SAMCODES. We're signing off on resources and reserves internationally, and we want to make sure that we have a reciprocity with other geoscientific organizations. Best practice is important, so the obligation to be a competent person globally is becoming more and more important, and we want to make sure that the GSSA is accredited throughout the world. So what is happening, and it becomes effective from the beginning of next month. From then on, the only if you are using the GSSA as your professional organization, it's the only category of GSSA membership for which you are allowed to sign off as a competent person. And it will also be the situation from the Johannesburg Stock Exchange. And obviously there's a period of learning how it works and a grace period until this time next year for the JSC. This applies to people who are fellows or members in good standing, and it's not applicable to student, affiliate, or institutional members. It's important that it's a 4-year degree or equivalent with at least 5 years practical experience as a postgraduate, 2 years of which were in a more senior role, and obviously submitting to the GSSA Code of Ethics and Disciplinary Procedures. They must be able to demonstrate their competence or by being with their registration on the CPD program for the previous 5 years. They must be conversant with the SAMCODES. And one of the important aspects, which is really nice to have, is that they'll be listed on the GSSA website, which is a public record, and that will include various aspects of what they're competent in. So it will be a good way to advertise one's competency, I guess. They will need at least 3 sponsors or referees, and they will obviously have to be approved by the GSSA Council. Application is going to be is online. There are various forms that need to be filled in by the referees. The status is for 5 years, has to be renewed every 5 years, and this is a way of making sure that, for instance, CPD points are valid. As I said, information will be available on the GSSA website. Applications are free, so it's not a case of any extra cost. It will be just a matter of the admin required to do that. The submissions will go through a peer review process with the chairs of the GSSA, the GSSA executives, the SSC executives, the chair of SAMREC, or SAMVAL, depending upon what's required, the GSSA representative at SAMREC, and the JSC readers panel chair. So they will all look at the applications to ensure that they can recommend them to the council of GSSA. So even before that, we've had a really good professional conduct requirements in the different codes. This one's for the SIMM, but there's also one for the GSSA, and also for the other engineering profession and SACNASP, land surveyors as well. So it's important that one is aware of what the different professional organizations, their codes of ethics, which is there to underpin our professional approach to things like being a competent person. Just a matching quote here. America has always been a country of amateurs, where the professional, that is to say, the person who claims authority as a member of the elite, which knows the law in the some field or other, is an object of distrust or resentment. So that's a quote that's saying, just be careful, you pick up a bit of flack by calling yourself a professional. Just a bit of fun once again. So an RPO, we have discussed what those organizations are, and they are almost identical to organizations that we have in this country, although in some countries they are government organizations. So for instance, in Chile, the members belong to an organization that is closely linked with the government, and it's very, very well managed from that aspect. But it's important that the self-regulatory admits members on their qualifications and experience, and has a code of ethics and a disciplinary powers. And when we talk to international bodies, we make sure all of these things are in place before they are recognized as a recognized professional organization. Previously, it used to be a ROPO, recognized overseas professional organization, and that was a hangover from JORC, where every country outside of JORC is overseas. But we now call those recognized professional organizations. Just to answer the question, is one competent? The important thing is, have you got the relevant experience? As I've said a few times, that the competent person, well, he's going to make his own judgment as to whether he is competent. It's not a case of getting competence confirmed before the time. With the GSSA and SIMM up until now, and the SIMM will still continue to do it. When you use the SIMM as your professional organization, there's a form to fill in, which is just to highlight to the SIMM that you are using their accreditation for a competent person, and it's a matter of just demonstrating competence. And that's required for each and every time one uses signs off on a report. Obviously, that the GSSA had the same situation in place, but now with the chartered status coming in, that will fall away with the GSSA, and people will be called on. They will be using their chartered status. Importantly, I don't know how many times I have to emphasize it, one needs to be able to face one's peers in the work that when one presents the signs off on as a competent person. I think we mentioned this morning. A site visit is important, and I showed you these pictures this morning about what you might or might not see. So it can be pretty disastrous in some cases, but always informative from my experience. So what does a competent person have to do? They must undertake or supervise all aspects of the work that is reported in the technical report, which will then be put into the public. They must be prepared to be challenged by their peers and defend the work that they've done. They must be prepared to be named in the public report and obviously accept responsibility because of that. They should approve a public report in the context for all public releases of exploration results, mineral resource or mineral reserves. And they must be prepare a detailed report to substantiate what they've done. So a competent person's report is definitely recommended, and they may well be held liable. And having said perhaps all the negative things, being a competent person and having signed off and developed the expertise is definitely an enhancement on one's CV. So the consequences of liability, obviously there are some aspects that I've highlighted from an administrative situation from the professional associations. One can be reprimanded, redo the work, do some training, etc. Suspension, expulsion, or reputation are aspects that the organization could do. But as I said earlier, reputational damage is really important. But having said all of that, it's possible that there could be statutory or a civil claim by the civil claims by, amongst others, investors who have put money into something and have had a loss. So that is possible. I don't have any recollection of having heard of any of those sort of consequences in the recent past. Important, this is all self-regulated. So it's not a case of writing exams to be accredited, certainly not in this country. The way in which people are brought to book is when complaints are filed. They need to be in writing. Those are reviewed by the SSC and passed on to the relevant professional organization for their attention. And hopefully, if there is a sanction or some help that person requires, that they can get that. Here are some examples. This is Goldfields. They made some life of mine estimates, and they put this out into the public domain. So in the red, this was in 2012, so it's a long time back, but it does emphasize what can happen. So they've highlighted that when they did some work, that they found that there had been a mistake in their annual reserves estimate, and that they'd lost a quarter of their reserves had been removed from the mine plan. So that is a sharp fall in their reserves, despite things like the higher gold price and a bull market and everything. So if the estimate is not done properly, there can be consequences, and I'm sure Goldfields was very embarrassed at the time about that. And you can see that probably what happened to their share price dropped dramatically at the time. This is an important aspect also from 2015, highlighting what the assumptions are that were used in a particular Goldfields resource and reserve declaration. They used a different price, a gold price in their resources of $1,500 per ounce, and for their reserves of $1,300 per ounce. So these are aspects of the declarations that can be put out as part of public reporting. This is an unfortunate one. Keaton Energy, they declared reserves based on a concept study. And obviously somebody pulled them up on that and said, that's not good enough. It needs to be a pre-feasibility study. So they had to retract it and change their declaration. So they would put out a SENS announcement, once again, embarrassing for the company. So not very good. Unfortunately, it's not always a situation where it can be how should I put it? There are external factors. So this is a situation where SAMCO Gold, which is in West Africa, Muddy Waters being an investment house, they publicly challenged SAMCO on aspects of their of one of their declarations. And at that stage, $2,000 an ounce was a very high gold price. And so they challenged SAMCO based on that aspect of their resource declaration. Now, it might well have had some merit at the time, but probably more important in this situation, it would appear that Muddy Waters was doing exactly that, muddying the waters. And so they challenged SAMCO, and the value of the properties were obviously considered overvalued, so they were devalued. So Muddy Waters could then put money into these assets and wait for the prices to rise, and then obviously that would be earn them some extra money. So that was an external situation, but one has to still be careful that one doesn't put out information that would obviously be challenged and put out into the public domain without the chance to properly defend it. So professionalism, I think it's important. It's the registration, behaving to the professional norms and continued professional development. And that would allow one to be a professional for a long time. As geoscientists, as I've said, SACNASP would be our first port of call for those working in South Africa. GSSA is now, as I said earlier, putting in place a chartered membership for reporting of being a competent person. Just to highlight that GSSA and SACNASP are very closely aligned. So two GSSA council members sit on SACNASP. I think SIMM also has a representative at SACNASP, and there's a assistance between GSSA and SACNASP for things like vetting process and for CPD points. That's the code of ethics. I'm not going to go through that in any detail. Important that if one is signing off, one has looked at the GSSA code of ethics. The SACNASP, as I said, is the legal aspect, and you're not allowed to practice in this country as a scientist without being registered with them. Just before I end, I think this is the last slide. If you're looking for the codes, there is a SAMCODES app. If you go onto your phone, you can get the SAMCODES app, and that will allow you to access all the SAMCODES aspects from your phone, so you don't have to carry any documentation around with you. I would recommend that you have a look at that and download it. It's very useful to have when you away from your office or away from your computer. At that stage, that's all I've got. Are there any questions at this stage? Joseph.
Thanks a lot, Ken. And I apologize, probably, the same statement said by Charlene earlier that we all speak English, but probably not speak English. The issue about competent person, I think it's something maybe you have emphasized that it's a relevant experience in the activity. So I just wanted to give a scenario, and maybe you can sort of maybe elaborate on it so that I maybe understand it much better. So considerations of a person, let's say in the platinum space underground, you have spent a few years in production and then a few years in the technical services, and eventually you find yourself on the desk of now being responsible for, let's say, estimating the ore reserves. So the activity that you mentioned to say it's relevant is the activity of estimation, not necessarily the activity that's associated with the mine planning activities that you have been working on, and or even on the production side that you have been on. If you can maybe clarify on that.
Okay, so that's a really interesting example. So what you're saying is somebody who's been on a mine, been through a whole lot of departments on the mine, ended up being in a senior position and asked to sign off on the resource and or reserve. So the great thing about that is that they've probably been through and understood numerous aspects of the geology of the deposit, the way in which the information is being gathered, whether by sampling or drilling or whatever. So they've probably got a very good handle on that. If they've had enough experience in modeling, that would be fantastic. So then they're definitely in a position to sign off on that aspect, assuming that that would be geological. If they're then signing off as a mining engineer, they would have all the mining engineering expertise and understanding and planning. But if they haven't done the actual run the software themselves, and they've got someone else to run it, they would, in my view, in all likelihood, be in a position to evaluate the work that's been done, whether it's the mine planning or the geological modeling or estimation. So in all likelihood, they would be in a very good position to be a lead competent person and have these other people do the work. They have a look at it, confirm that it is applicable, and then sign off. Does that make sense, Joseph?
Yeah, absolutely. No, thanks, Ken. I appreciate it.
Hi, Ken. A question trying to marry the competent person's requirements with the accounting requirements. Specifically, it's a hypothetical situation. You've got your lead competent person, but one of the jurisdictions in which the company operates, that country's code is not Crisco aligned. How would the lead competent person, would they have to send someone out from head office to there to do a Crisco aligned reserve resource declaration to include in the lead competent person's report? What do you do with potentially a reserve resource report that's not Crisco aligned in a lead competent person's report?
Okay, you've made it so vague, I'm not sure which country you're talking about.
I don't know of any countries that aren't Crisco aligned. That's why I made it so vague.
Okay, okay. So then let me jump on two places where this can happen. Now, recently, a few years back, the United States moved from the Securities Exchange, changed from what was called SEC Guide 7 to SK 1300. Now, SK 1300 is based on the Crisco template, but is not a Crisco template. So the situation is that the competent person doesn't have to, the registrations, it's a bit different, so that they can be signed off as a competent person under, they call it a qualified person, having looked at what is required. And as I said, the requirements are so similar, I don't think it's actually too difficult to do, but it's not identical. The other one that does also occur, for instance, in Indonesia, if you're signing off on work in Indonesia, which is a Crisco country, you have to be accredited by them, which requires a 10-year course and writing an exam. So there are some little nuances in there. If you're looking for some of the detail, JORC recently released a summary of the competent person's requirements for all the Crisco codes, and I think it includes SK 1300, and that's actually a really good document if you're looking for that sort of detail.
No, I think, let me turn it around another way. Are there mining jurisdictions where a Crisco code is not applicable?
Plenty.
Okay. Now, if that mining jurisdiction is part of a multinational group, how does the lead competent person then have to give instructions to the person in that country to do a SAMCODES report, or is he allowed to use the report that they've produced in their home country? My guess is no, he's not allowed. They've got to do a Crisco report or a SAMCODES report. But how do you police that process?
Okay, so I think it depends on. So we get public and private companies. So public companies, where it's on a stock exchange, it's black and white as to what's required for reporting. And if it's for JSE listing, then SAMCODES is applicable. If it's a secondary listing, then they'll allow one of the other Crisco codes. And then, as you suggested, Kevin, is that then instructions should be given to somebody in that jurisdiction to prepare a compliant estimation and report. And obviously, would I hope that there was guidance to do that. So that would be definitely situation for public companies. Private companies, that's a whole different situation. They tend to be a little bit more selective in what they do. And so they'll sometimes report something under Crisco and then something under another code or UNFC or something. But unfortunately, there's no way to police it directly unless and it's up to the investor to be sure of what they understand from that situation. But the strange thing is that SAMREC has no legal standing except the fact that it's linked to the JSE. So SAMREC, independently of the JSE, has actually no legal standing.
So my reading from that is that one of the other duties of the lead competent person is actually to be able to be satisfied that the other jurisdictions which are feeding documents in, that person meets specific requirements. And similar, like an accountant can't rely on another accountant's report without checking the judgment and the so forth. There's this similar type of situation in a multinational between the lead competent person and the reporting people up to that lead competence report.
Absolutely.
Thank you.
I see there's a query about getting the app for Apple. I know that it can be done because the lady who's running it, she has an Apple. I'm not exactly sure how it's done. I think we'll see if we can find the information for you.
Ken, if I can comment on that one. If you're running the Apple, there is a shortcut to an internet website on the app itself that will allow you to use the app on the website, but getting it as a proper app on Apple is still going to take a long while.
Thanks, Tanya. Any other questions or queries or comments?
Okay, well, if no one's got any further comments at this or further questions at this stage, let me thank you all for your time and attention this day. It's been a long day. We've covered a great deal of information. So there's quite a lot for you to go back home and digest. And then we will see you all again back here next week, same time, same place, to start looking at the valuation and the JSE listing rules.